Hi everyone. We are going to do a quick rapid revision of your ACCA FM paper. So FM paper, which is your financial management, is a skills level paper, and in this revision session, we are going to cover as much as concepts that we can. We're going to focus only on those important areas where the questions have been frequently asked. And also, we're going to take up questions from the past exam, the specimen papers. We're also going to analyze some examiner reports. And we are going to see how a computer-based exam looks like. So that's going to be the agenda of the entire revision session. Okay, so before we get into something, right, we first need to understand what is FM all about. I know this is a revision phase, and in revision phase, I expect all of them to know what FM is. And I hope everybody over here knows what are the chapters that are being covered in FM. So to give a quick recap, let me just share my screen. So this is your ACCA FM syllabus, right? So you can see that there are about 20 chapters. So any student that too during the revision phase, if they just look at this, it's not going to look pleasant, right? 20 chapters, oh my God, so much to cover. But we need to change our approach of looking at things, okay? We don't look at it as, oh my God, 20 chapters. Instead, why don't we look at these 20 chapters as concepts to be covered? And that's when it becomes really easy for us to plan our studies. Okay, so in these 20 chapters, if you observe, okay, what I can do is I have segregated these 20 chapters into concepts or the key areas of the syllabus. Now, when I say key areas of the syllabus, these are the very important chapters that we can definitely not skip. Correct? Of course, in professional exams, we can't afford to skip anything. But again, there are certain chapters which we have to give priority to, right? So we're going to discuss what are those chapters and where a student has to pay more attention to. And also, we're going to cover some past exam papers from those particular concepts. Okay, so let me just show you guys the key areas of the syllabus. So if you look at the entire 20 chapters, I told you guys that's going to be a shocker at the last moment. So that's the reason we have bifurcated those chapters into concepts. So in ACCA FM, the main three decisions, right? At this point in time, I guess everybody knows what are the three most important decisions to be taken by the finance manager. Yes, it is your investment decisions, dividend decisions, and your financing decisions, correct? Apart from these three decisions, now everybody understands that these three decisions, let me share the screen. Give me a second. Yeah. So I hope everyone can see the screen. Yes. So in ACCA FM, we are going to address the key areas of the syllabus, right? And the most easy answer that every student who has studied FM knows that the three most important decisions taken by a finance manager is, yes, your investment decision, financing, and dividend decisions, correct? But if you closely look at all those 20 chapters, you will realize that it is not just these three important decisions, but there are two more important decisions which a finance manager has to take. Of course, in the exam point of view, if they ask what are the three most important decisions, you're definitely going to say it's investment decisions, financing decisions, and dividend decisions. But apart from these, we also have to take decisions regarding our working capital and our risk management decisions. Correct? These two decisions are also really important. So if you look at the entire 20 chapters, can we not, okay, these entire 20 chapters can be bifurcated into these many categories? Starting with your working capital management, which is considered to be very important. Why is it very important? Because right from your chapter 7 to chapter 10, it talks about working capital management, correct? And after that, another reason why I would say working capital management is important, because it is not tested much in AFM, that is your professional level paper. So that's why here in FM it becomes very important. Then talking about your financing decisions. In financing decisions, we are going to talk about from where are we going to get the funds. All those funds will not come for free. Again, there is a cost involved. There's cost of equity, cost of debt, cost of preference shares, and together we calculate the weighted average cost of capital. So the merits and demerits of each sources of finance. So all those concepts are nothing but your financing decisions, right? Where we speak about the cost of capital, your capital structure. That again is your chapter 17 and 18. Moving ahead, once we have collected the funds, right? We have collected funds from maybe debt. Even in debt, we're going to discuss about the various types of debt. That is, there is a redeemable debt, irredeemable debt, convertible debt, equity, preference share. So we've collected the funds. Q collect kiya hai, so that we can invest it, right? So then we invest. So where do we invest? How do I decide, okay, this particular project is good to go or not? So then comes your investment appraisal or investment decisions, where we're going to discuss about, your basic investment appraisal techniques and advanced investment appraisal techniques. When I say basic investment appraisal techniques, it's your ROC, your return on capital employed, or your payback period. Very simple. But when I use the word advanced investment appraisal techniques, it is about the discounted cash flow techniques. What do you mean by discounted cash flow techniques? It is those techniques which considers the time value of money. You all know what is the meaning of time value of money. Why do I say that you all know? Because we're in the revision phase now. You all know that $1 today is worth more than $1 tomorrow. So naturally, when I'm making an investment decision, it is not going to be for 1 or 2 months, right? It is going to be there for more than a year, right? 5 years or 10 years. So it becomes very important for us to consider the time value of money, because if you have 100 rupees note with you, 5 years or 10 years back, 100 rupees note was buying you so much. Now that same 100 rupees is buying you only this much. What is that? That is your inflation, right? So inflation and various other macroeconomic conditions are going to affect your investment, right? So that's why investment appraisal is considered to be extremely important, not just in FM, but also in your AFM. Okay. And what are we going to discuss in investment appraisal? Here we're going to discuss about topics like which investment appraisal technique to use. Should I use NPV, IRR, return on capital employed, or payback method? Then we're also going to discuss things like, is it better to lease a particular asset or is it better to purchase it? We have to do this comparison, whether to lease or buy. And then we're also going to touch on concepts like what should the firm do when it has limited funds available for investment, right? That is your capital rationing. Then we're also going to talk about sensitivity analysis. That is when there is risk and uncertainty. Then what is to be done? So all those things are covered in investment appraisal. All right, which is extremely important. And then business valuation, we say it is moderately important. Of course, again, it is tested in your AFM also. So in business valuation, we are going to talk about why do we have to value business and what are the various methods to value business. So those are the areas. Apart from that, I told you guys, you have your working capital management decisions and you have your risk management decisions. So your risk management decisions are basically your foreign exchange risk and interest rate risk. So that again is least important because we're doing this revision session. We are bifurcating the importance of each areas, but very important in AFM, right? Why? Because it's tested very deeply in your AFM. All right. Apart from that, you have ratio analysis. Ratio analysis is very simple because by the time you cover all the chapters, no, you will learn all the ratios which goes into your working capital management or investment decisions or business valuations. So it is like a culmination of all the ratios that you've studied in your previous chapters. So now if I go back to the ACCA FM syllabus, it looks easy now because at once 20 chapters looked like a lot to study. But now, can you bifurcate? Can I say from chapter 2 to chapter 6, it's all about investment decisions? Correct? From chapter 7 to chapter 10, it's all about working capital decisions. Chapter 13 and 14 is about your risk management decisions. And then chapter 16 talks about your dividend decisions. Your 17, 18 financial ratios, all of these are your financing decisions, correct? And whatever chapters are left, those are your theory chapters. That is your sources of finance, what is the economic environment of the business, what are the functions of the managers, the board of directors, all of that. So now we have a clear picture as to what is FM all about, right? We've discussed the chapters, all the 20 chapters. We have converted the 20 chapters into concepts, right? Wherein we have seen that the three areas of the syllabus would be working capital management, which is very important, financing decisions, which acts as the base for your investment decisions, right? The weighted average cost of capital, that discount rate itself you're using for your investment decisions. So that, and then investment decisions, which are extremely important, business valuations, which is moderately important, risk management is least important but very important in AFM, so you have to get your basics right here, and then it's your ratio analysis and theory chapters. So now we can go ahead with the revision session because we've got a clear idea as to where to pay more attention to and which areas we have to give priority. Now that we've understood what are the key areas of the syllabus, shall we now understand what is the format of the exam? I know at this point in time, everybody knows the format and all of it. It's very important for us to get familiar with the format of the paper. It's not that you go to the exam hall and then you understand the format. No, that's very dangerous. Don't do such things. So let's now go and look at the approach, how to approach FM. So if you see over here, you have, it's a 100 marks paper, correct? So when I say 100 marks paper, we can bifurcate the categories into three areas, three sections, right? Section A, Section B, and Section C. Your Section A is your objective type question. What do you mean by objective type question? Your MCQ. Everybody knows what is MCQs, right? Multiple choice question. What happens in a multiple choice question? You will be given 15 questions and each question will carry 2 marks. So how much is it? Can I say we have how many sections? We have Section A, where we have 15 questions, right? And each question is going to carry 2 marks each. So 15 questions carrying 2 marks each. It is going to be your MCQs, okay, mainly. So can I say 30 marks, correct? So that goes to your Section A. Then comes Section B. What is your Section B? Section B is your case study questions. So when I say, or it's more like your objective type. This was more of MCQs, right? So when I say Section B, it's like how we have a case scenario, okay? Or it's like a short, like you remember in English, in school, we had a paragraph and based on those paragraph questions were asked. Similarly, you'll have a situation and based on that situation, you'll have 5 questions and each question will carry 2 marks each. So that's going to be your Section B. So can I say again, there's going to be 3 scenarios. Okay, there's going to be 3 scenarios and each scenario will carry 5 questions. Okay, and how much is it going to be? It's going to be again for 2 marks each. So total, this is also going to come up to how much? 30 marks. Okay, so you will have question number 1, question number 2, and question number 3. So this 1, 2, 3 are going to be scenarios, and based on that scenarios, you will have 5 questions each. So total, you will have 15 questions, and 15 questions again carrying 2 marks each. So that will come up to another 30 marks. Now, what can you expect in your section A? It's not just your multiple choice questions. There could be questions where you have to drag and drop, or it could be a match the following, or it could be you entering one, entering the figure. I will, at the end of the revision session, I will show you how a computer-based exam looks like so that you get an idea as to how the interface is, how the questions can be asked. And section B, as I said, there is a scenario, and based on that scenario, you have you have 5 questions carrying 2 marks each. So 30 marks over there, 30 marks over here. So it comes up to how much? Comes up to 60 marks. Kitna bataya? Total is 100 marks, right? So how much is remaining? You again have section C, which is your constructed response question. What do you mean by constructed response question? Wherein you will be given a case study, okay? And based on this case study, you will be given questions, all right? And unlike your section A and B, where you have to choose an answer or write it here, you have to briefly explain it. They can either give you a Word document or an Excel sheet where you will have to solve the MCQs, okay? And you will have 2 questions carrying 20 marks each. So that's going to be 40 marks. So your total now comes up to 100, right? That's your 100 marks paper. 20 questions, 20, 30, 30 and 40. So as explained here, that section A, 15 objective test questions, each were 2 marks. It could be anything. And section B, it is objective test cases, a scenario with 5 questions, right? So that again will be 10 marks per scenario. So 3 scenarios, so 30. And then you have section C, in which you have how much? 2 questions carrying 20 marks each. So if you look at the tips that they've given over here, this document, I have taken it right from your ACCA Global website. Okay, you have all of these resources available in the professional website. So please make use of it. So what are they saying? Always read the question carefully, think before answering, don't rush, answer all questions even if unsure of the question. Why do they say this? Because there is no negative marks, right? Kya jayega? Choose karo, okay? Better than getting 0, right? What if your tukka is correct? So you'll get 2 marks, no? So that's why don't leave any question. And when it comes to section C also, what are they saying? Plan your answer the requirement, okay? They're asking something, you are writing something. No, read the requirement twice, refer to the scenario, always mention the company's name when you're writing the answer. Break your answers up with headings or bullet points, or basically you have to impress the examiner. जो भी आपके papers correct कर रहे हैं, you have to make sure that they are able to, gauge you. They are able to, you basically impress your examiner who's giving you the marks, okay? So attempt all parts. Again, why? Because there are no negatives. So this is about your ACCA FM. We've already discussed the key areas where we spoke about investment decisions, working capital decisions, risk management decisions. All these are the areas of the syllabus. Okay. So I hope everyone here has got an idea now as to what is your ACCA FM, how to approach the financial management exam, and what are the chapters, concepts, and also the format of the exam. So that's your entire ACCA FM. Okay. So as I told you guys that out of all the areas, which is the most important one? It is your investment decisions, correct? So what I'm going to do is I'm going to break the revision sessions into categories where we are exclusively going to discuss about investment decisions. Okay, and in investment decisions, your right from your chapter 2 to chapter 6 is about your investment decisions, right? So if you look at the things here, we are going to start with what is your basic investment appraisal techniques. What are they? It's your return on capital employed and your payback period. Okay, why do we say that it is very basic? Because it does not consider time value of money. Then moving ahead, we have investment appraisal, where we're going to talk about discounted cash flow techniques. Here it considers time value of money, and here we're going to discuss about what? Your NPV, IRR, all of that. So to begin with, everybody knows what is the meaning of investment decision. When I say investment decisions, here we are going to talk about anything which is long term, right? And which involves a huge cash outflow. Okay, what do you mean by huge cash outflow? Lot of money is being used. Okay, if you're buying a machinery or an equipment or building, बहुत खर्चा होगा, no? So that is also called as your capital expenditure. So that is all about your investment decisions. Okay, so in order to check whether a particular investment is good to go or not, what do we have to do? We have to check whether it is profitable or not, whether it is giving good returns or not. And that is why we discuss the concept of investment appraisal. Okay, what do you mean by investment appraisal? Basically, it is a scenario appraisal. We are checking the attractiveness of the investment. And what is the attractive feature in investment appraisal? Any project which gives good return, that is the attractive feature, right? So, again, in investment appraisal, we are bifurcating it into basic investment appraisal techniques and advanced investment appraisal technique. Okay, so when I say basic investment appraisal techniques, here it is your return on capital employed, your payback period. Okay, and it's very important for you guys to know what are the advantages and disadvantages of each of the investment appraisal technique. Often in the exam, they have asked this question. When I say advanced investment appraisal techniques, those are those techniques which considers time value of money. Okay, and here we're going to discuss about NPV, IRR, and we have discounted payback. All right. Now, what is discounted payback? It is a simple payback itself, where this here in a normal payback question, time value of money was not considered. But in discounted payback, we do the math. Everything is the same. It's just that we have taken time value of money into consideration. Okay. So, one more thing that you need to remember here is that your return on capital employed is the only investment appraisal technique which considers profits. Okay, it considers profits and not cash flows. Whereas your payback, NPV, IRR, discounted payback, all of these, they take cash flows into consideration. Now, why do we need to understand the difference between profits and cash flows? Because cash flows are any day better than profits. Why do I say this? Because profits are very subjective. Profits can be manipulated, window dressed, and for all these reasons, cash flows are any day better than profits. All right. Now, again, when I say cash flows, the relevant cash flows, right? When I say relevant cash flows, those cash flows which are incremental in nature, which is, cash based, which helps you in decision making, those are your relevant cash flows, right? So in cash flows, you should always take your relevant cash flows. What are your irrelevant cash flows? Irrelevant cash flows are those cash flows which are historic in nature, which does not help you in decision making, like your sunk cost or committed cost. What do you mean by committed cost? Which you're going to incur anyway. We can also call it as unavoidable cost. All right. So these are your irrelevant cash flows. So in your chapter 2 of ACCA FM, we've discussed about return on capital employed, payback, and all of that. In discounted cash flow techniques, we cover the topic of NPV, IRR, all of that. And then as we go ahead with the chapter, that is further aspects of discounted cash flows. What is this further aspects of discounted cash flows? In further aspects of discounted cash flows, they are basically saying, now we all know how many methods are there. There is 1, 2, 3, 4, 5 methods. Out of all of these methods, the best method is your NPV. Okay, NPV method is considered to be the best method. And because it is considered as the best method, there are certain things. The reason why is it called best? Because it considers so many factors, right? And that is what they're discussing over here in chapter 4. Further aspects of discounted cash flows. These further aspects of discounted cash flows are taken into consideration in your NPV method. Okay, everybody knows what is NPV at this point in time. It is present value of cash outflows. When I say present value of cash outflow, it is your year 0. Year 0 में क्या होता है? आप purchase करते हो investment. आप purchase करोगे तो क्या होगा? There is a initial cash outflow, right? क्यों purchase करते हो? Because with the help of this investment, you are going to generate revenues in the future, right? Then you have your cash inflows. But problem क्या है? Problem ये है कि ये जो cash flows आप generate करते हो in investment appraisal, these are just forecasted cash flow, right? You are saying that okay, if I invest 10 lakh में एक machinery में invest, if I invest it, then I am expecting a cash inflow. Year 1 में maybe I'll get 50,000. Year 2 में I'll get 30,000. Year 3 में. So what are these? These are your predicted or expected or forecasted cash flows. But in NPV, what do? We convert those future cash flows to present value terms. Now to convert the future cash flows to present value terms, I need a discount rate. Now you can call it as discount rate, you can call it as hurdle rate, you can call it as weighted average cost of capital, whatever. So the moment I convert my future cash flows to present value terms, that's when I get my present value of cash inflow. So your present value of cash outflow plus your present value of cash inflow, whatever answer you get, that's your NPV. Agar NPV positive ho gaya to very good, accept the project, good to go. Negative aaya to reject the project. Clear? So that was about your NPV, and the reason we say NPV is an excellent method is because it considers time value of money and it takes these 3 things into consideration. What are they? One is inflation, one is tax, and working capital. All right. Because it considers inflation, tax, and working capital, we call NPV as the best method out of all the other techniques. Again, in inflation, we discussed in this chapter itself, there are 2 types, right? One is your specific inflation and then there is general inflation. Abhi India mein general inflation to 6% pe chal raha hai, correct? But what about specific inflation? Sales are getting inflated at a particular percentage. Variable cost is getting inflated. So these are your specific inflation. क्यों हम ये सब बात कर रहे हैं? क्योंकि whenever you're talking about investment decisions, we have to convert our future cash flows to present value terms, and those future cash flows have to be inflated. And once you inflate your cash flows, they become nominal cash flows. Those cash flows where we have taken inflation into consideration, we call it as nominal cash flows. Or nominal cash flows को present value में लाने के लिए you need a discount rate, right? And that discount rate what you use also should be a nominal rate of return. All right. So this is about your cash flows and the interest rate. Nominal cash flows and nominal rate of return. So that's about your inflation. Talking about tax तो भरना ही पड़ेगा. Machine you've purchased the machine, it is giving you good sales. After deducting tax, आपको profits हुआ, आपको cash flows मिला है. Now these cash flows are before tax, so you have to convert it after tax. And one more important adjustment in tax है, that is your depreciation. क्या ये relevant cash flow है? नहीं. Depreciation is a non-cash item. It is an irrelevant cash flow. पर मगर depreciation tax shield. What do you mean by depreciation tax shield? Suppose my depreciation is $100,000 and the tax rate is 40%. जो $40,000 है ना, this is a cash inflow and this is a relevant cash flow for me. Okay, depreciation is not a relevant cash flow, but depreciation tax shield is a relevant cash flow. So that you will have to take into consideration when you are calculating your cash flows. And we all know what is working capital. We've discussed in our normal classes the importance of working capital. It is the capital that is required for day-to-day operations of the business. And right from your chapter 7 to 10, it talks about how to manage your inventory, accounts receivables, accounts payable, all of that. So working capital is always a outflow in the beginning of the year, because suppose you purchase a machine, right? You purchase this machine and what happens? Will the machine work by itself? Of course not, right? It is not a robot. So you will have to put raw materials, you will have to put labors. So ये सब तो आपके day-to-day operations के लिए. So raw materials, labor, money चाहिए. So that is nothing but your working capital, which is an outflow in year 0. But once the project comes to an end, it is a cash inflow. Okay, we call it as a recovery of working capital. So that's about your chapter 4, where we discuss about further aspects of discounted cash flow. In that, these are the areas where you have to pay attention to. Then when I talk about asset investment decisions and capital rationing. Now, what are these asset investment decisions? Okay, so this was all about your chapter 3. Correct. Then this is your chapter 2. And then when I spoke about the inflation and all of that, this is your chapter 4. And then in chapter 5, what are we discussing? Your chapter 5 is all about your asset investment decisions. What is it? Your asset investment decisions. What is this asset investment decisions? It is, you'll have situations where, one, whether it is better to lease a particular asset or whether it is better to buy the asset. So lease versus buy. So whenever you come across a lease versus buy question, what are you supposed to do? You have to check what are your relevant cash flows. Okay, what do you mean by relevant cash flows? In case of leasing, okay, what are your relevant cash flows? One is the lease rent, correct? And then you'll also get tax relief on your lease rent, right? These are your relevant cash flows. Similarly, if you're purchasing the asset, what are your relevant cash flow? One is the purchase price, that is whatever is the cost of the asset. Then you have your TAD, that is nothing but your depreciation tax shield that I spoke about, tax allowable depreciation, and then your scrap value, right? So what do we have to do? We have to calculate the present value cost of leasing, that is NPV of leasing, and present value cost of buying, right? Jo bhi kam aata hai, we will go with that, right? The least out of these is the decision that you have to make. So we are going to talk about whether to lease a particular asset or whether to buy it. Then we're also going to address certain scenarios where yeah, I think I was muted. Yeah. So in the second decision, asset investment decision, what you are supposed to do or you can expect is the replacement decisions. What do you mean by replacement decisions? What do you understand by replacement decisions? So often finance managers are confused when is the right time to replace a particular asset? अगर आपके पास एक मशीनरी है, क्या आप वो मशीनरी 20-30 साल तक यूज कर सकते हो? नहीं. आफ्टर अ पॉइंट इन टाइम व्हाट हैपेंस टू दैट मशीनरी? मेंटेनेंस कॉस्ट बहुत आएगा, राइट? और स्क्रैप वैल्यू नीचे जाता जाएगा. So can I say, if you use an asset for a really long time, okay, two things will happen. One is the maintenance cost is going to go up and up because it's an old machinery, so that's the reason. And another reason is the salvage value will come down. So that is your replacement decisions. Okay, so in replacement decisions, we are going to talk about when is the right time to replace a particular asset. And that's the reason here in replacement decisions, we're going to cover topics like EAC, that is your equivalent annual cost, where we convert the cash flows to present value terms, right? And then we check whichever is giving you the lowest EAC, that is the right time, because we are going to have confusion whether we have to replace a particular asset after 4 years or we have to replace it after 6 years. So using our equivalent annual cost method, we are going to decide when is the right time to replace a particular asset. And then, of course, in this particular chapter, we are going to talk about your capital rationing situation. What do you mean by capital rationing? Capital rationing is a scenario where a company has limited funds. It has limited funds available for investment. आपके पास 10 लाख है, पर प्रोजेक्ट का कॉस्ट 12 लाख होगा. लाइक लेट्स से आई हैव $100,000, okay, and I have project A, B, C, D. A will cost 80K, B will cost 10K, C will cost 50K, D will cost let's say 20K. Can I take up all the projects? No. I have only $100,000. So this is a situation of capital rationing. So whenever I have capital rationing, I will have to check how can I utilize my funds in the best possible manner? Okay, how can I utilize my funds in the best possible manner so that the NPV is the highest? Should I take A and B or should I take C and D? So you have to check. So here we talk about divisible projects and indivisible projects. When I say divisible projects, they are those projects which can be taken partly, right? For example, I have $100,000. I can take project A, I can take project B. But can I take project C? 80 हो गया, 10, 90. I have only 10,000 remaining, but project C is 50,000. So I can make part investment, okay, a portion of it. Now that is your divisible project. If it is an indivisible project, it is a type of project where you can either take it fully or not take it at all. So that is your capital rationing. Okay. So these are the topics that are being covered in your chapter 5. And finally, when I talk about investment appraisal under uncertainty, you all know what is the difference between risk and uncertainty, right? There is a difference. Risk, you know what are the outcomes, you can assign probabilities, but uncertainty on the other hand is where you just have no clue about what's going to happen. Okay, and in such a situation, so that's your chapter 6. Okay, in chapter 6, we're going to discuss about your sensitivity analysis. What do you mean by sensitivity analysis? Sensitivity analysis is a topic where we are going to talk about what if scenarios. What do you mean by what if? What is the meaning of this? What if I increase my variable cost? What will happen to my NPV? What if I increase my selling price by 5%? What's going to happen to my NPV? So these are the questions that we're going to address in sensitivity analysis. So in sensitivity analysis, the what if scenarios, and we are also going to talk about we're going to take up problems on sensitivity analysis, then joint probabilities. So these are the things that are being addressed in sensitivity analysis. Okay, guys, so I'm going to stop over here now, because this first class of revision session, I wanted you guys to understand what are the where do we have to concentrate, what are the key areas of the syllabus, what is the format of the exam. And we have had a detailed discussion about investment decisions, right? We've gone through ऊपर से हमने chapter 2 to chapter 6 Everything that goes into that chapter we have discussed. So in the next class, I am going to take up past exam papers. Okay, I'm going to take up past exam papers and solve questions from investment decisions. That is this topic. Okay, so I'll see you guys in the next class with past exam papers. All right. So till then, keep revising and brushing up your concepts so that you guys can clear your FM exam in the very first attempt. All right. I'll see you in the next class. Bye. Hi everyone, welcome back to ACCA Rapid Revision classes. We're doing financial management revision, that is your FM paper. So in the previous class, we discussed about the syllabus, we discussed about the important concepts, what is the format, and we also saw one of the most important decisions taken by the finance manager, that is your investment decisions, right? And in investment decisions, we saw the chapters, that is from chapter 2 to chapter 6, where we discussed about all your investment appraisal techniques, right? Your basic investment appraisal techniques, advanced investment appraisal techniques. So we had an overview of all the chapters where we discuss about investment decisions. So as mentioned earlier, today we're going to do some past exam papers, okay, on this topic. So in the past, as you all know that your format of the exam has section A, B and C. Section C carries 40 marks. That is 2 questions carrying 20 marks each. And most of the time, okay, according to statistics, your section C questions generally come from investment decisions or working capital decisions or business finance. It is generally in these 3 areas that the concept is being tested. So in today's class, we will take up some past exam papers of the topic investment decisions, where we will be covering, or we will be seeing how to tackle those tiny adjustments, or it could be a mixture of all the investment decision chapters where they ask one question where there is concepts related to discounted cash flow or on capital rationing or lease versus buy, like that. So not wasting much of time, let's directly go to the past exam paper. So if you see over here, this is how your paper looks like. Okay, this was your December 2020 exam. Okay, you know there are 3 windows, right, wherein you can appear. So this was the September and December ka paper. So let me just go to the question. So here basically they're just telling you the instruction as to, you will have, as we've already discussed, you have 2 constructed questions which will be 20 marks each, so 40 marks in total, all of that, and then you should click next to start. See, this is exactly how your main ACCA FM exam is going to look like, the interface I'm talking about. Don't worry, in a CBE environment also we will go through how the format looks like. But if you see over here, this is how the exam paper is. You'll have the scenario, and based on that scenario you will have sub questions, right? And they'll give you enough space also to solve. For example, here it's a question on evaluation, so you will have to work it out, right? So they'll give you an Excel sheet. But here if you see, it's about explanation or discussion. So for that they'll give you a word format where you will have to type in the answer. So similarly, there is this question which came in December attempt. Okay, so it's a past exam paper. How about we do this question, and at the same time we will revise the concepts that is being tested in investment decisions. That is right from your chapter 2 to chapter 6. So let's first give it a quick read. And for your information, all of these papers, okay, your past exam papers, they're easily available from your ACCA Global website. All you have to do is go to your ACCA Global website and then look for your past exam papers, and you'll find all of them. You can even download them. Okay, so let's do this question. So here, if you observe, Crockett Company is a manufacturing company and has 3 investment decisions for the coming year. So there are 3 investment decisions. One, they have 6 investment projects are being considered with the following details. So they've given how much is the initial investment, and they've also given us the NPV, right? Then project B is expected to generate the following annual cash flows. Out of this project B, these are the cash flows that you can expect. Then they're saying project B cash flows are before allowing for inflation. So you know that your NPV method, it considers inflation, and we also know that inflation is of 2 types, right? There is general inflation and there is specific inflation. So if you look over here, what are they saying? That project B cash flows are before allowing for inflation of 4% per year for sales, and 5% per year for cost. So can I say this 4% and this 5%, okay, which is your specific inflation? Why do I call it as specific inflation? Because it is addressing only for your sales and your cost. Okay, and then they have already given us the nominal cost of capital, which is 10%. So what is the meaning of nominal cost of capital? So there is real and nominal, right? Real interest rate and nominal interest rate. So when I use the word nominal interest rate, it basically means they have already considered the inflation, right? So this 10% is after including general inflation also. Okay, so there is no extra step for us to use Fisher's formula and calculate the nominal rate of interest, because it's already given to us. Okay, then due to management reluctance to raise new finance, capital for investment in above project is currently restricted to $5 million. So can I say here they have combined chapter 3 and chapter 5? Because chapter 3 talks about discounted cash flow and what are the aspects in your discounted cash flow. And the moment they say that the company is restricted to just $5 million, can I say this is a situation of capital rationing? What do you mean by capital rationing? It's a situation where the company has limited funds available for investment. Okay, then they're saying project A, B, D and F are independent, but project C and E are mutually exclusive. Now, what does this line mean? A, B, D and F are independent, but what about project C and E? They are mutually exclusive. So we've already seen in our classes that mutually exclusive means what? I can either take C or E. I can't have both. Why? Maybe because they're using the same resources, right? So whenever the projects are mutually exclusive, I should take any one of the 2. Okay. Then they're saying all of the, what else? Okay, let's go down. Apart from that, they're saying that all of the projects are divisible and none can be delayed or repeated. Now, what do you mean by divisible projects? Again, something that we have discussed in chapter 5. So, divisible projects are those projects which can be done partly, right? Or indivisible projects are those projects which you have to either take it fully or not take it at all. So, whenever they say divisible projects, it means that you can do part investment. Okay, so it's very important for us to first understand the question, because once we understand the question, then it will be easier for us to start solving. So that was investment decision 1. The company had 3 investment decisions. Then they're saying a number of Crockett Company's employees have a company car. The entire company car fleet is now due for renewal, and in the past it has been replaced every 4 years. Management are not sure if the optimum length of time and feel that other fleet replacement cycles such as every 3 or 5 years should also be considered. So look how they have combined your replacement decisions also into this question. So this company is not sure whether they have to replace the car after 4 years or after 3 years or after 5 years. So this is again talking about your replacement decisions, right? So it's whenever you come across replacement decisions, you're confused. When is the right time to replace the asset? So that's when you have to check for the optimum replacement cycle. Okay, we call it as optimum replacement cycle. And how do we calculate the optimum replacement cycle? by calculating your EAC, right? With the help of EAC, you will identify when is the right time to replace a particular asset. Then apart from that, they're saying the management of Crockett Company are considering the financial viability of another project, but as yet no detailed information is available to perform an NPV appraisal. One of the reasons for this is the various cash flows will be subject to a number of different rates of inflation that are very uncertain and pleasant. For example, the selling price may be more than 2%, material cost may be 4 to 6%, general rate of inflation is again going to be different, and management are not sure whether the appraisal could be performed by simply ignoring the inflation altogether. Note that the 5 million capital consent outlined with investment decision 1 applies to investment decision 2 only 1 and not to investment to decision 2 and 3. So this is the question. Okay, it's a 20 marks question which came in the past in December attempt. So what are they asking? First and the foremost question, for 4 marks, they're asking calculate the NPV of the project. Second question, they're asking given the capital constraint, that is there is a capital rationing situation over here, calculate the optimum investment combination and the resulting NPV. So they're basically asking us, if at all, we have only $5 million, and because I have only $5 million, I can't take up all the projects, right? So in which way I can utilize this $5 million in the best possible manner so that I get the best return. That is what they're asking. Then they're asking for investment decision 2, explain the approach Crockett Company should use to determine the optimum replacement cycle for the company car fleet. Okay. That's again, they're asking us to calculate when is the right time to replace. And then finally, for 6 marks, they're asking in relation to investment decision 3, describe 2 approaches for dealing with inflation and provide a reasoned recommendation as to which approach Crockett Company management should follow. So that brings up to total of 20 marks. So I hope everybody has understood what the question is. The question is a full-fledged question where they have given you concepts right from chapter 2 to chapter 5 of investment decisions. Okay, so what we'll do is we will solve this past exam paper in our Excel sheet. Okay, because even in the exam, you will have to solve the questions in an Excel sheet, right? So similarly, they'll give you like this, an Excel sheet in the exam as well, where you have to solve it. So that's the reason I'm going to the Excel sheet now. Just give me a second. Once. Okay, so let's start with the first question. I hope everyone can see the screen. Okay. So, yes. Which problem are we solving now? We are doing Crockett Company. Okay. So let's start. So it's a past exam paper. That is Crockett Co. So what is the first question that they're asking? Let me check. So they're asking us to calculate the NPV of project B, right? So we'll put it this way. A part of the problem, calculation of NPV, that is for project B. Okay, so it's always better to make your answer look very presentable. Okay, so we're done with mentioning the heading. So let's start with the calculation. So what's the first step? Let's see what is the life of the project. So for project B, they've told project B is expected to generate following annual cash flows. So 4 years, right? So we'll put it that way. We have year, correct? 0, 1, 2, 3, 4. Okay, so these are the years. Then what else? After that, first year 0 may what happens? You purchase the asset. How much initial outflow? It is 1,500 and NPV we will have to calculate. So let's say that everything is expressed in millions. So year 0, negative 1,500. And how much are you going to get? Sales is going to be 725, 765, 885 and 612. So we'll write this is your initial investment. Then how much is your sales? Look at the question. They're saying 725, 765, 885 and 612. But do you observe here that they have specifically told us that project B cash flows are allowing for inflation of 4% per year for sales and 5% per year for cost. So I will have to, now these cash flows have to be inflated. So how will I do it? Every year it is getting inflated. Year 1, it is 725, but this is before inflation. There is inflation at 4%. So what will I do? 1.04, the whole to the power 1. This is the inflated sales. Similarly, for year 2, how much is the sales figure? It is 765, but this is before inflation. So 765 into 1.04, the whole to the power 2. Then third year, it is 885. Right? So 885 into 1.04, the whole to the power 3. And then over here, year 4, how much is your sales? It is 612 into 1.04, the whole to the power 4. So in this way, what have we done? We have calculated the inflated sales. Right? This is your inflated sales. Similarly, you have your cost. Now, what about cost? Cost is also getting inflated. They've told in the question that it is getting inflated at the rate of 5%, right? So, here, if you want, you can mention over here, 4% is the inflation. Similarly, over here, 5% is the inflation. So, how much is your cost? It is 145, but after the inflation, it is going to be 145 into 1.05, the whole to the power 1. Similarly, over here, how much is it? 168 into 1.05, the whole to the power 2. 202. 202 into 1.05, the whole to the power 3. Then 94 into 1.05, the whole to the power 4. So this way we have calculated the cost also. So can I say sales minus your cost is going to give you your net cash flow? Mean your cash flow, because we have not discounted it yet. So can I say this minus this is your cash flow, right? Sales minus cost. Same way if I drag, I'm going to get it for every year. But these cash flows, have they been discounted? No, we have not discounted these cash flows, right? So what is the discount factor? Tell me. How much is the discount factor? They have told us that the nominal cost of capital is 10%. So these are my future cash flows. I have to convert these future cash flows to present value terms. So for that, I will have to discount it at how much? 10%, right? So either you can refer to your present value tables, which will be given to you in the exam, and arrive at the answer, that is what are the discount factors, okay? Or you can simply do it easily in Excel. How do you do it? For example, I want 10%, right? You know, for year 0, it's going to be 1 itself. Here, I will do 1 divided by 1.1. This would be for first year. Let's take up to 3 decimal places. For second year, you can do previous one again divided by 1.1. For third year, take the previous one divided by 1.1. Again, take the previous year divided by 1.1. So in this way, we have got the discount factors. You can either do it in your Calc or you can refer to your tables, or you can do it simply like this in the Excel. So what is the final step? To check what is our present value. So can I say 1500, which I have today, is going to be the same 1500 itself? 1500 into 1. But what about these future cash flows? This into this, right? 642 into this. This way, you can simply drag it, but I'm just showing you guys how we are getting it. This is my future. I'm getting it in year 4. But what is its present value today? It's this much. So in this way, we've got our cash flows. So what is the final step? To calculate your NPV. How do you calculate your NPV? What is it? Come on, at this point in time, everybody knows what is the meaning of NPV. NPV is present value of cash outflow plus present value of cash inflow. So this is your present value of cash outflow. These are your present value of cash inflow. So together, you're going to get NPV. So how much is your NPV? It's coming up to 561. Now everything, remember, this is expressed in millions. So that means it is $561,000. So this is how we do the question. So what is your answer? That was your first question which we have answered, right? Which was for how much? Only for 4 marks, but very simple, correct? So this was for 4 marks and this is the first question. Similarly, what else are they asking? Let's have a look at it. In the second question, they're saying, given the capital constraint, calculate the optimum investment decision, investment combination and the resulting NPV. Now we have a capital constraint. What is it? We have only $5 million, but we have so many projects, correct? We have 6 projects, but I have only 5 million. So obviously I can't take up everything. So I can take, but since they are divisible projects, I can do part investments. So how do I go about it? How do I start? So let's do the second part of the question, wherein they're asking us to calculation of optimum investment combination. All right. So let's do that. Let's type in the heading, calculation of optimum investment decision. Okay. So this way our heading is ready. So now we will have to calculate the optimum investment decision. So you know that there are mutually exclusive projects, right? What are the mutually exclusive projects? They're saying you can either take C or E, right? So what should I do? I want to know which is the best one. So what will we do? We will first choose project C over project E. This is scenario 1. Okay. And then we'll check how much is the NPV in this particular situation. And then we will choose, in the second scenario, we'll choose project E over project C and check how much is the NPV. Wherever I'm getting the highest NPV, we will go with that. So basically, we have to solve once this scenario and this scenario. Since they were asking it for 6 marks, this would be for 3 marks. This would be for 3 marks. Correct? So let's do it. So first situation, we'll put it this way, choosing. Now, why am I doing this? Because a mutually exclusive project, right? And in the question also, they are specifically mentioned that taking into consideration the capital constraint, you have to calculate the which investment combination will result in the highest NPV. So if I'm choosing project C over project E, I'll have to check how much would be my, okay, if this is the situation, what will be my NPV? And then the second scenario is where I'm choosing E over C. So let's start the problem. How much is the NPV? How many projects are there? Tell me. Projects, you have A, B, C, D, E and F. Correct? These are your projects. They have given us how much is the initial investment. Correct? Can you all take it down? It's given to us in the question. How much is the initial investment? And they've also given us how much is the NPV, right? So let me put it. So I'm choosing project E over project C. So I will delete E because we are not taking it, right? Now I'm taking this combination of choosing project A, B, C, D and F. How much would be the initial investment? 1,000, 1,500, 750, 1,125 and 1,300. Correct? I've just taken the initial investments. And what about the NPV? How much is your NPV? 390, 561, 325, 590 and 635. How did I get 561? From the previous problem for project B. We calculated it, right? So in that way, we've got the answers. So this is my initial investment. Okay. Anything else? Then they are asking us, let's calculate the profitability index. Why am I calculating profitability index? Because these projects are divisible. So let's just understand the concept once. You know that projects can be divisible or indivisible, right? Whenever the projects are divisible, right? Whenever the projects are divisible, that time we have to use profitability index. For indivisible projects, we generally use trial and error method. Okay, so profitability index, how do you calculate? It is NPV divided by initial investment. Correct? It is NPV divided by initial investment. So let's do that. Correct? In this way, you will have to calculate for everything and we'll get the profitability index. Let's take up to 3 decimal places. Now, once you take the profitability index, I hope you guys remember, what do? We start ranking the project. Correct? We start ranking the project. So let's start ranking. Which one is giving the highest profitability index? Can I say it is project D? Right? Project D and then project C, F and then project C and then 4 and 5. Just based on numbers, we are giving the ranking. So, why do we need these ranks? We need these ranks to give priority. What is my capital constraint? In the question, they've clearly told us how much we have. We have only $5 million. $5 million, if I'm ignoring the last 3 zeros, that means how much do I have? Capital constraint is equal to $5 million, right? Which is because here we are expressing everything in millions. Correct? So I have only 5,000. So first, if I can I say that I can invest fully in project D? Because that is given the first priority. So I can invest full 100% here. Okay, so you can take your calci and start checking where you can invest and where you can't. Then second, 5,000, 1125 is done. Out of 5,000, 1125 will go for project D. Second priority will be for project F. This also I can invest 100%, right? Then my next priority would be for project C, which is 750. Here also I can invest full 100%. Okay. Then my next priority is to project 4. Do I have enough money? Check. Yes, I do have enough money to invest in project A as well. So you can actually see, I have only 5 million, that is 5,000. If I invest in project F, 1,300 gone. In project D, 1,125. Then third priority, 750. Then fourth project, I invested 1,000. So I have how much? I have only $825 remaining, right? Because here also I will invest full 100%. But do I have full 1,500 to invest in project B? No, I have only 825 because I've invested in other projects, capital constraint, capital rationing. So only, and since they are divisible projects, I can invest in a proportionate basis, partly. So how much out of 1,500? Only 825 I can invest. So can I say 825 divided by 1,500? 825 only I can invest out of 1,500. So how much will it be? 55%. Only 55% I can use. So if I can invest only 55%, will I get the full NPV? Of course not, right? How much ever I've invested, that much only NPV I can expect. So can I say the total NPV that I'm going to get is, in case of project A, I'll get full NPV, right? Because I've invested fully. Then in case of project C also, I'm going to get full NPV. In project D also, I'm going to get full NPV because I've invested fully. Here also, I'll get full NPV. But what about project B? In project B, I've invested only 55%. So NPV also, I will get only 55%. So that would be 308.55, which I can round it off to 309. So this is my total. So let's see what is the total I'm getting. So the total is some error. Well, 1 second. Just take the total. Yes. So my total NPV is 2,249. Okay. This is my total NPV if I choose project C over project E. Now this was for 3 marks. Now same thing. Okay. I'll have to check what will happen if I choose project E over C. Okay. Now what is happening? We are choosing project E over C and checking if it is still. So I will remove C. Okay. And instead I'm investing in E. Right. How much is project E? Let's go check from the question. Project E is 1850. Right. So we'll change this to 1850. And what about the NPV? 840. Correct. So we've already, the Excel will directly do the math. You all can take it as homework. But since I have copy pasted this thing, the Excel will directly do the math. You know, it is 0. Everything is the same. Correct. What is your profitability index for project D? Now I'm choosing project E over project C. So 0.390, 0.374. What is your project E would be this divided by this. Sorry, NPV divided by initial investment. How much is your project E? Let me check from the question. Project E is 1850. That is the initial investment. and NPV is 840. Okay, this is your project E. Correct? NPV, yes. And what about your project D? How much is it? 1125 and 590. So divided by, and what about project F? 1300 and 635 is your, yeah. Okay, let's now start ranking the project. So which one will be given the first priority? Highest is for project D itself, then second project F, then this, and then this. So you have only 5 million, that is 5,000. So you will invest full 100% here. Then you can invest here also full 100%. Then the next priority here also you can use 100%. So how much over? 5,000 minus 1,300 minus 1,125 minus 1,850. You have only 725 left. Correct? So next priority is to project A. You have only 725, but how much is it costing? 1,000. So can you invest fully 1,000? No, you have only 725. So check how much 725 divided by 1,000. So only 72.5% you can invest. And in project B, you cannot invest anything. Why? Because there is this capital rationing. You have limited funds. So can I say you'll get full NPV for the projects where you have invested fully? Correct? Over here, you'll get all full NPV. And over here, you've not invested anything. So NPV also you'll not get. So finally, how much is the total NPV if you're choosing project E over project C? Let's calculate. Two, 455, is it correct? How much do you get? 72.5%. This into 72.5%. 840, 590, yes. So somewhere around 2348 is your total NPV. So which is better, guys? What is the conclusion? What conclusion can I give here? Because what is the question asking? The question is for 6 marks where they're asking, given the capital constraint, that is I have only $5 million, calculate the optimum investment combination and the resulting NPV. So the optimum investment combination. So you can write optimum investment combination would be to choose project E over C because it results in higher NPV, right? Here you were getting only $2,249. Here you're getting $2,348. So this is how you're going to approach a mutually exclusive project. So look how they've combined chapter 2, 3, 4 and 5 in this particular question. It's a past exam paper. Was it very difficult? No. It's just that we need to know the concept and then it is completely manageable. Okay, let's finish this problem. Then they're asking for investment decision 2. Explain the approach Crockett Company should use to determine the optimum replacement cycle. Okay, so let's do the next part now. So this was the first part of question A. Now let's do the B part of the question. That is calculation of optimum replacement cycle. So how do you start? We need to first calculate this is our question, no? Rocket. Okay. So let's check for investment decision 2. What are they saying? The entire company fleet is now. So they want us to check how much would it be if I were to replace it. Okay, it's not basically a calculation that they're asking us, right? So if you see, it's a theory question. They're just asking us. See, we don't have to calculate it. Here they're asking, explain the approach that Crockett Company should use to determine the optimum replacement cycle. So they're asking us the approach, not the calculation. So here you can write approach to arrive at optimum replacement cycle. So how do you start whenever there is a replacement cycle question? How do you do it? I hope you all remember. It starts with first checking for every year, right? So can I say approaches to determine or approaches to arrive? Okay, you can write approaches to determine the optimum replacement cycle. How do you do it? First and foremost, you have to determine the cash flows for each year, right? You'll have to check every year if you're replacing it after 3 years or if you're replacing it after 5 years. Every year, what are those cash flows? Then you have to also check what is the initial investment, what is the maintenance cost, correct? And then you should also calculate the scrap value. In this way, you will first have to determine the cash flows each year, the initial investment and everything. Once you calculate the cash flows, you have to discount those cash flows, right? Discount these cash flows at a given rate. Then what will you do? After discounting these cash flows, you're basically calculating the present value. You calculate the present value of cash flows. Then you have to convert to EAC. What is EAC? Equivalent annual cost, right? This is your equivalent annual cost. And what is the formula for EAC? It is present value of cost divided by annuity factor for that year. For example, if you're replacing after 3 years, whatever is the discount rate, for example, if the discount rate is 10%, then you see what is the annuity factor at 10% for year 3. Similarly, you see what is the annuity factor at 10% for year 5. So in this way, you will calculate the EAC, and lowest EAC is equal to your optimum. Whichever gives you the lowest, that would be your optimum replacement cycle. So in this particular question, the examiner wanted to check whether you know the concept or not. How would you arrive at your EAC? So all you had to do is write the steps to solve a problem on replacement decisions. Okay. Which they asked for how many marks? For 4 marks. So ideally 4 to 5 steps you have to mention. Then they're also asking us this question. Please go through this question. So we're done with answering 6 plus 4, 10, 10 plus 4, 14. So we are left with a 6 marks question, which is again theory, right? And what are they asking here? They're asking in relation to investment decision 3, describe the 2 approaches for dealing with inflation and provide a reason recommendation as to which approach the Crockett Company management should follow. So can you all just give a quick read as to what is investment decision 3? Go through investment decision 3. Okay. So for 6 marks, again, it's a theory question. So can I say out of this 20 marks question, if you observe, they have asked us the first, my God. Yeah. So they have basically asked us to calculate, where is it? Yeah. So for 6 plus 4, 10 marks was 10 marks was practical and 10 marks was theory. So they've given equal weightage to both theory and practical question. Here for 6 marks, they're asking the approach. So how will you start the answer? See, they're asking in relation to investment decision, describe 2 approaches dealing with inflation. So we know that there are two approaches, right? One is your real and nominal. When I say real, it is without inflation, and nominal when it is including inflation. So you will have to write your answer related to that. Here you have to basically talk about the 2 types of approach. 2 approaches. What are they? One, you will have to talk about the nominal approach and the real terms approach. What happens in nominal approach? You know that in nominal approach, we convert the cash flows, right? With the nominal terms approach, both the cash flows and the discount rate. So you can write over here, cash flows and discount rate, both take inflation into consideration, right? Using Fisher's formula, we convert our future cash, we convert real interest rate to nominal interest rate. We find out what is our I. Nominal rate of interest is also called as your money rate of interest, right? So cash flows and discount rate both take inflation. So if you remember, when we did this problem, the first A part of the problem, here we took a nominal approach. Why nominal approach? Because we use 10%, which is a nominal rate of interest. And all these cash flows were inflated. We had taken inflation into consideration, where we have taken inflation for cash flows and also the interest rate. So that is your nominal approach. If it was a real approach, I would have taken the I would have taken those cash flows without inflation, and even my interest rate would be less than 10% because this is inclusive inflation. So in this way, you're going to write about the nominal approach, where you're going to say that in your nominal approach, you have to take the cost of capital also should be inclusive, and you have to talk about Crockett Company. You have to tell that Crockett Company, where is it? Yes. So you have to say that Crockett Company will need to apply the specific rates of inflation. Why? Because they have given to us in the question, no? What are the specific inflation and other cash flows to ensure that we have taken inflation into consideration. And then when it comes to real term approach, we don't take inflation into consideration, right? So even the discount rate would be not 10%, it would be without inflation. So we should have, so that's why in this particular question, can I say that real term approach would not be suitable because they have specifically given us specific inflation for both your sales, income and everything, and they have only given us the nominal cost of capital. So your recommendation here should be that Crockett Company should use nominal approach and not real approach, right? That is how you have to frame your answer. So yeah, in this way you can write that real term approach would result in a much easier appraisal exercise for Crockett Company because we have not taken uncertainty, that is inflation, into consideration. But it would not give a realistic approach because you know how important inflation is, right? So that's the thing that you will have to mention over here. So that was your full-fledged 20 marks question on investment appraisal, right? So by this, we've covered most of the concepts of investment decision, that is your NPV, capital rationing, then your replacement decision, all of that. I would want you guys to do, take up a homework question, okay, on investment decisions, that is, Hayback company from your Kaplan exam kit, because this particular question has taken all the three factors, that is your inflation, working capital, tax, all of that. So it's a full-fledged investment appraisal problem, which I want you guys to try it out as a revision. Okay, first you do it by yourself and then refer to the solution, because once only if you look at the solution, then you will not know where you're going wrong. So first solve, go through the question, and please solve it in Excel, because your main exam is not pen and paper. It is a computer-based exam. And just like how I showed you guys how to do it in Excel, try this problem in Excel. And by this, your entire investment decision would be revised, right? So we can now move to the next concept. Just give me a second. So after this full-fledged investment appraisal section C question, let's do some questions from section A and B also. Because often what happens, you know that students give too much attention to section C and they forget to pay more attention to section A and B, which is your MCQs, and your based on a case study, you have 5 MCQs, right? So you should not forget that yes, section C carries 40 marks, but your section A and B together carries 60 marks. So, and MCQs are like that. Either you can get full 2 marks or you'll get 0. There is no in between, right? So that's why regarding the same concept, that is investment decisions, let's take up some more challenging MCQs so that our concept becomes even more clear. So let me share the screen. Okay, so let's do some MCQs regarding investment appraisal questions. All right, so your first question here, it's a scenario, and based on the scenario, they've asked 3 questions, okay? So they're saying NW company is considering investing $46,000 in a new machinery, a new delivery lorry that will last for 4 years, after which time it will be sold for 7,000. Depreciation is charged on a straight line basis, and they have given us the operating profits or losses from that particular machine. What is the return on capital employed for the lorry? So you all know how to calculate return on capital employed. How do you do it? Return on capital employed is one of the investment appraisal techniques which takes profits into consideration, right? And not your cash flows. And whatever they've given is profits itself, so no worries. And what is the formula for return on capital employed? It is profit before interest and tax, that is average annual profit before interest and tax divided by average investment, correct? This is the formula. So can you guys tell me how much is the average annual profit before interest and tax for this question? They've given us that the investment is how much? Investment is $46,000. So by 2, that would be your average. What about your average annual profit before interest and tax? How much is that coming up to? Can I say it is 16,500 plus 23,500 plus 13,500 minus 1,500 divided by 4, right? Because we have to always take our average annual profit before interest and tax. So what I'll do is, this is just for your calculation. Can I say return on capital employed is equal to average annual profit before interest and tax, that is PBIT. I'll just write PBIT, divided by average investment, correct? So how much is your average annual PBIT? Can I say it is 16,500. 16,500 plus 23,500 plus 13,500. And remember, you have a loss in year 4. So minus 1,500. Right? 52,000. But you want the average. So divided by 4. This is your average annual profit before interest and tax. And what is your investment? Average investment. You're investing $46,000. But if you want the average, you'll do it by 2. So how much is the return on capital employed? Can I say my return on capital employed is equal to average annual profit divided by this? So have we missed out any adjustment? Yes, there is depreciation, right? In the question, how much would be the depreciation? Depreciation is charged on a straight line basis. So whenever they ask you to calculate the average investment, it is usually, let's see how much is the depreciation. Depreciation would come up to, it's a straight line basis, 11,500. So your numerator is 13,000 and what is your denominator? So generally we take initial investment plus scrap value by 2, right? That's the definition of average investment. Do you remember? Your average investment is generally initial investment plus scrap value divided by 2. Something that we've seen in the textbook also. How to calculate. Either your return on capital employed can be done in 2 ways. That is, you divide it by initial investment or using the average investment method where you take initial investment plus scrap value by 2. So your answer would be 46,000 plus the scrap value, which is 7,000 divided by 2. That is 26,500. So your 13,000 divided by 26,500. So how much is it? 49%. This is your return on capital employed. So that is your option C. Similarly, what are they asking? Next question they're asking, assuming operational cash flows arise evenly over the year, what is the payback period for this investment? So look how they're testing your concept over here. We all know that your return on capital employed, it takes profits into consideration, but your payback, it takes cash flows into consideration. So normally what will a student do? Then the student will take 46,000 and start solving. Okay, if I want to calculate the payback, you'll say, okay, 46,000, first year I'm getting 16,500 and you go on deducting. But we don't take profits into consideration in payback. You have to take cash flow. So the first step would be to convert these profits to cash flows. How will you convert these profits to cash flows? I'll give you 2 minutes to try this problem. You have 4 years and they've given the profits. But what do you need? You need cash flows. How do you arrive at profits actually? It is after your cash flows. Profits are basically cash flows minus depreciation. So if you want cash flows, what should you do? Depreciation is on a straight line basis. Your depreciation would be 9750, right? So you will have to first now calculate what is the profit. I mean, they've given you the profits. You will have to calculate what is the cash flow. So you have to go in a reverse manner. How will you go to the reverse manner? They have given you the profits, right? And profits are generally calculated like this. That is your cash flow minus depreciation. You'll get your profit. Correct. But now in this particular question, they've given you the profit. You need cash flows. Why? Because they're asking payback period, and payback considers cash flows. So what should you do? Can I say cash flow is equal to profit plus depreciation? You will have to add your depreciation to arrive at your cash flows. So here you have 1, 2, 3, 4. So if you want to know what are your cash flows, you have to add. So 16,500 is your profit, but you have to add 9,750, which is your depreciation. How did we get 9,750? Something that you've studied in 11th standard, original cost minus scrap value divided by life of the asset. So that's how you get it. Similarly, over here, second year, 23,500 is your profit, but cash flow would be plus 9,750. Here also 13,500 plus 9,750. Here you have negative 1,500 plus 9,750. So you've got your cash flows. Now can you all calculate the payback? I've told you, very easy method. You start with how much are you spending? 46,000. First year, how much you'll get? 26,250. Deduct 26,250. Second year, you'll get 33,250. But how much is remaining to recover? Only 19,750. So what will you do? 19,750 divided by how much are you getting second year? 33,250. So can I say it takes 1.59 years? And if I want to be very specific, because they're asking us in months, so 0.59 into 12. So I can say 1 year, 7 months. Everybody, how did we get this? 46,000 you're spending to buy this lorry. Okay. And if you buy this lorry, every year you're going to get a cash flow. First year you will get 26,250. So 46,000 May, first year only you will recover 26,250. Correct? How much is remaining to recover? Now your calci is showing you 19,750, which is remaining to recover. But in second year, you will get 33,250. No. So I am going to recover the cost of this machinery. What is the meaning of payback? How quickly you can recover the cost. So I know that within 2 years only. If I want to know exactly how much, what will I do? 19,750 divided by the next year's cash flow. That is 33,250. You will get 0.59. So I can say 1.59 years. But the problem is, have they given us 1.59 here? No, they've given us 1 year 7 months, 1 year 5 months. So normally students will think 1.59 means 1 year 5 months. But logically, is that right? No, 1 year is equal to 12 months. So 0.59 years is equal to how much? You have to do 0.59 into 12, you'll get 7. So 1 year 7 months is the right answer. So your correct answer would be 1 year 7 months. So that would be option A. Okay, apart from that, there is a theory question where they're asking which of the following are the benefit of return on capital employed method of investment appraisal. So they're asking which is the benefit of ROCE. So can I say it considers the whole life of the project? Yes, it does. Is it cash flow based? No. Return on capital employed is profit based. So no. Second one is wrong. It is a percentage which, being meaningful to non-financial professionals, helps to communicate the benefits of investment decisions. Yes, I can say that statement is also right. So can I say option 1 and 3 are the right answer? So the correct answer would be option B. Okay, option B is the right answer. So this was a question where, they tested your concept. So always remember your payback, NPV, IRR, they're all based on cash flows, but your return on capital employed is based on your profits. Okay. Apart from that, we have some more questions. Let me take up one or two questions from your practice. Okay, let's take up this sensitivity analysis question. So here they're asking, a company has calculated the NPV of the new project as follows. And they're asking, what is the sensitivity of the project decision to a change in sales volume? Always remember, whenever they ask you a question on sensitivity analysis, you have to calculate the sensitivity margin. How do you calculate the sensitivity margin? It is NPV divided by present value of cash flow under consideration. Okay, present value of cash flow under consideration means they can ask you the sensitivity of anything. They can ask you the sensitivity of sales, they can ask you the sensitivity of variable cost or of scrap value or initial investment. Similarly, here they've asked us what is the sensitivity of sales volume. Whenever they ask you the sensitivity of sales volume, remember that you should always take contribution. Now, what is contribution? Contribution is sales minus variable cost, something that you've studied in management accounting. Sales minus variable cost is your contribution. So they have already given us the present value. So we don't have the task to convert the cash flows into present value terms because they've given it to us. NPV is also given to us, right? That is 200 divided by how much is the present value of my contribution? 4,000 is my sales. Variable cost is 2,000. So can I say 4,000 minus 2,000? 2,000 is my present value of cash flow. So 200 divided by 2,000.1. So 10%, and you will choose option C. Wrong answer. Why? Because they have given us the tax rate in the question, and whenever they give tax rate in the question, you should always take your contribution, which you got it as 2,000 after tax. So after tax would be 2,000 minus 20%, which is 1,600. So here your answer should have been 1,600. So 200 divided by 1,600, which is 0.125, that is 12.5. This should be not 2.5, it is 12.5. So that's why your correct answer would be 12.5%. Had they not given this line, then yes, 10% would be the right answer. You would do 200 divided by your contribution margin, which is 2,000. But since they've given us the tax rate, whenever they give the tax rate, always calculate the after-tax cash flow. That is 200 divided by 1,600, which is 0.125, which is nothing but 12.5%. Okay. Any question related to... Okay, let's try this question. They're asking you what is the present value of cash flows relating to working capital. So if you see over here, they're saying that AW company needs to have 100,000 working capital in place for the start of a 2-year project. The amount will stay constant in real terms, and they've given the inflation, that is 10%. And they've given us the money cost of capital. Remember, I told you guys that your nominal rate of interest can also be called as money cost of capital or money rate of interest. So that's given to us. They're asking what is the present value of cash flows relating to working capital. They want to know what is the present value. So how much is the life of the project? Can I say here you have 0, 1, 2. And you all know how much is the working capital you require? $100,000 at the start of the 2-year project, year 0 itself. And they're saying inflation is running at 10% per annum. So it is going to increase, right? So how much will it be? 10% means 1.10. So I'll put it this way. Your working capital is $100,000, and then it is going to increase by how much? 10%. So you can either do 100,000 plus 10%, or you can do simply 100,000 into 1.1, right? And here you will not require any working capital. Why? Because the project life is ending. So can I say working capital needed will be first year minus $100,000. Then what is your incremental? We always take the incremental working capital. How much extra you need? This minus this, you require 10,000. And then finally, in year 2, will you require anything? No. So it is recovery. So these are your working capital needed, but they want to know what is the present value. They've already given us the discount factors at what percent? At 12%. So can I say year 0, it is 1. Here it will be 1 divided by 1.12. You can either take the figures from your table or you can solve it in Calc or in Excel. So at 12%, your discount factors for year 1 and year 2 is so much. So how much is the present value? Can I say this into this? Correct? Similarly, just drag it and you will get it. So if I want to know the net present value, what do? Sum of present value of cash inflow. You're getting somewhere around 21,237. So can I round it off to 21,260? It is because of the decimals that we're getting this difference, right? So the closest answer would be option A. So these were some of the challenging MCQs which is really testing your concepts. So that's the reason I took them up. There are some more for your practice. You can definitely try them. So yeah, that's about it. By this, we have done a complete revision of our investment decisions where we spoke about NPV, your discounted cash flow methods, payback, return on capital employed, replacement decisions, all of that. So I would want you guys to try out this problem. Just give me a second. As homework. Let me show you guys the question. Just give me a second. Okay. So this is a question which was tested yeah. So if you look at my screen, another question, again, it's available in your ACCA Global website. Please download this paper. Okay, this is your December 2021 paper where they asked you, it's a past exam paper. I would want you guys to try this question as homework. That is Hawker Company. Okay, here the question says that, it is, I'm just going to debrief the question. Now, what do you mean by debriefing the question? Debriefing the question is where I'm not solving the question, but I'm telling you guys where to pay attention to and trying out, you guys only have to do it. Okay, so in this question, if you see, Hawker Company is able to replace its existing delivery, right? And it estimates that the replacing the existing vehicle will save the running cost of 2,000 per year. Okay. They have two options. Either the vehicle could be purchased using 34,000 using bank loan. After tax cost of borrowing is 4% per year. And the residual value would be so much. Straight line tax allowable depreciation is there. And would also get a emission tax of 600 at the end of each year of operation. And these are also tax deductible. Okay. Then they're saying the vehicle could be leased. Okay. So there are two scenarios. Now this is basically a lease versus buy question, which came in the exam. Okay. Option 1 is if you're buying the asset. Option 2 is you can lease the asset for a period of 4 years and have to pay lease rent of 6,000 per year at the start of each year. So the lessor will pay the lessor. There are two parties, lessor and the lessee. Lessor is the owner of the asset. Lessee is the user of the asset. So lessor only will pay the emission tax, but these lease payments are tax deductible. They've given you the average after-tax weighted cost of capital as 8% and the tax rate is 20% 1 year in arrears. So these are the places where you have to pay attention to. Okay, where they've given you the what is it, the tax rates, and they've told you where you have to pay attention to and all of that. Now, the general mistake what students would do here is that whenever they're doing a lease problem, they will end up taking this 8% to convert their future cash flows to present value terms. And that would be wrong. Why? Because we know that in a lease versus buy question, irrespective of whatever is your nominal rate of interest or your weighted average cost of capital, you should always use your after tax cost of borrowing or after tax cost of debt. So even for your leasing calculations, you have to use 4% and not 8%. So purposely they've given in this question the 8% to confuse you. So don't get tricked this way. All right. So this is how I'm going to debrief the question. This is one place where you have to pay attention to in a lease versus buy question specifically. You should always take the after-tax cost of debt to convert your future cash flows to present value terms. Apart from that, in your NPV, if you're calculating the NPV of buying the asset, you know that initial investment is given to you. They've given you, they've told you specifically that you're going to get $600 at the end of the each year of operation. So, wherein you will have to pay, right? It is a tax. So, consider year 1, year 2, year 3, year 4, there is a negative 600, right? Then but then you will also get tax relief. That is out of, even though you're spending 600, how much is the tax relief that you're getting? Full 600? No, only 20% of that amount. So, 120 would be your cash inflow. So please consider that as an inflow. And your tax relief on tax allowable depreciation, I think the depreciation is given, you will have to calculate it. How much is it? They're saying straight line depreciation. So simple, 34,000 divided by how much is your life of the asset? Okay, residual value is there. So original cost minus scrap value divided by life will give you your depreciation. But remember, depreciation is an irrelevant cash flow. Only the tax relief that you get on your depreciation is a relevant cash flow. So same way, just calculate that and then also calculate the tax TAD, that is your tax allowable depreciation. That would be your relevant cash flow. Don't forget to take the residual value, that's in your year 4, and then calculate the NPV. Similarly, when it comes to your leasing, look at this line. They've told that it is payable at the start of each year. So that means at year 0 itself, you have to start paying lease rent of 6,000 and for 4 years. No, so it would be year 1, year 2, year 3, year 4. One more place where you have to pay attention over here. They've told that the tax is in arrears. So that means whatever you're supposed to get it in years 1, you'll get it in year 2. Year 2 ka year 3. Year 3 ka year 4. And year 4 is in year 5. So that you have to pay very close attention. Okay. And then your last step where you'll calculate what is the NPV of buying the asset and what is your NPV of leasing the asset. When I say NPV, it is basically what is the present value of cost of buying the asset and what is the present value of cost of leasing the asset. You'll get the answer wherever you get the least, that option Hawker company should go ahead with. So I have completely told you guys where to pay attention to, and I want you guys only to try out this problem by yourself in an Excel sheet. And by this, we are done with investment decisions, and we've covered almost 6 chapters over here, and we've touched all the important areas in investment decisions. So I will see you guys in the next class with a new concept, which is very important in FM exam point of view. So yeah, I'll see you guys in the next class. Bye bye. Till then, please keep revising and keep solving more and more past exam papers and your exam kit problems. See you. Hi everyone, welcome back to ACCA Rapid Revision session. In the previous class, we had a detailed discussion about investment decisions, right? So today we're going to touch one more important area, that is financing decisions. Now, when I talk about financing decisions, today's discussion is going to be on the topic cost of capital, capital structure. So we are going to first understand the important concepts in these chapters, because in your section C, such questions from cost of capital, your capital structure have been tested in the past. So first, let's understand the basic concept, and then we will be taking up some past exam papers on this topic. All right, guys. So you all know that the three most important decisions to be taken by a finance manager is investment decisions, dividend decisions, and financing decisions. But I've also told you guys that apart from this, there are other two decisions, that is working capital decisions and risk management decisions. But we've already discussed about investment decisions in detail. Now let's talk about financing decisions. Now when I talk about financing decisions, one of the very important topic and most likely to be asked in the exam is your weighted average cost of capital, right? Now the concept of weighted average cost of capital has been tested often in the exam. It can either come in section A or section B, or it can come for a 6 or 7 marks in your section C problem also, right? So today we are going to talk about the concept of cost of capital. Now when I talk about cost of capital, which is your chapter 17, right? Everybody understands that in order to start a business, right, we need capital, correct? We need capital to start the business. Now, how am I going to raise the capital? That is the next question. I can either raise capital through, let's say I want to start my own business and I need capital, right? I need money. How can I raise funds? I have various sources, correct? I can raise funds from various sources. That is, I can raise funds from equity. I can raise funds from debt. Even in debt, you know, there are two types. There are redeemable debt and irredeemable debt, correct? I can also raise funds through preference shares, correct? So, or I can take a bank loan. So, these are the various ways I can raise funds, or I can raise capital to start my own business, right? But do you think that all those are giving me now, equity investor or a debt investor, preference shareholders or the bank, all those who are giving me the funds, will they give it to me for free? Of course not, right? Nobody gives anything for free. So, it comes with the cost, right? The one who is giving us the funds, it comes with the cost, and that is known as cost of capital, right? Now, why are they lending you their hard-earned money? Because they want something in return, correct? So, please understand that for one person, it is a cost, and for the other person, it is a return. So, for the investor, it is return, but for the company, it is a cost. So this is the basic understanding that you need to make it very clear, right? Now, when we are talking about weighted average cost of capital, okay, when I talk about the concept of weighted average cost of capital, what's happening over here? Your weighted average cost of capital is a situation. Now, obviously, when you raise funds, you will not raise funds from only one source, right? You will raise funds from various sources, right? So that's why in weighted average cost of capital, we are checking. Suppose I have raised $100,000. Okay, I have raised $100,000, and let's say 60% I have taken equity and 40% through debt, right? So now what is this? What is the weight? Out of this $100,000, 60%, that is $60,000 from equity, $40,000 through debt. So this is my weight. Now all those have given me the funds, right? The investor, will they give it to me for free? No. Let's say cost of equity, which we generally call it as KE. They will want something in return. So for investor it is written, but for the company, usually company calculates the weighted average cost of capital. For them it is cost. So let's say it comes around 12% is the cost of equity and cost of debt is 8%. Now, can I say my total weighted average cost of capital is 12 plus 8, 20%? Will that make sense? Of course not. Why? Because the proportion, the weight of each source of finance is different, right? So how do we calculate weighted average cost of capital? We check out of the total capital, how much? 60%. So 0.6% into 12%, right? Or you can do 0.12, anything. So 0.6 into 0.12. This is your equity. Plus, you have also raised funds through debt. And what is the cost of debt? 8%, right? So it would be 0.4 into 8% is 0.08. So this is your debt. Now, total, how much is it? 0.6 into 0.12, 0.4 into 0.08. So can I say a total of 10.4%? You'll get 0.104, which is nothing but 10.4%. So I cannot say 12 plus 8, 20% is my weighted average cost of capital. That would be incorrect because I have not taken weights into consideration, right? So 10.4% is my weighted average cost of capital. That is, if I want to start my business and if I want $100,000 and if this is the weight and this is the cost, my total cost to raise this $100,000 is 10.4%. Now, in this particular situation, there were only two sources of finance, right? There was only debt and equity. But that's not the case in real life. In real life, people will raise funds through various sources. As we said, it could be equity, debt, preference shares, bank loan. Even in debt, you have redeemable debt, irredeemable debt, all of that, right? So that's why before we do past exam papers on this particular topic or we take up problems on financing decisions, I want to make it very clear how to calculate the each cost of capital. Now, for example, in the example that we took, the cost of equity and cost of debt was already given to us. But what if this figure is not given to us? Then we will only have to calculate how much is the cost of equity, how much is the cost of debt, how much is the cost of preference shares, bank loan, right? So let's just have a quick revision on the calculation of cost of capital. So let me put it this way. Everybody knows we are talking about cost of capital to have equity, debt, preference shares, right? I'll take so many. Even in debt, you have redeemable debt and irredeemable debt. Now you all have come to a conclusion that nobody gives anything for free, right? All those who are giving us this fund, it comes with the cost. So let's first identify how to calculate cost of equity. Okay, so I'll start with cost of equity. You all know what is the meaning of equity, right? Where you sell a part of your ownership to the company, to the investor. And now that you all have been watching Shark Tank, you all know what is the meaning of equity, right? They say we want 30 lakhs for 4% equity, 1 crore for 5% equity. So that's basically the ownership in the company, correct? So that's your cost of equity. Now, when I talk about cost of equity, we need to identify, right, how to calculate this cost of equity. So for that, we have Gordon's formula, or commonly called as the growth formula. So here what happens? We are calculating KE. Okay, what is KE? Your cost of equity. Now, if I want to raise funds, if I want to raise equity, it comes with a cost. I want to know how much is that cost. So that would be D0 into 1 plus G divided by P0, the whole thing plus G. This is the formula. Okay. And this is calculating the cost of equity. Now, what is D0? You all know. It is the dividend, the current dividend. What is P0? Always remember, it is your X the dividend market price of the share. What do you mean by X dividend market price of the share? It is excluding dividend. Okay. Purposely in the question, they'll give you cum dividend. And if you have to calculate cost of equity, you should always take X dividend market price of the share. What is G? G is your growth rate. Okay. So these are the things that have been given to you. So you know that how to calculate cost of equity. You just have to apply the formula. Sometimes what happens? The growth will not be given in the question. When growth is not given in the question, you can calculate growth two ways. Again, one is your past dividend growth formula. And the second one is your retention formula, or again, this is Gordon's formula itself. So how do you calculate your past dividend growth formula? Suppose the dividend is not given in the question. Current dividend divided by dividend n years ago, the whole to the power 1 by n minus 1. You're basically going to apply this formula to calculate how much is the growth rate. Or suppose you have another way to calculate the growth. So what happened? Gordon, this retention formula is also of Gordon itself. What did Gordon say? This is your dividend valuation model, okay, famously called. So what Gordon told is that based on the past dividends, we cannot predict the future growth. Instead, the growth is defined by how much the company retains and again reinvest. So he came up with another formula where he said growth is equal to B into RE. What is B? B is the retention rate. What do you mean by retention rate? For example, if the company has earned $100 and out of that $20 they plan to give as dividends and $80 they plan to keep it with themselves. So can I say this is retained? Now, do we take 80? No, this is the retention rate. So it is not $80, it is 80 divided by 100, that is 0.8, that is 80%. Retention rate it is. So this is something that you have to keep in mind, that you should always take the rate and not the dollar figure. You shouldn't take 80 over here, you should take 0.8. Into RE. What is RE? RE is basically the accounting rate of return, or your return on capital employed, or your return on equity. So what did Gordon believe? That the growth of the company depends on how much you retain and how much you invest and how much return you get, right? So it could be your return on equity, or accounting rate of return, return on capital employed. Let's say it is 10%. So in that case, you would do 0.8 into 10% to understand how much is the growth rate. So these are the two ways to calculate the cost of equity. Now, can I also conclude by our discussion that for the company, it is cost. We call it as cost of equity. Can I say this is equal to, in investors' point of view, equity shareholders' required rate of return? Can I say it is equal? Everyone, you will agree to this, right? Because it's just the point of view that is changing over here. When I say cost of equity, I'm talking in the company's point of view. When I'm talking equity shareholders required rate of return, I'm talking in the investor's point of view. So they can either call it as KE or RE. These are the two ways of, this is the interpretation which is very important. Apart from that, sometimes this is one way to calculate cost of equity. Another way to calculate cost of equity is through your CAPM. Now, everybody at this point in time, since it's revision, you all know what is the meaning of CAPM. It is your capital asset pricing model. What happens in capital asset pricing model? Now, why do we use this? Now, the reason why we use CAPM is because in your dividend valuation model, if you observe your dividend valuation model, does it take risk into consideration? No. Nowhere the risk has been addressed over here. They're just talking about the growth of the dividends and growth of the share price and all of that, right? They have not taken risk into consideration. And that's why in your CAPM model, CAPM, capital asset pricing model, they take risk into consideration. Okay, so that's why the formula is RF plus beta into RM minus RF. So what is this? This is also KE. You can use this to calculate the cost of equity. CAPM is an investor point of view. And when do we use CAPM? Suppose you are in one business area, okay, and you calculate its weighted average cost of capital comes up to 10%. Let's say you're in food industry. Now you want to shift to automobile industry. All of you agree that food industry is very different, automobile industry is very different. So can I use the same 10% for automobile industry? No, it does not make sense, right? Because food industry, the business risk, the financial risk, everything is different from automobile industry. So I'll have to calculate a new weighted average cost of capital, which takes risk into consideration. So that's why, what do? We do it this way. That is, we calculate CAPM whenever we want to take risk into consideration. So what is RF? RF is the risk-free rate of return. So what is your risk-free rate of return? Usually you get it on your treasury bills, government gilts, anything that is related to government. That is risk-free. What is beta? Beta is the systematic risk. I hope everybody knows what is the meaning of systematic risk. There are two types of risk, systematic risk and unsystematic risk. Systematic risk is a risk that can be diversified. What do you mean by it can be diversified? When I say it can be diversified, it simply means that, systematic risk is a risk that cannot be diversified. Right? And on the other hand, unsystematic risk is a risk that can be diversified. So when I say systematic risk, it is a risk that is going to affect everyone. Right? Remember the COVID times, the coronavirus, all the industries are affected, right? So that is your systematic. You cannot say, okay, I will not invest in automobile industry, I'll invest somewhere else. No, even that industry is affected. So you cannot diversify. On the other hand, unsystematic risk is a risk which is very specific. For example, if there is any strike done by the workers of a tire manufacturing company, will it affect food industry? No, it is a very specific risk. So you know that there is something wrong in the tire industry. So don't invest your money there, invest somewhere else. So what have you done? You have diversified it. So systematic risk cannot be diversified. Unsystematic risk can be diversified. Okay, so here beta represents the systematic risk. RM is the return that you're going to get from the market, and RF is your risk-free rate. Now, what do we understand by this formula? This formula simply tells us that RF, it talks about the guaranteed return, right? Why do everybody invest in FD or government securities? Why? Because you know there is very low risk or no risk, and it is guaranteed that you'll get, right? So this is guaranteed return. But as an investor, you would also want some additional return, correct? So this represents the additional return, that is over and above your risk-free rate. You will invest in industries, right? Risky stocks. So that is your market return. So how much extra? That is why we are doing RM minus RF. How much extra you're getting over and above the risk-free rate. So this represents your additional return. But this additional return is subject to systematic risk. So that's why we multiply it into beta. We all know beta interpretation. If beta is equal to 0, it is risk-free. Correct? If beta is equal to greater than 1, if beta is greater than 1, that is if beta is 1.5 or 2 that means the securities or the investment that we are into is way more riskier than the average investments out there. And if I say beta is less than 1, like if it is 0.5 or 0.2, it means that the securities that I am having is less risky than the average in the market. Okay, and if beta is equal to 1, then it is the same level. The level of systematic risk is the same what I have in my portfolio and the average in the market. So this is another way to calculate your cost of equity, right? And or in other words, investors, equity shareholders required rate of return. Okay, so that was about equity. We also know that we can calculate debt, right? Debt is of two types. Now, what is the difference between redeemable debt and irredeemable debt? The basic difference between redeemable debt and irredeemable debt is redeemable debt is a debt where we make principal plus the interest payment. Whereas in irredeemable debt, we only make interest payment for a foreseeable future. What do you mean by foreseeable future? For a really long time. Okay, and there is no concept of principal payment in case of irredeemable debt. So the calculation of cost of redeemable debt and cost of irredeemable debt is also different because the nature of the debt is different. Then talking about preference shares, let's do cost of preference shares now. I just want to quickly give you a recap as to how we used to calculate this and the things you have to take care over here. When I talk about cost of preference shares, okay, I'll call it as KP. It is dividend divided by P0. What is the formula? What does this mean? This simply means that D0 is your dividend. P0 is your X dividend market price of the share. And always remember the dividend is calculated on the nominal value. What does this mean? Suppose they'll tell you that in a question, they'll tell you that the nominal value, okay, the nominal value is 0.85 and the market price is 1.5 and it is 6% preference shares. They'll give you like this. So this 6%, you should not calculate it on the market price of the share. Why? Because market price keeps on fluctuating. You should always calculate it on the nominal value. All right. So that is what they're trying to say, that whenever you're calculating the numerator, the dividend is not 6%. It is 6% should be on the nominal value. So it would be 0.85 into 6% divided by what is the market price of the share? 1.5. Whatever answer you get, that would be the cost of the preference share. So remember this point, that it is always calculated on the nominal value. Okay. Moving on, when I talk about cost of debt, I told you guys that there are two types of debt, right? There is a redeemable debt and irredeemable debt. Now, when I talk about irredeemable debt, when I talk about irredeemable debt, it is very simple. Why? Because it is interest divided by market value. Now, one more thing, in preference shares also, can I conclude what I concluded over here? Can I say that the cost of preference shares, for whom is it the cost? It is for the company, right? Cost of preference shares is equal to preference shareholders' required rate of return. Can I say this? Of course, right? We can say that cost of preference shares is equal to preference shareholders' required rate of return. Yes. Why? Because this is in company's point of view. This is in investor's point of view, right? Similarly, can I say that cost of debt is equal to debt holders' required rate of return? One is in company's point of view, one is in investor's point of view. Can I say this? No, I cannot say this. This is something that you have to understand, that when it comes to cost of equity, we can say that cost of equity is equal to equity shareholders required rate of return. When it comes to preference shares, I can say that cost of preference shares is equal to preference shareholders required rate of return. But when I talk about debt, I cannot say that cost of debt is equal to debt holders required rate of return. Why? Because the company gets tax relief on interest payments. What do you mean by tax relief on interest payment? For example, if they tell you it is 5% debt, what is this 5%? This is your coupon rate. What do you mean by coupon rate or the stated rate? It is the rate of interest that you're getting. And as we discussed in preference share, the dividends are paid on the nominal value. Similarly, the coupon rate, the interest is also always paid on nominal value. And for your information, always assume, if in the question it's not given, that the value, the nominal value of the bond is assumed to be $100. Okay, the nominal value of the bond is assumed to be $100. Okay. So 5% debt, you have the coupon rate, then this is the interest on nominal value, which you will have to calculate. Now, what do you mean by KD is equal to interest divided by market value? Interest, this is always calculated on the nominal value, divided by, now whatever this is in investor's point of view. Why? Because the investor is getting full interest. Now, if I say 5%, let's say the tax rate is 30%. Okay, so $100 is your nominal value. Coupon rate is 5%. So how much is the interest? Interest is $5. So the investor is getting full $5, but the company is not paying $5. Company is getting tax relief. The government says out of 5, 30% you don't have to pay. So can I say $5 minus 30%? So how much is that? 5 minus 30%. That is only $3.5 the company is paying. Got it? How did we get it? You can either do interest into 1 minus the tax rate. Interest into 1 minus, how much is the tax rate? 0.3. Correct? That is 5 into 0.7, which is $3.5. So this is the amount that the company is paying. So is it same? So can I put it this way, that the cost of, this is in the investor's point of view. For company, we put it KD into 1 minus tax rate is equal to interest into 1 minus tax rate divided by market value. That is the difference. Okay, so that's the reason we say that these two things are not the same. That is, cost of debt is not equal to debt holders required rate of return. Correct? Because you can only calculate and check. It's going to be different. Let's do it quickly. Random figures I'll take. So what is this? This is in company's point of view, the formula. And this is in investor's point of view. Right? So how much is it going to be? Can I say here in this scenario, it's going to be, your interest would be how much? $100 is the nominal value into 5%. $5, correct? Let's say the market value of the loan note is 105. So interest I is $5 divided by 105. So how much is the cost of into 100? So can I say 4.76%? This is what the investor is getting. What about the company? Company is paying 5 into 1 minus the tax rate divided by 105. So can I say it is 3.5 divided by 105? So that is around 3.33%. So do you see the difference? The company's cost is just 3.33%, whereas for investor is getting 4.76%. And that's the reason we say that cost of debt is not equal to debt holders required rate of return. But in case of equity and preference shares, they were equal. It's just the point of view here. Because the company gets tax relief on interest payments, that's why they are not equal. Now, you can also say that, let's now talk about redeemable debt, and the same thing applies over here as well. Here we know that we have to follow that this famous line that you've come across, market value of an investment is equal to present value of its future cash flows discounted at investors' required rate of return. Okay, everywhere if you observe, we've been doing this only. When I calculated dividend valuation model also, we can interchange this formula to know what is the price of the share. The same formula you can interchange and you can calculate what is P0. Correct? Using the same formula, we can also do it this way. Let me show it to you guys because this is also very important. Just like we can use KE to calculate D0 into 1 plus G divided by P0, the whole thing plus G. This we were using dividend valuation model to calculate cost of equity. Right? Same way, we can use dividend valuation model to calculate the market price of the share, that is P0. How? You know, KE, this plus G will go this side, minus G is equal to D0 into 1 plus G divided by P0. I want to know how much is P0. So P0 will go this side. So P0 is equal to D0 into 1 plus G divided by this will come down, KE minus G. So I have used the same formula, right? Here I am using cost of equity. Here I am using it for market price of the share. Got it? So the same formula can be used to calculate the cost of equity or the market price of the share. So market price of the share is the market value of any investment. How do we calculate? It is present value of future cash flows discounted at investors' required rate of return. This is an assumption in FM. So similarly, for redeemable debt, what are your future cash flows? For a redeemable debt, your future cash flows are your interest plus the principal amount. Correct? But these are your future cash flows. You have to discount them. Everybody knows what is compounding and discounting. Compounding is where you calculate the future value. This is compounding. Here, you're calculating the present value. So this is discounting. Right? This is compounding. This is compounding. That is calculation of future value. Here it is discounting. So here we're calculating the present value of our future cash flow. So you know how to do it. It is year 0, you make an investment, then whatever is the life of the debt, you have your cash flow, you have to discount it. You can use annuity factor because the cash flows are even in nature, that is the interest amount, and that's how you calculate the market value. Right? I hope you guys remember, year 0, you make the investment, then let's say the life of the debt is 5 years. Year 1 to 5, this is the market value, this is the interest. And then finally at year 5, you make the principal payment. That is usually they'll tell you in the question. Generally, it's going to be repaid at nominal value. Sometimes it could be paid at a premium or paid at a, it could be paid at a premium or at nominal value. So if it is paid at a premium, then 105% premium means it would be 105. Correct? So these are your cash flows. You have to discount them using annuity factor or discount factor at whatever is the required rate of return so that you get your present value. When you solve this, you're going to get what is the market value because this and this will be given to you in the question. You have to convert. When do you use annuity factor? When the cash flows are even in nature. That is for your interest expense, you will use annuity factor. But for principal, you will use discount factor because it's only for that year. And that's how you'll calculate the present value. And when you add these two, you will get how much is the market value. So they can ask you to calculate the market value, or if they're asking you to calculate the cost of debt, then we will have to use IRR. How do you calculate cost of redeemable debt? By using IRR. That is your internal rate of return. And you all know what is the formula for internal rate of return? Something that we've studied in investment decisions. Right? IRR is equal to L plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. The whole thing into H minus L. This is the formula for IRR. Why do we usually use IRR to calculate the cost of redeemable debt? What do? We take at 5%, we need one positive NPV, and then we take 10% or 20% so that we get a negative NPV. And then we put those figures in the formula to calculate the IRR. And this IRR itself is the cost of redeemable debt. Just be careful that if you are calculating your weighted average cost of capital and the company has raised funds through redeemable debt, then remember to deduct tax. Okay, because weighted average cost of capital is in the company's point of view, and company always gets tax relief on interest payment. So don't forget to deduct that. All right, so that's about your cost of redeemable debt, where we calculate using IRR. We take one discount rate, calculate the positive NPV, then we take another higher discount rate so that we get a negative NPV. Once we get a positive NPV and a negative NPV, we put it in the formula to calculate your redeemable debt. All right. So now we all know that how to individually calculate, right? How can we individually calculate our cost of equity, cost of debt, cost of preference shares, all of that, right? And now let's understand how to calculate weighted average cost of capital. I've already discussed about that here, right? Where we saw you should always take the weight and multiply the weight with their respective cost. Now you also know how to calculate this cost if it's not given in the question. So if at all you get a question from section C on weighted average cost of capital, I would recommend you all to stick to a format where you first write what are the sources of finance. Okay, that should be your first step. How has the company raised finance? It might have raised through equity, it might have raised through preference shares, then through redeemable debt, right? Then there could be bank loan. So first you write down the list of the sources of finance. Once you have listed down this, the next you calculate their weights. No, sorry, you calculate their market values. Usually they will ask you to calculate using market values itself. So next you calculate the market values of each source of finance. I hope you know how to calculate. That is number of shares into market price of the share, number of loan notes into market value of the. So you will get the market value. You total this. Then what is the next step? You check the weight. That is out of the total capital. How much is equity? How much is preference shares? How much is redeemable debt? So in this way, you will get the weights. And then you multiply the weights with their respective cost of capital. And that's how you will get your weighted average cost of capital. So you know that suppose $100 is your total market value. Equity might be 20, preference shares 20, redeemable debt 30. So how much? 30, 40, 50, 60, 70 and bank loan 30. So this is your total value. Okay, I'm taking simple numbers to make you guys understand the concept. So this much money you have raised. But out of this, how much is equity? 20%. Preference shares is 20%. Debt is 30%. Bank loan is 30%. Now, all those I've given you, the investors, will they give it to you for free? No. Let's say cost of equity being the most expensive one is 15%. Preference shares is 12%. Bank redeemable debt is 10%. And bank loan is 9%. So, this is the cost of each source of finance. Then what is the next step? You have to multiply 3 into 4. That is your respective weights into the cost. You'll get one answer. Here. And then the total is going to be your weighted average cost of capital. That's going to be your answer. So, especially when you're doing a section C problem, please present it in this way so that it is very easy for the examiner to give you the marks. Okay. So now moving on, this is the base of your chapter 17 where you need to know how to calculate the cost and equity. Let's just do a quick revision of your chapter 18, that is capital structure. So here we are going to discuss about, you need to know about the gearing. You have two types of gearing, financial gearing and operating gearing. Financial gearing talks about how much debt is there in the capital structure, whereas operating gearing talks about how much fixed cost is there in the capital structure. So you need to be aware of both things, that is how to calculate your operating gearing and how to calculate your financial gearing, right? Just remember that financial gearing talks about how much debt is used, and operating gearing talks about how much of your cost is fixed cost. So the formula is fixed cost divided by total cost, or fixed cost divided by variable cost. If you are looking at the impact on the profit or loss, then this is another formula. So it's always better to remember these formulas because you never know how the question facts will come like, right? So you need to know all the formulas so that you are in a position to answer. So this is about your gearing, financial gearing, operating gearing, interest gearing. That is, do you have enough interest? You're checking your capacity to cover the cost of debt if it falls due. Then apart from that, here you need to know the Modigliani and Miller approach, traditional view approach. We all know that, right? Every company will try to minimize its weighted average cost of capital as much as possible. Why? Because lower the weighted average cost of capital, higher is the market value of the firm. So please do give it a read. That is the traditional view. Then Modigliani and Miller with the tax, without tax, and pecking order theory. So these are the various theories which can probably come for section A or B, or it can come in C also, where they're asking you to talk about how we can minimize the weighted average cost of capital and what are the various theories. Okay, so please do give it a read. You remember, right? First M&M came up with a theory without tax. Then they came up with a theory with tax, which said your weighted average cost of capital is downward sloping. What does traditional view tell you? In traditional view, you observe that the weighted average cost of capital is U-shaped, right? They said that it equally offsets. That was your traditional view. Then in traditional view, they said that there is an optimum gearing. Okay, anything beyond this point, you see weighted average cost of capital is increasing. Anything beyond this point also, the weighted average cost. Only at this point. So there is an optimum level of gearing at which your weighted average cost of capital is minimum. Anything above or below that is just going to increase. So that was your traditional view. Then there was Modigliani and Miller who said that it does not matter. Okay, whether you have debt or equity, your weighted average cost of capital is going to be a straight line. So look, so there it was U-shaped. Here it is a straight line, right? So they can ask you MCQs where they are testing with this concept. So here, what did M&M theory tell? That it will remain constant at all levels of gearing. Why? Because they exactly offset by increasing in the cost. What do you mean by exactly offsetting? Now you know that if there is debt. If we take debt, what will happen? The cost of debt is cheaper than cost of equity. All of you know that equity is the most expensive source of finance. Why is it most expensive source of finance? Because equity shareholders have a lot of expectations, right? So that's why automatically equity is an expensive source of finance, because they sacrifice dividends. Even at the time of liquidation, they are given the last preference. So when one sacrifices so much, automatically expectations will increase. So cost of equity is always greater than cost of debt, correct? So here what they're trying to say is they directly or they exactly offset. That is, if a company has too much debt, two things will happen. One, that because of debt we'll get tax relief, so this will come down. But at the same time, since the company has taken too much debt, the equity shareholders might not be very happy with this and they would expect a higher return. So even this will increase. So they're saying this decrease and increase will exactly offset each other, and that is why the weighted average cost of capital is a straight line. Okay, and then they only after 5 years they came up with another theory, Modigliani and Miller itself, saying that with the tax, they're saying that with the tax it is always better to have debt in the capital structure. They're saying that you should have maximum debt because debt attracts tax relief, and that is why debt is a cheaper source of finance. And because debt is a cheaper source of finance, you know that KD, which is your cost of debt, it is nothing but a part of weighted average cost of capital. If this reduces, even your weighted average cost of capital will reduce, and thereby it is downward sloping. So did you observe that in traditional view it was U-shaped? In Modigliani and Miller without tax it was a straight line, because they said it does not matter. And in Modigliani and Miller with tax, your weighted average cost of capital is downward sloping. So I would recommend you all to give it a read, because they can ask you a question on this. Apart from that, we also know when to use CAPM in the project appraisal. We have discussed this, that whenever a company is shifting to a new business area, then that's when we use CAPM. You know what we have to do, right? The 3 steps, we've discussed it in our normal class. That is, step 1 is de-gearing, then re-gearing, and then calculating the answer. What do you mean by de-gearing, re-gearing? Suppose I am in food industry. Now I want to enter into cosmetic industry. 2 different industries. So first, what will I do? First, I would want to know what is the business risk. Correct? When I'm entering into a new business area, the first step would be for me to know what is the business risk. Right? So that is step 1. What is step 1? De-gearing. What happens in de-gearing? You are identifying the business risk. Will you invest your money blindly? No. Let's say from food industry, you're entering into cosmetic industry. You have no idea about cosmetic industry. So what do? You first understand what is business, what is the risk. So business risk. So you use this formula, the asset beta formula. But remember that we don't have in FM, debt beta is assumed to be 0. So your formula is only this much. Okay, so using the asset beta formula, we will first calculate what is the business risk. Okay, so always remember, asset beta is representing the business risk, and equity beta is representing both your business risk and your financial risk. Now, we will take up a past exam paper to understand this concept in detail. Now that you're entering into cosmetic industry, you don't know what is a business risk, right? So that's why you're calculating it. And for reference, you need a proxy company. So now if I'm starting a new cosmetic industry, I need some reference, right? So I can take Lakme or Sugar Cosmetics or whatever as a proxy company, okay, as a base. And then I will put those figures to identify what is a business risk. Once I've identified the business risk, what is the second step? The second step is re-gearing. What do you mean by re-gearing? Now you're ready to invest. Okay, now you're calculating, you're putting your money. You'll put your debt equity ratio in this to calculate how much is the equity beta. Okay, using the same formula. You'll be using this formula itself, but this time you're calculating equity beta. Once you find out the equity beta, once you find out that what is a business risk and what is a financial risk. Now you want to know how much is the return you're getting. So for that, you will use CAPM. That is RF plus beta into RM minus RF. And this beta will be what you calculated from step 2. Anyways, we'll do this problem so that we'll take up a problem from the past exam paper. So we are thorough with this concept. And yeah, that brings us to the discussion of what are the important concepts in financing decisions, right? And in business valuations, you know that, they might ask you to value a business based on your discounted cash flow method or asset-based value method or price earning ratio method. So just go through it. All right, guys, let's just take a quick break. And after the break, let's do a past exam paper on the discussion that we had so far. All right, let's now continue. Let's do some questions on the topic that we discussed. So let me share the screen. Okay, so this is a past exam paper, okay, which came in March, June 2021. So let's take up this problem. So the question is, this is exactly how your main exam, ACCA FM exam question will look like, where they'll give you a scenario. This is a section C question. Okay, they'll give you a scenario like this and they'll give you space to answer that question. All right. If it's a practical question, you'll be given an Excel sheet. If it's a problem, you'll be given a word to write your answer. Okay. So let's give it a quick read. So they're saying that ZMO company is a listed company in the house construction industry. Over the past 5 years, the results have been disappointing. And as a result, the share price has fallen from a high of $3.5 per share 5 years ago to only $1.05 per share today. The deterioration in the performance and share price has accompanied by an increase in financial gearing to a high level. That is, if you take too much debt, we say that there is high financial gearing. They've given you the balance sheet, right? And what have they told? ZMO company's loan notes are quoted at $65 per loan note, and both the loan notes and the bank loan are secured. ZMO company's equity beta is 2.3. Okay, this is the scenario now. They've given us enough information. Then they're telling us new venture. To improve performance, ZMO company is considering the construction of commercial properties. What were they into? They were into house construction, right? And now they're planning to move to commercial, which is totally different. Constructing a house is very different from constructing a commercial property, such as office blocks and industrial complexes like malls. So this is a new activity for ZMO company, and it's expected that the risk will be different from its current activity. We know that when we are moving into a different industry, we cannot use the same weighted average cost of capital. The finance director has proposed that a project-specific discount rate, which is nothing but your CAPM, should be used to appraise the new venture. But the commercial director does not believe this. So finance director is saying that we have to use a new, but the commercial director is saying not required. Now, Winston Commercial Property undertakes commercial construction projects. Now, what is this? Winston. Now, what is ZMO is the company which we are talking about. Now, they're talking about another company. That is Winston Commercial Properties, WCP, undertakes commercial construction projects similar to those being considered by ZMO. So, what is this? This is your proxy company. Remember in our example, if I want to start my cosmetic industry, I need some base, right? So, I'll take Sugar Cosmetics. So, similarly, this company, ZMO, is entering into a new business area. So, for reference purpose, which is the proxy company, WCP. And they've given how much is the equity beta. And they've given how much is the equity shares, 100 million of ordinary shares at 2.6, right? And they've also given, it also has 110 millions of loan notes in issue at 96. Both companies pay tax at 20%. RF is given, RM is given. All right, what are they asking us? For 6 marks, they're asking you, using the capital asset pricing model, calculate the ZMO company's current cost of equity and the project specific cost of equity suitable for the new venture. So they want you to calculate what is the current cost of equity and what is the project specific cost of equity. That is being asked for 6 marks. So shall we go to the Excel sheet and do this problem? Again, this is a past exam paper. So let's write down what is the requirement. Calculation of current cost of equity. And then we will also have to calculate the project specific cost of equity. Current cost of equity is simple. Using dividend valuation model, you can calculate. Have they given you enough information to calculate? Just give it a check. Do we have enough information to calculate the current cost of equity? Check. I'll give you all 2 minutes to try this. Okay. So current cost of equity, I'm again using the CAPM formula. You know what is? They have clearly told using CAPM. Calculate current cost of equity. So you know what is the formula? It is cost of equity is equal to RF plus beta into RM minus RF. Correct? This is the formula. So how will you calculate? How much is your RF in the question? Of the current company you check. So can I say currently the company has how much? What is the RF? They've given equity beta is 2.3. Check how much is RF. The risk-free rate is 4%. It was given to us in the question, no? 4 and RM is 10%. RF is 4% and RM is 10%. So pretty simple. 4%. RM is equal to 10%. Beta is equal to 2.3. So what is the answer? 4 plus beta is 2.3 into 10 minus 4. 17.8%. What is this? This is your current cost of equity. Now, if the company that is right now of ZMOR company's housing cost of equity is 17.8. Now, if the company is entering into commercial, then I will have to calculate a new cost of equity which takes risk into consideration. So what do? We do these 3 steps now, right? So how do we start? First, we have to calculate is the question, yeah. So it's entering into a new business area. So I need proxy company's details. Project specific cost of equity suitable for the new venture. So let's put the heading itself like that. Calculation of project specific cost of equity. So step 1. What is step 1? Step 1 is de-gearing, right? So first step is de-gearing. How will you do it? What is the formula? Asset beta is equal to value of equity divided by value of equity plus value of debt into 1 minus tax. This most of the students forget. The whole thing into equity beta. This is the first step. So how do we do this? How do we do this? First of all, how much is the value of equity? Now, whenever I'm doing de-gearing, Okay, we do it this way. I will solve it in the book over here so that you all can understand clearly. So Z more. Step 1, de-gearing. What is the formula for asset beta? Value of equity divided by value of equity plus value of debt into 1 minus tax rate, the whole thing into equity beta, right? So how much is the value of equity? Can you recognize? Now I will have to take of the proxy company because I want to identify the business risk. So how much is the value of the proxy company? 100 million shares and the share price is 2.6. So 260, 100 million into 2.6. So 260. Right? And this is the value of equity. How much is the value of debt? Check. You had 110 million. Okay, be very careful. $100 million. This was given in dollars of $1. So that means 100 million shares. So similarly, 110 million is a nominal value, right? Divided by 100. So 1.1 million loan notes you have. Okay, this is the total value. So I want to know how much is the number of bonds or number of loan notes. That would be 110 million divided by 100. So you have 1.1 million into 96. So 105.6. So I'm doing 110 divided by 100 into 9.6. 96, sorry. So we get 105.6 million. Correct? This is the value of debt. So always remember, you should always take it after tax. So can I say, how much is your value of equity? 260 divided by 260 plus 105.6 into how much is the tax rate? 20%. Right? 1 minus 0.2. The whole thing into how much is the equity beta of the proxy company. Why? Because you are using Winston Commercial Properties to identify asset beta. Asset beta is nothing but the business risk. Before investing, you first want to know, right, what is the business risk? So that's why. Have they given us? Yes, the equity beta is 1.25. Okay, into 1.25. So I want you all to solve this. I'll give you all 2 minutes. Okay. So you get around 0.94. 0.943 something. So I will round it off to 0.94. What is this? This is nothing but your business risk. Okay. Or in other words, it's your asset beta. If you all are wondering how we got it, you know, value of equity is equal to 100 into 2.6. This is the value of equity. Value of debt is equal to, you wanted to know how much is the number of loan notes into what is the value of one loan note? 96. So 105.6. Tax rate is given. So the formula would be value of equity is 260 divided by 260 plus 105.6 into 0.8, that is 1 minus 0.2. Correct? We can put this much in the bracket. And the whole thing into the equity beta was 1.25. Okay, somewhere we've missed the bracket. $260. Are you guys getting 260 divided by 105.6 into 0.8? Okay, this is 1.2. All right. This is a completely whole thing. Let me put it clearly. So when you solve for this, 260 divided by 260, I'll do it like this. 105.6 into 0.8 is 84.48 plus 260. That is 344.48. The whole thing into 1.25. Yes, you'll get 0.94. What is this? This is your asset beta. Now, what is the second step? Now you've got the business risk. Now, step 2 is re-gearing. What do you mean by re-gearing? You're using the same formula, okay? You're using the same formula, but this time you're ready to invest now. So, you will not take proxy company's value of equity and debt. You will take your value of equity and debt. How much is your value of equity and debt? They gave it to you in the beginning of the question, right? That we have the share price of 1.05, and what is the value? How many shares? 40 million is a total value. So can I say 40 million divided by 0.5 will give me the number of shares? That is 80 million shares into what is the current share price? 1.05. So 84 is going to be my value of equity. That is 80 is the number of shares. How did we get 80? They've clearly told us that the total value, nominal value is 40 million and per share is 0.5. So in that way, I can get the number of shares into what is the value of one share? 1.05. So this is the value of equity. Similarly, how much is the value of debt? Debt, we have 6.5% irredeemable loan notes, which is $100. So 250 divided by 100, correct? So it will be 250 divided by 100 into what is the value of the loan note? How much is the value of one loan note? Have they given us? Yes, it is $65. So into 65. Most common mistake, students, is they'll just end over here. There is another debt also, no? Value of debt they are asking. It's not just irredeemable loan note. Your bank loan is also a part of debt, which is $20 million, right? So that also you will have to take into consideration. So your total would be these two. This is the total value of debt. Now I want you all to put the figure in the formula. Now we are doing step 2. What is step 2? Re-gearing. Now you're ready to invest. What do you mean by ready to invest? Now it will be now you want to calculate how much is the equity beta. Asset beta from the previous figure, you got it as 0.94. Correct? Is equal to how much is your value of equity? We saw it is 84. Divided by 84 plus how much is the value of debt? We calculated, right? It is 182.5 into 1 minus the tax rate. The whole thing into equity beta. So solve. and tell me how much is equity beta. So 182.5 into 0.8 plus 84 is 230. So 84 divided by 230. I'll keep this in memory. So equity beta is equal to 0.94 divided by this. So are you guys getting 2.57 as your equity beta when you solve this? First you solve the denominator, you'll get 230. 84 divided by 230, you'll get one figure. That will go this side, denominator, to get the answer. So it would be 2.57. So simply go back and mention, like just put all the figures. Asset, you know that 0.94 is your asset beta. Value of equity is 84 divided by 84 plus how much is your value of debt? 162.5. Most of the students forget to take the bank loan into consideration and lose marks. That is one place where you can go wrong. And one more, they forget this 1 minus tax rate. So don't do that mistake. Into equity beta. So when you solve this, you will get equity beta as 2.57. This is your step 2. Now, final step. Step 3 is calculating your CAPM. How will you do it? They've given you everything. RF is given, which is 4 plus beta you found out from your step 2, which is 2.57 into RM minus RF, 10 minus 4, that is 6. So when you solve this, you will get your answer. So do you see that current cost of equity was 17.8%, but if you're entering into this project, that is the commercial malls and everything, then the CAPM is 19.42. So this was asked for how much? 6 marks. If you do it this way, you'll get full 6 marks because everything is addressed. Then what else they're asking? Referring to your calculation above, comment briefly on the view of commercial director. Now, what was this commercial director saying? Look at the question and see. What is he saying? We have to comment saying that project specific cost of equity is higher than the current cost of equity. Right? Project specific, we can write a comment saying the second part of the question. That project specific cost of equity is greater than current cost of equity, which indicates, what does it indicate? Which indicates that the new venture, okay, that is the new venture which ZMO company is planning to invest. The new venture is profitable, but at the same time risky because its cost of equity, project specific cost of equity is also higher. So by this we get 8 marks over here. Then the remaining 12 marks, what are they asking? Discuss 3 problems ZMO company may face because of having high levels of gearing. Now, what do you mean by high levels of gearing? If you have too much debt, then what is the problem? The problem of having too much debt is that you might not be in a position to pay interest expense on time. Then you might not also get, what to say, your next time if you want a loan, the company might hesitate to give you, correct? So you can write, and your equity shareholders also will not be happy with too much debt in the firm. So these are the points that you can write. Or there are chances that you might go bankrupt. So any 3 problems you can mention over here. Okay, that is the debt capacity or the equity shareholders or bankruptcy or not being able to pay interest, all of that. So that was for 6 marks. Then they're asking in respect of both equity and debt, discuss the risk-return relationship and how it affects ZMO company's financing cost. So they're asking you in respect of both equity and debt, discuss the risk-return. So basically they're asking which is better and what is the risk involved in equity, what is the risk involved in debt, and what is the return. So we all know that investors' required rate of return will be primarily dependent on the risk of the investment, right? If risk hai to ishq hai, remember, so high level of risk, higher the return you will want. And if you invest in a low risk investment, then lower return. So if you're a rational investor, would not invest in a high risk investment. Why? Because offering a low return, as they could obtain the same return from a lower risk investment, right? If you are a rational investor, then obviously you could obtain the same return from low risk investment. So a low risk investment offering high returns would not exist, as it would be undervalued and high demand. So you're basically talking about the risk of the investment and what is the return, and you can also talk about the attitude of the investors here. And then you can say that the equity holders have no guaranteed return, because when it is about equity, you are not obliged to pay dividends, right? That's the beauty of having equity. You're not you can say that this time we have not made profit, so we're not paying dividends. But when it is about debt, you have to pay interest. So that is a commitment. It's a fixed commitment. So those things you can write. And then you can say that if the bank has also taken a loan note, so interest expense is compulsory. You have to pay to the bank. And if the company is unable to pay the interest, then the company's assets are in risk because of the default. All these things you can write. And we know that cost of equity is always higher than the cost of debt, right? Cost of debt, if you check, you can use the cost of debt formula also over here. How will you calculate the cost of debt? It's an irredeemable debt. How do you calculate cost of irredeemable debt? We just discussed in today's class, right? It is interest divided by market value of the loan note. Interest is always calculated on the nominal value, which is 100. So 100 into 6.5%. 6.5 is your interest divided by what is the market value? 65. So can I say 6.5 divided by 65? That is 10% is your cost of debt. But how much was your cost of equity? Your cost of equity was 17.8%. So do you see the difference? How much return the equity investors are demanding and how much the debt holders are demanding? That is the trade-off. So this risk-return relationship also you can mention. So yeah, all these points you can mention in your answer to show the relationship, the advantages of taking equity and the advantages of taking debt, and you can talk about the disadvantages of both the sources of finance as well. So yeah, that was your 20 marks question on business finance. Okay, so this area, kind of this particular question tested your ability to calculate the cost of capital, right? It checked how to calculate cost of equity, cost of debt, bank loan and all of that. And also at the same time, they blended chapter 17 and 18. So yeah, by this we are done with the revision of financing decisions. All right. In the next class, we'll start with a new concept, and we'll also take up new problems on from the past exam paper on that particular new concept. So please keep revising, keep practicing more and more questions, and do it in Excel itself, or you can also take up questions from the ACCA. I mean, you can solve the questions on ACCA Global website. You will get the what is it, your practice sheet. Okay, you can download that. Since you have a student account, you can download it so that you're familiar. If you don't want to solve in your laptop's Excel, you can download that CBE worksheet, and then so that you are able to get familiar with the CBE approach. Just give me a second. So from your ACCA Global website, since you have an account, you can log into your ACCA Global website and you can use this blank workspace. You can download this. It's basically how your exam sheet will look like. So that, because in our general Excel, a lot of extra features are available, right? But in your exam sheet which they give you, it will have only limited functions. If you want to get familiar with that Excel sheet, as I showed you guys, you can download it. Okay, you can download the blank workspace so that you exactly know what are the functions that are there, and you can practice at home itself solving in that sheet, so that on the exam day nothing is new to you. Okay guys, on this note, I'll end the class now, and I'll see you guys in the next class with the new concept. Till then, keep studying and happy studying. Bye bye. Hi everyone, welcome back to ACCA FM Rapid Revision. So in the previous class, we discussed about financing decisions, right? We touched on the topic of cost of capital, weighted average cost of capital, the capital structure, that is your financial gearing, operating gearing, and we also did a past exam paper where we took up a question on capital structure. That is when one firm is moving to a different industry or into a new venture, then we will have to calculate a new weighted average cost of capital using CAPM, that is your capital asset pricing model. So in today's class, we're going to address yet another important concept in ACCA FM, that is your working capital decisions. So we are done with investment decisions, we're done with financing decisions, and the next important concept in FM is working capital decisions. All of you understand what is the meaning of working capital. Working capital is your current assets minus current liabilities. You know it. What is the meaning of working capital? It is the capital that is required to run your day-to-day operations, right? So everybody is already aware of these things. Not to mention anyway. But you guys as professional students will need to know more about working capital management. How are you going to manage your inventory? How are you going to manage your accounts receivable? How are you going to manage your accounts payable? All these type of questions you can expect in the exam, either for section in A, B or C. So when I talk about working capital management, here we need to focus on the liquidity and the profitability trade-off. So let me share the screen where we would be discussing about working capital management. So apart from the understanding of your current assets and current liabilities, all of that, what we need to know here is the concept of liquidity and profitability. Now, what do you mean by liquidity and what do you mean by profitability? All of you agree these are two different things, and especially when we are discussing about working capital management, it's important for us to understand the difference between the two. Okay, when I say liquidity, it is my ability to meet the short-term obligations, correct? That's your liquidity, whereas profitability talks about how profitable a company is. So in the earlier discussion, when we were doing investment decisions also, we saw one fact that any day, cash flows are better than profits. Why do we say cash flows are better than profits? The reason we say cash flows are better than profits is because cash flows are very real. They cannot be manipulated. They cannot be, it's very like your profits. Profits are very subjective in nature. It can be window dressed and it is short run in nature, whereas cash flows are better than profits. And that's why even in investment decisions, be it your NPV method or your IRR method, we always give importance to cash flows rather than profits. The best example would be Jio. Remember when Jio first came into the market, they were giving data for free. So can I say their profitability was low? Because they're selling something for a very less price, and in fact, they were selling it for free. But after a few months, what did they do? They started charging for it, right? So, and whenever it was free, everybody was switching to Jio. Everybody were taking Jio instead of Airtel and any other SIM because it was available for free. So what was happening? The company had liquidity. There was cash flow flowing in the business, but did it have profitability? No. In the books of account, it did not have profitability. But since the focus was on liquidity, even today, Jio is one of the most successful company. Why? Because of the fact that they focused more on cash flows rather than profits. So when I talk about pure liquidity and profitability, even in working capital management, we have our famous current assets, right? You have your inventory, accounts receivables, cash. All of these has to be managed properly. If it is not managed properly, right, we have to know what is the liquidity and profitability trade-off. Should I keep too much inventory or should I keep too less inventory? If I'm focusing on keeping too much inventory, then what is it? I'm focusing on liquidity, right? There is so much cost involved in keeping too much inventory. But if I keep too less inventory also, it comes with a cost. Similarly, when I talk about accounts receivable, if I'm giving too much time for my customers to make the payment, then, or if I'm collecting cash very quickly from my customers, again, I'm focusing on liquidity. Similarly, cash. Should I keep too much cash with me? Because should I maintain so much liquidity? Or should I be like, what is the point of keeping too much cash with me? Instead, it is better if I, keep it in the bank, or if I keep it invested, I will get some return. So there the focus is on profitability. So this liquidity and profitability trade-off is very, very important in working capital management. And also, when I talk about working capital management, right from your chapter 7 to chapter 10 talks about working capital management, right? It is very, very important in FM. So from chapter 7, we start understanding the different working capital ratios. Now you need to be very familiar with these ratios because they can definitely ask questions in your MCQs, and also in your section C, it's important to know how to calculate your accounts receivable days, accounts payable days, all of that. So let's just do a quick revision of all the ratios that we have discussed so far. So there is current ratio, which is very simple. It's your current assets divided by current liabilities. If at all they're asking for quick ratio or asset test ratio, what does that mean? They exclude inventory or prepaid expenses. Why? Because inventory at times will take time to get sold. No, there are certain inventory which was purchased 5 years ago which has not yet been sold. So that is why they don't believe inventory to be very liquid. So that's why they exclude inventory from the current asset. So that's why your quick ratio, it's also called as asset test ratio. Then comes your receivables collection period, or we commonly call it as accounts receivable days. What do you mean by accounts receivable days? To put it in very simple terms, how much time you're giving your customers to make the payment. Are you giving them too much time or are you giving them less time? It's your credit period. And how do you calculate your accounts receivable days? Simple. It is accounts receivables divided by sales, right? Generally, this is your credit sales that you will have to take over here, okay, into 365. So always remember, if I'm calculating accounts receivable days, which can also be called as DSO, days sales outstanding, or it can also be called as receivables collection period. It's very simple to remember. The numerator is accounts receivable itself divided by credit sales into 365. Right? If it's given in months, then you multiply it into 12. I hope that is self-explanatory. Next comes payables payment period. Okay, that's simply your accounts payable days. Can you guess the formula? As I told you, when I'm talking about accounts payable days, your numerator is accounts payable itself divided by credit purchases. This time we are talking about purchases into 365. So this talks about how much time you're taking to pay your suppliers. All right. It's always better to delay or postpone the payment to your suppliers because it promotes liquidity, right? like a Gandhi, if you pay, if your supplier has given 30 days time to make the payment, and if you pay on the second day itself, and somewhere on the 10th day, if you need money, money is gone, right? Then again, you have to borrow and you have to pay interest. So that's why it's always better to delay or postpone the payments to your suppliers so that it improves your working capital cycle. So your accounts payable days may sometimes they'll give you the accounts payable days, and with the help of this formula you will have to arrive at how much is your accounts payable, right? They'll give you this and they'll give you credit purchases. So just by this much information you can arrive at how much the accounts payable balance is, or sometimes they'll give you accounts receivable days and credit sales, and you will have to find out how much is the accounts receivable. So that's why it's very, very important to know this formula. Similarly, inventory holding period, or we can call it as inventory days. How much time it takes for you to convert your inventory to finished goods. So inventory divided by cost of sales into 365. Then comes again, you can split it into 3 types, that is raw material, work in progress, and finished goods. See, that's the basic difference between stock and inventory, right? Stock is your finished goods, whereas inventory could be your raw material, it could be your work in progress, or it could be your finished goods. So here, what they're saying, raw material days. How do you calculate raw material? So always your numerator is raw materials divided by raw material usage, or you can also take purchases sometimes. Similarly, when you're calculating work in progress, your numerator is work in progress divided by cost of production. Finished goods, your numerator is finished goods divided by cost of sales. So in this way, you can calculate the number of days it takes for you to convert your raw materials to work in progress to finished goods, and finished goods to accounts receivables. The ulta of all these ratios that we discussed, like inventory days, accounts receivable days, accounts payable days, is your turnover ratios. Correct? So inventory days was inventory divided by cost of sales. So ulta of it, cost of sales divided by inventory is your inventory turnover. So always remember, the turnover ratio, the higher it is, it's better. What do you mean by inventory turnover? How many times in a year you're able to purchase the inventory, sell it, purchase the inventory, sell it, purchase the inventory, sell it. So more the better. So that's your inventory turnover ratio. But your inventory days, lesser the better. The inventory holding period, lesser the better, because more time you hold it, that means it's a sign that your inventory is not getting sold. So your inventory days, your accounts receivable days should be less, but inventory turnover ratio, accounts receivables turnover ratio, that has to be high. So in this way, you need to know how to calculate these ratios. When comparing ratios between 2 balance sheets, you can base each holding period on balance sheet figures rather than an average. That is, generally we take average, but if it's not given, then you can take the closing figures. And remember, if it is in days, you'll take 365. If it is given in weeks, then 52. And if it is given in months, it is 12. These are understood. So once we find out how much is our accounts receivable days, how much is our inventory days, how much is our payables days, that's when we get our working capital cycle. Correct? How does your working capital cycle looks like? It is your accounts receivable days, your working capital cycle is your raw material days plus work in progress days plus finished goods days plus accounts receivable days minus accounts payable days. This is going to give you your working capital cycle. Why do I say this? Because this much time it takes for you to convert your raw materials to work in progress to finished goods, then to accounts receivable, and then you have to pay your supplier. So this much time it takes for your cash to come back to you once it goes from you. Okay, so what do you think? Higher the working capital, it's better, or lower? Lower the cycle better, because that means that quickly you're getting the money. If the working capital cycle is 30 days, that means you have to wait 30 days for your cash to come back. If it is 15 days, then within 15 days, you're able to do it. So shorter the cycle, the better it is. Okay, so that is a brief recap of your chapter 7, where we discussed about the various main ratios, and with the help of the ratios, how can we arrive at other figures. And also the liquidity and the profitability trade-off, where to focus. Then when we talk about inventory management, what happens in inventory management? There is this confusion, right? Whether I have to keep too much inventory or whether I have to keep too less inventory. What is the problem if I keep too much inventory? Can I keep it on the road? No, I will have a warehouse. So I need holding cost, storage cost, I have to pay rent, I have to keep a watchman, that watchman's salary. Then sometimes this inventory might be a perishable good. Then to store that, again, an extra storage cost. Or sometimes I might take insurance for it. Again, insurance cost. So if I keep the inventory, I have a lot of cost. Correct? But if I believe in not keeping too much inventory, then what will happen? See, if you keep inventory, you have ordering cost, holding cost, all of that. Then if you keep very low inventory, you're like someone, what's the point of keeping too much inventory? Instead, I will keep very low inventory or no inventory. What will happen? If a customer walks into your shop and asks for an inventory, do you have it? No, you don't have it. And thereby, you lose that customer. And because you lose that customer, word of mouth, it goes, the referrals, you won't get it, and that's the problem. It affects the reputation of the business, goodwill, all of that. So lost contribution. Had you kept that inventory, you could have sold it and made money, but now you can't. Why? Because you chose to keep very low inventory. Emergency orders, you can't. Suddenly a customer says, and I want 200 units immediately. You're someone who does not keep too much inventory, so you lose that order. Production stoppage, high reorder cost, because you don't have that much relationship with your suppliers. Again, you have to set up. So these are the disadvantages of keeping very low or no inventory. So can I say it has its own benefits? If you keep too much inventory also, it's a problem. If you keep too low inventory also, there is a problem. So what was the solution? Our very famous EOQ. What does EOQ talk about? EOQ talks about the optimum reorder quantity. Okay, so it talks about the optimum reorder quantity. What do you mean by optimum reorder quantity? We had this confusion, no, whether to keep too much inventory or too low inventory. So optimum reorder quantity basically means how much to order. Okay, it's going to talk about how much to order. What do you mean by how much to order? Because we have this confusion. If you order too much, what will happen? You have to carry that inventory, so the carrying cost will increase. If you order too less, then also there was problem. So your EOQ model will tell you exactly how much to order so that your ordering cost and your carrying cost is the least. Because if you use your own brains and order, there are chances that you end up paying either more of ordering cost or more of carrying cost. But at EOQ, both of these costs are minimum. In fact, they are the same, right? So let's just briefly understand EOQ, that is your economic order quantity. Since this is a revision class, I hope everybody knows how an EOQ works, right? Your economic order quantity. Your economic order quantity is square root of 2 into cost of order into demand divided by cost of holding per unit per annum, right? So D is your demand. Then cost of order is cost per order. Each time you order, you will require, there'll be a cost involved, right? And CH, cost of holding per unit per annum. This is your holding cost. Okay. So what does your EOQ tell you? It basically tells you that as you hold more inventory, now this is the quantity and this is the cost. As you hold more inventory, the cost is also going to increase, right? This is your carrying cost. But what about your ordering cost? It is going to decrease. Everybody agrees? Now, suppose you have a demand of 12,000 units a year. Okay, you have a demand of 12,000 units. If you order 1,000 units every month, how many orders are you placing in a year? 12 times. And each time you place an order, you have to pay. Or if you're ordering 6,000 units every 6 months, then you're placing the order 2 times. But every time you place an order, you have to pay ordering cost. If you order all 12,000 units once itself, then you're placing the order only once, correct? So that's why the advantage is your ordering cost more. See, if the number of units is more, let's say 1, 2, 3, 4, 5, okay, then your ordering cost is less. But if you're ordering only 1 unit, then you will end up paying so much, right? At the same time, if you're holding too many units, your carrying cost is high. If you're holding only 1 unit, your carrying cost is low. So do you see where both the points meet, both the costs meet? That is your EOQ. So at EOQ, so somewhere around 2,500, let's say this is in thousands. So at 2,500 units, your cost is the least. Anything above 2,500 or anything below 2,500, you will end up paying more costs. Like let's say 3,000, you will end up paying a lot of carrying cost. Or if you order only 1,000 units, you will end up paying a lot of ordering cost. So at this 2,500 units, you're at EOQ. That is your optimum order quantity. Okay, but of course, it's a very traditional technique and it comes with a lot of assumptions like demand and lead time. What do you mean by lead time? The time gap between placing the order and receiving the order. They're saying that is known. We know in real life that demand is so it's continuously changing, right? And also lead time is the time gap between you placing the order. Can it be constant? Can I say every time in 5 days only I'll get? Sometimes it might take 6 days, 10 days, or 1 week. So in real life, these assumptions don't hold true. Purchase price is constant. Of course, we have to consider inflation and so many other factors. So we cannot say that the purchase price will be the same. No buffer inventory is hold. What is meant by buffer inventory? It is the safety stock. You know, a stock that is kept in case of emergency. Okay, so that is the assumption under EOQ. So this was about your optimum order quantity. Similarly, we have reorder level. What is reorder level? Reorder level talks about when is the right time to place the order. Okay, we know what is EOQ. EOQ is your, so understand the difference. EOQ is the optimum order quantity. What does this mean? This talks about how much to order. Okay, what is it talking about? How much to order. Your EOQ. It's the optimum order quantity. Talks about how much to order. Whereas your reorder level. What do you mean by reorder level? It talks about when to order. Okay, what does it talk about? When is the right time to place the order? Is it, will you place the order once your entire stock is empty? No. When it reaches a certain level, that's when you have to place the next order because it takes time, no? The moment you place the order, will it come immediately? No. There is lead time. So that's why reorder level talks about when to order. Okay, so understand the difference between the two. Sometimes your supplier will give you a discount. Now, when the supplier gives you a discount, what should you do? You have to check whether you have to take the supplier's discount, okay, or you have to order at EOQ. You have to do a cost benefit analysis. Whosever cost is the less or is the least, you will go with that particular option. Okay, if the supplier, so in order to evaluate whether it is better to buy from the supplier will say, if you order 5,000 units and above, I will give you 5% discount. Whereas EOQ might be 2,500 units. So you should check whether it is worth purchasing from the supplier or is it better to continue ordering at EOQ. How will you check? What are the costs that you will have to keep in mind? What are the total cost? One is your ordering cost. How do you calculate your ordering cost? It is number of orders into cost per order. That is demand by order quantity into cost of order. Okay, this is your ordering cost. Then, how much would be your holding cost? Holding cost is your average quantity into cost of holding per unit per annum. So that is X by 2 into cost of holding per unit per annum. Alright, this is your ordering cost, this is your holding cost, and then you'll have to calculate your purchasing cost. Purchasing cost is basically how many units, what are the total number of units you're purchasing, that is the total demand in a year into the purchase price. Of course, when you're calculating it for the supplier, this purchase price will be less because the supplier is giving you an offer. So by adding all of these, you're going to get your total cost, right? How do you calculate your total annual inventory cost? It's your purchase cost, ordering cost plus holding cost. So look at it. This is your purchasing cost, this is your ordering cost, and this is your holding cost. And when buffer inventory is held, that is when you have your safety stock, you should add that. You should add that to your average quantity. Remember, whenever safety stock is given in the question, that has to be added to your holding cost. So in this way, we calculate the total cost. So we will take up an exam kit. We will take up a past exam paper where we will be discussing this particular concept, whether to go ahead with the supplier or at EOQ. So you'll have to calculate the total cost with the supplier and the total cost at EOQ to arrive at the answer. All right. Besides this, what's going to happen? What is reorder level? Reorder level is the volume of inventory held when an order is placed. I told you that is when to place the next order. And how do you calculate reorder level? Reorder level is very simple. It is your demand into lead time. Just be careful that sometimes your lead time will be given in weeks and the demand might be given in annual. In such a case, you can't multiply the two, right? So if the lead time is given in weeks, you convert the demand also into weeks. All right. Similarly, if the lead time is given in days, you convert demand also to days. All right. If the lead time is given in months, then demand also should be converted into months in order to multiply the two. You can't have one in annual, one in weeks and multiply the two. That is killing maths. So don't do that. Just how will you convert? Like for example, if the lead time is given in weeks and the demand is annual. And if you want to convert demand to weeks, you'll do D divided by 52. If it is in months, D divided by 12. If it is in days, D divided by 360 or 365, whatever is given in the question. So in this way, you will have to calculate your reorder level. And then you know that there are intelligent system, inventory management system, that is the latest one, that is JIT, just-in-time system of inventory management system, which was introduced by the Japanese, where they don't believe in keeping too much inventory. They keep only what? They start the production process only after the order is placed. Right? That is your just-in-time system of inventory management. You can expect a question over here on this topic where they talk about smooth flow of work through the manufacturing plant, flexible production process, which is responsive to customers' requirement, reduction in capital tied up. What do you mean by capital tied up? For example, you have $100,000 with you. Either you can invest it in inventory or you can invest it somewhere else. If you put it in inventory, you have to wait until the inventory gets sold. So the capital is tied up in the inventory. What if you invest this $100,000? You'll get some return on it. So this is known as, so they're saying with the help of JIT, just-in-time system of inventory management, you can reduce your, reduction of capital tied up. And always remember, whenever in EOQ calculation, while calculating your EOQ, when you're calculating your cost of holding per unit per annum, it is important to take your opportunity cost also into consideration. What do you mean by opportunity cost? For example, the purchase price of the product would be $10. Okay. And the interest rate would be, let's say, 3%. So had you invested your money somewhere else, you would have got 3% return. But what did you do? You invested it in the inventory. So $10 into 3%, whatever is your answer, that is your opportunity cost. Why? Because you chose to hold the inventory rather than investing it. So that is your cost of holding the inventory, which should be added. Okay, most of the time this will be given in the question in the exam also, and students forget to take this into consideration. So please be smart enough to include the opportunity cost of holding the inventory also in your cost of holding per unit per annum calculation. Okay, so that was about it. Then so these are the two methods. Then you have periodic review system. It's like where the inventories are reviewed at fixed intervals. Then they're set at a predetermined level. It is again based on demand and lead time, popular with suppliers, all of that. That's basically your, you have your DMart and all of that, right? So they basically follow periodic review system. But then nowadays GIT system is very, very useful. So that was a quick revision of your chapter 7 and 8. When we move to chapter 9, we come across accounts receivables and accounts payable. Here we talk about, should I give too much time for my customers to make the payment, or should I collect quickly from my customers? Things like this. And what are the factors? See, these things are important because we've seen while solving past exam papers that it's in your 20 marks question, full 20 marks will not be practical. Around 10 marks will be for theory, where they ask you probably what are the factors influencing the credit policies. It depends on what the demand for the product is, risk of bad debts, how much does it cost for you to finance your working capital, what is your competitor giving. All those things will influence what should be your credit policy in the organization. Should I give too much time for my customers, or should I collect quickly? It depends on all of these factors. Will you blindly give someone credit? Of course not, right? You have to assess the credit worthiness. You have to see whether giving credit to this person is worth it or not, right? So that's why you will check with the customer's bank, or you will check with the trade reference whether this person is is in a position or is able to give on time or not, or company's own sales records you can see, or publish, or credit rating agencies are there. You have this CRISIL points. Based on that also you can decide. And whose duty it is to remind? Of course, it's your duty because you made the sale. So it is your duty to invoice them promptly and collect. Nobody is a Gandhi who will come and say, hey, I have to pay you, please take it. No, you have to ensure that you collect from your customers on time. And how can you do it? You can give them reminder letters, telephone calls, then withholding supplies. You're not going to give them the next order until you get the payment. Debt collect, send someone to collect the cash. And if nothing works out, legal action. So these are the steps that you will have to take into consideration to manage your accounts receivable. One of the most important formula is to calculate the annual cost of discount, because when you give a discount to a customer, your liquidity is increasing. But what is happening to your profitability? Profitability is coming down. What do you mean by profitability is coming down? You're selling something for a lesser price, right? So when you're selling something for a lesser price, it is a cost to you. And if I want to know what is the cost of discount, at the first place, why would you give discount? Because you need the money early, right? Now you need the money early. You have two options. Either you can go and borrow, but if you borrow from the bank or whatever, it comes with an interest. Or you can give a discount, right? Now, if you borrow, also there is a cost. If you give discount, also there is a cost. Now you just have to check which is better, which cost is better, right? That is the analysis that you have to do. Is it better to borrow or is it better to give discount? Because both of it comes with a cost. So that's why here, when you're saying cost of financing the receivables, what is the interest cost? Receivable balance into interest. That is the overdraft rate. This is the cost of borrowing. And this is how you will calculate the cost of discount. That is 1 plus discount divided by amount left to pay, the whole to the power n minus 1. And how do you calculate this number of periods? it's given to you. We've discussed this in our main class, how to calculate the annual cost of discount. And then you have to check whether borrowing is better or giving discount is better, right? That is the cost benefit analysis that you will have to do as a future finance manager. So here, that is what they're saying. If the cost of offering the discount is greater than the rate of overdraft interest, then the discount should not be offered. Matter what, if the discount is coming up to 10% and borrowing is just at 8%, it is better to borrow, no, than giving discount. Or calculate the cost of discount using the formula and compare it to the overdraft rate. That is what we did. If the cost of discount is coming up to 10% and borrowing rate is 8%, it is better to borrow because cost of discount is higher. Or calculate the annual reduction in cash received from customers who take the discount and compare it to the receivables funding, that is cost saved from the reduction in. Okay, this is going to make sense when we do a past exam paper. All right, then what are the other ways? There is factoring, there is invoice discounting, right? These are other ways to ensure that you're getting your cash quickly from your customer. Okay, so it could be invoice discounting where you pledge your receivables, correct? The advantage of invoice discounting is that the customer is not aware that you're pledging their accounts receivable and taking money. But in factoring, it kind of affects your goodwill. So what happens in invoice discounting? This is the company, it has sold something to its customers and it has given 30 days time for the customer to make the payment. But the company wants the money right now. Can it force the customer? No. So what does it do? It goes to an invoice discounter. The invoice discounter will give only 80% of the value of that amount. And the customer sells, so the situation is like this. Let's put it this way. 100,000, or let's keep it simple, $100. Okay. You have sold $100 worth product to your customer and you've given your customer 30 days time, right? The customer sells goods to the company sells goods to the customer payable in 30 days. But you need the money urgently. You need it today itself. Can you force your customer? No, you only gave 30 days. No, you can't force. So what do? You go to the invoice discounter. What will the invoice discounter say? That I can't give you full $100. I can give you 80% of the amount. That is, I will give you $80. Will he give it to him for free? No. He's obviously going to charge something for it. So the company borrows up to 80% of the value of the debt, right? And the company receives the payment after 30 days. After 30 days, this customer will make the payment, no? That's when the company pays the invoice discounter the amount borrowed plus the interest. That interest is the extra money that the company will have to bear because it got the money early. Similarly, there is factoring. Factoring also works in a similar way, but it's just that with the help of a factor, the entire managing of your accounts receivables department or your credit control department will be taken care by the factor. It's no more your headache. Okay. So, but the problem is now the customer knows that you have approached a factor. And the moment you approach a factor, it kind of brings this notion in the customer's mind that maybe the company has liquidity problems. That's why it's approaching a factor, right? So the scenario is still the same. It has given 30 days time. It can't wait for 30 days. So it approaches a factor. What does the factor do? The company sells the debt to the factor. The factor administrates the sales ledger. Now tomorrow when the customer after 30 days will not make the payment to the company, will directly make the payment to the factor. Okay, so please do give it a read about factoring because questions on factoring also have been asked. So that was a quick recap of what's factoring. Then just go through the advantages and disadvantages of both these methods. Besides that, in accounts payable, what do we discuss? In accounts payable, again, the confusion whether we should give delay or postpone the payments to our supplier or should we collect quickly from them. So by delaying payments to payable, companies face possible problems. So suppliers may refuse to supply in future. If they're saying if you delay too much, will the supplier do business with you next time? I don't think so. Supplier may only supply on cash. They'll say only if you pay cash, we're going to give you. Loss of reputation, all of this. But in spite of all these disadvantages, of course, you should not delay too much, but still delaying is better because it kind of improves the liquidity and also improves the working capital cycle. So remember that annual cost of discount that we discussed in accounts receivable, that time the situation was you were giving the discount, right? Now there could be situation where your supplier is giving you a discount. Okay, the supplier may offer discount to encourage early settlement. Now you will have to check whether it is better to take the discount or not take the discount. In the previous scenario, it was whether to give the discount or not. In this scenario, it is whether to take the discount or not. Okay, that is also very important to understand. Besides that, here it's just the formula, everything remains the same. The cost of discount, the part is the same. It's just the interpretation. You should just check whether you are the supplier here or you are the customer here. Okay, that's the difference that you have to understand. So that was a quick recap, guys, of chapter 9. And then finally, your chapter 10 is about cash and funding strategies. Here we basically talk about the different methods of managing the cash. In that we have two methods. One is the Baumel's cash management model and one more is the Miller-Urey. Baumel's cash management model is very, very similar to your EOQ. It's the same model, right? The formula, everything is the same. It's just the interpretation. There we were managing inventory. There we were talking about how much to order. Here we are talking about how much to transfer, because keeping too much cash in your account is not advisable. It is better if we invest in marketable securities. But investing everything is also not advisable. Suddenly, if you need money, what will you do? So that's why how much to order is what, not how much to order, how much to transfer and how much to keep. That is what Baumel's cash management talks about. And Miller-Urey's cash management model talks about how to manage irregular cash flows. Baumel's cash management model talks about regular cash flows. Okay, so that is the assumption. But you know that in real life, the cash flows are not very regular in nature. Sometimes you have high, sometimes you have low. So it's very irregular. So that's when Miller-Urey came up with this model. Okay, where he said that whenever you have excess cash balance, now this is the return point, okay? Whenever you have excess cash balance, that time you have to invest. Invest how much? Not fully, up to the return point. Then again, when you do business, you will start spending money, right? And you have to pay your suppliers, rent, so many overheads. So there are chances that you will reach the lower level. Now, when you reach lower level, you need money, right? So that time what will you do? The reason you invested is because bure waqt mein kaam aaye. So you will start selling. But will you sell everything? No, only up to the return point. Okay, only up to this point you will sell, not everything. So this is how your Miller-Urey cash management model. It's a very big formula, but don't worry, it will be given to you in the exam in the formula sheet, where they might ask you to calculate the return point or the spread. You just have to be careful while plugging in those datas into the formula. Okay, always remember the interest rate is taken in daily terms. Okay, and variance is your standard deviation scale. So they might give you SD, that is standard deviation. So don't directly take standard deviation, you have to square that amount, because in the formula we take variance of cash flow, not standard deviation. So these tiny things, what goes into the formula, how to arrive at the answer, this is something that you have to remember. Okay guys, so that was about your cash management, Baumel's model and Miller-Urey's, and preparation of budgets. You have cash inflows, cash outflows, that is your payments, you'll get net cash flow. Opening balance of first month, closing balance of first month is the opening balance of second month. Basics, so where you might be asked to prepare a cash budget also, you just have to be careful. What are your cash inflows? What are your cash outflows? You'll get the net cash flow. Then you'll have the opening balance. When you add the net cash flow and the opening balance, you'll get the closing balance. Closing balance of January is the opening balance of February, and the same procedure repeats. So just be careful when you prepare a cash budget. So that's about your cash management, right? Where one more small topic is how to finance your working capital, right? Should I use short-term source of finance, or should I use long-term source of finance? That's the thing. You know that there are current assets and then there are fixed assets. Correct? Current assets are usually financed out of short-term credit, while non-current assets like land, building and all, you won't take overdraft for it. For that, you need long-term funds. But sometimes in most businesses, a proportion of the current assets are permanent and some are fluctuating. Correct? So in such a situation, how a company manages it, That is known as approaches. Approaches to capital managing. If you're very aggressive approach, okay, this talks about how are you financing it. If you're very aggressive, you will finance all fluctuating current assets and most of your permanent current assets, that is your non-current assets, with short-term finance. If you're very conservative in nature, then long-term finance is used for most current assets, including a proportion of fluctuating current assets. Okay, long-term finance because you're conservative. And if it's matching, then for short-term you will use short-term. I mean, for fluctuating you will use short-term, and for long-term you will use permanent. For permanent current assets you will use long-term. So these are the approaches of how you're funding your assets. All right. So short-term finance is usually cheaper than long-term finance, but the lower financing cost should result in better profitability. That is aggressive. Quicker cash turnover may allow more reinvestment and hence allows the business to expand more quickly. So these are the advantages of aggressive. But conservative, lower liquidity risk, greater ability to meet a cert. See, when it comes to a long-term funds, there is no urgency to pay. You have time to pay. More relaxed credit policy for receivables, all those things. So generally, the more conservative the approach, the lower the risk, but higher the cost in terms because the money is tied up in working capital. So these are the working capital approaches. So that was a very, very quick revision on your working capital concepts, where we discussed about your inventory, your cash, accounts receivables, accounts payable, the important ratios, all of it. So next, what we are going to do is we are going to take up a problem, a past exam paper problem, wherein we will be solving questions on all the concepts that we have discussed so far. So we're done with a quick revision of working capital management. Now it's time to test our concepts. So let me go to the past exam paper and start solving them. So let's continue. I'm going directly to the past exam paper. So this is an ACCA FM exam paper which came in December 2021. All right. So let's take up this question where they're saying that it's a working capital management question. All right. So you can see it's exactly how your main ACCA FM exam will look like. This is the format, where you will be given two scenarios. So I'm taking scenario 1. That is basically, I'm talking about the first question. So let's just first give it a read. What is the question saying? So they're saying candy company purchases a number of different products from various manufacturers, which it then sells on credit to a number of large retailers. Candy company is currently reviewing its working capital investment, and two independent options are currently under consideration. One, it can take a bulk purchase discount from one of its biggest suppliers, or offering an early settlement discount to its customers. Bulk purchase may, what are the figures? One of Candy Company's biggest selling item is the gimbal. Gimbal is their product. So Candy Company pays $30 for a gimbal, and annual sales demand is 18,000 units. Purchase price is 30. At present, how much is the order size? 1,000 gimbals. What is the ordering cost? $75. So even in the exam, you will be given this option to highlight so that while you solve, it's easy for you to look at these figures. So while reading the question only, you can highlight some important points. Annual holding costs are equivalent to 9% of the purchase price. This is nothing but your opportunity cost. Due to high level of demand for gimbals, Candy Company always holds a buffer inventory sufficient to cover 2 days demand. Okay. What else? Candy Company can purchase, Candy Company has been offered a bulk purchase discount of 1.5%. Okay. So this is the offer given by the supplier. If the company order size is up to 1,500 gimbals. Okay, if it now it's currently ordering 1,000, but if it orders 1,500 gimbals, then it's going to get a discount of 1.5%. Although this is 50% more than the what? It is 50% more than the size of the current order quantity, right? Because 1,002, it will become 1,500. Candy company feels that it has sufficient storage capacity to accomplish this, but annual holding cost will increase to 10% of the purchase price. Also, the increased size of the order would result in higher delivery cost, increasing the cost of placing an order by $25 per order. Okay, why? It is increasing by 25. So earlier it was 75. Now it is going to become $100. If accepted, Candy company would still maintain a buffer inventory sufficient to cover 2 days demand. Okay, this is scenario 1. That is with the supplier. Then they're saying Candy company has a total credit sales of 45 millions per year, and all Candy company's customers are equal in terms of sales value. Although Candy company's credit terms require payment on 30 days, only 60% of its customers pay on time, and the remaining 40% of the customers pay on an average of 40 days. Candy company is considering the introduction of an early settlement discount of 0.5% discount. All those are paying within 10 days. And who is going to take up this discount? Only 50% of its customers will take advantage and pay in 10 days. 20% of the customers will still pay 2 terms. What do you mean by pay 2 terms? That they'll still take 30 days. Only 50% will pay in 10 days. And there'll be 30%, the remaining 30% who will continue to pay on 40 days. They've told, and then the financing of the short term is at what percentage? 70%. Okay, assume 360 days year for all calculation. Now, this particular working capital management exam kit problem is taking into consideration all the chapters, that is chapter 7, 8, 9. Correct? They've been asking about inventory management, they're asking about the ratios, they're asking about the accounts receivables management. So, it's a full-fledged exam question on the topic of working capital management. Just few minutes back, we had a detailed discussion about working capital management. Now, let's do this problem. So, firstly, they're asking us calculate the financial effect on Candy company accepting the bulk purchase discount. Then calculate the financial effect of the company offering a settlement discount. That's for 4 marks. Using your result 1 and 2 above, comment on the financial acceptability to Candy company for each option. Then they're saying explain the cash operating cycle and discuss the relationship with the level of investment in working capital. So that brings us how much? 6 plus 4, 10 plus 2. Then there is discuss working capital objective of liquidity and profitability and the conflict. Remember we discussed about this conflict, whether we have to give too much inventory, too low inventory, whether we have to give too much time, too less time. This is the liquidity and profitability. So it's a total 20 marks question where, 12 marks is for practical and 8 marks is for theory. So let's solve this. What I'll do is I'll go to our Excel sheet. All of you can see the screen. So we are doing Candy company, which is a past exam paper on the topic working capital management. So what is the first part of the question? Let's start with that. Calculate the financial effect on Candy company of accepting the bulk purchase discount. So this is the A part of the question, right? Where they're asking what if we take the bulk purchase discount, right? So we'll write it this way. Calculation of the same heading only you can write. The financial effect. Calculation of the financial effect on Candy. On Candy if it accepts bulk purchase discount. Correct? This is the heading. How much marks for this particular question? It's a 6 marks question, right? So currently, how much is the demand? Can you look at the question and tell me? Currently, how much is the demand? It is 1,000. Right? This is, just check if the demand is given in an all. No, the demand is 18,000. So let's first write down the things that we know. So demand is 18,000 units. Then what else do we know? How much is the order size? 1,000. Now this is the current situation, okay? Order size is 1,000. What else? Cost of order is 75 in the current situation. And what about is 75? This is current. Then purchase price. Purchase price is 30. This is in the current situation. Now, if I go with the bulk purchase, then what are the changes that you see? Demand is going to be 18,000 units itself. No change. Order size is going to increase to 1,500. Cost of order is going to be 75 plus 25. And purchase price would be 40 minus, you're getting a discount of how much? 1.5%, right? So 40 minus 1.5%. We are going to get it for $39.4. Correct? This is the purchase price. Okay, so this much is given to us. Now let's calculate the total cost under both the scenarios, because that is what they're asking us, no? The suppliers offer and this. So what are the total cost? Do you remember in the concept revision, we saw that the total cost is generally your ordering cost, holding cost, and the purchasing cost. So we'll do that. First is your ordering cost. How much will be your ordering cost? Demand. Okay, we'll write down all of it. Then you have your carrying cost. That's nothing but your holding cost. Then you have the purchasing cost. Okay. So this is the current scenario. And if you take the bulk purchase. So you know what is the formula for ordering cost, right? It is number of orders. So can I say it is demand, total demand, divided by how much is your order size? 1,000 divided by how much is your ordering cost? 75. So 1350. That is basically demand by order quantity, the whole thing into cost of order. Same way over here, the demand is the same, 18,000 divided by how much am I ordering in case of bulk purchase? 1,500. So this is my number of orders into my cost of order has increased to $100. So it is 1,200. So do you see in bulk purchase, my ordering cost has come down. Let's now calculate the holding cost. Holding cost is generally, how do you calculate it? It's your average quantity into cost of holding per unit per annum. Have they given us the purchasing, the carrying cost per unit per annum? Check in the question. We know that holding cost is average quantity. So how much am I ordering? We are ordering 1,000 divided by 2 into what is my holding cost? Annual holding cost is 9% of the purchase price. So 30 into 9%, that is 2.7. Right? So it is 2.7. Correct? So this would be your answer. So what do you observe over here? Current ordering cost is also 1350. Holding cost is also 1350. So can I say currently the company is ordering at EOQ? 1000 is its EOQ because we know at EOQ the ordering cost and the holding cost is the same. Similarly, can we calculate the bulk purchase now? How much is it? What is the cost? The order size is going to be 1500 by 2. And what about the cost of holding per unit per annum? 39.4 is your purchase price into 9%. 3.546. So it's going to be, have we missed out any adjustment? Okay, one thing, remember what I told you guys, that you should always include your buffer stock if it is in the question. And they've clearly told that the buffer inventory, candy company would still maintain a buffer inventory sufficient to cover 2 days demand. So tell me, how much is the buffer inventory? 18,000 is for 360 days. So for 2 days demand, it's going to be 100 units. So here you will have to add the buffer inventory also. See, under pressure, students would forget to include this adjustment. So please don't do this mistake whenever you're calculating your holding cost. If there is buffer inventory in the stock, you will have to take it into consideration. And they've told that buffer inventory is 2 days time. Okay, so we know that 18,000 is for 360 days. So for 2 days, how much is it? You can do 18,000 into 2 divided by 360. 100. 100 units is your safety stock, which we have to take into consideration, not just in current, even in bulk purchase. You will have to add the 100 units. And I hope you all have also taken down the carrying cost. So carrying cost, is it changing over here? We'll have to check that. Okay, see, they're saying annual holding cost for gimbal would increase to 10% of the purchase price. So here, it's not going to be 3.546. It would be 39.4 into 10%. That is 3.94. Or what is the purchase price? Okay, I think the discount won't be taken into consideration here. The purchase price is 30, no? So it would be, where is it? $2.5. So just go through the question. Have we missed out any adjustment? Here it is 1,200. They've told 2 days demand itself. Cost of placing the order would increase. 1,500 gimbals. So that would be 1,500 divided by 2 plus 100. That is 1,600. 1,500 divided by 2 plus 100. 5. Okay. So this was, how much was the purchase price? Was $40, not $30. Huh? No, it was $30. Here I've taken company pays $30 a gimbal. Okay, I have taken 40 over here. Let me make the correction. It is $30. And over here also we will have to make the correction. It would be 30 minus 1.5%, 29.55. Correct? Holding cost would be 30 into 9%, that is 2.7 in case of current scenario. Here it would have been 2.955. Yes. Always take 29.55 into 10%. That would be 2.955, which we can round it off to 2512. See, these are the tiny adjustments that you have to take care in the main ACCA exam. Here, please note that the figures of your ordering cost, holding cost, everything is changing in case of bulk purchase. All right. Then comes your purchasing cost. How many units are you purchasing in total? 18,000 units. And what is the cost under the first scenario? It is 18,000 into the purchase price is 30. So it is $5,40,000. And what about here? Also, you're spending 18,000 units. You're purchasing for the whole year, but you're purchasing it at 29.55 because you're getting 1.5% discount. So what is your total cost? Can I say the total cost is equal to sum of your ordering cost, holding cost, and the purchasing cost? So this is your total cost. So where is the total cost the least? If you order at the current situation or if you order at bulk purchase. Here it is $5,42,970. Here it is $5,35,000. So how much is your savings? Savings is so much. So much is the savings if you go for the supplier's offer. So this was a proper question on whether we have to take the supplier's offer or not. Okay, so that was a 6-mark question but tested so much of your concepts. Now moving on to the second part of the question. What are they asking? Calculate the financial effect on candy company on offering the early settlement discount. So let's put the heading. What happened? We missed one slide. Okay. So let's do the second part where we are calculating. So we'll put it this way. Calculation of financial effect on candy company on early settlement. Early settlement of discount. This is the situation. Okay, so how do we start early settlement of discount? Let's read the question. I'll give you all 2 minutes to go through the question. Candy company's total credit sales is given to you. They've also given, they've given us how many customers are going to pay on time, right? So let's figure that out. Let me write it. What's my credit sales? How much is my credit sales? It's $45 million, right? Which is given to us. Then they have also given us how many customers are making the payment on time. 60% of its customers make the payment on time. On time payment. That means when is it? In 30 days itself. Then 40% customers. How many days they take? They take 40 days. That is overdue, no? More than the credit period. Then if you give them a discount, what is the scene? We'll come to that. So first we'll calculate what is our old accounts receivable balance. Okay, so we're going to start with first calculating the old accounts receivable balance. So we all understood what is the calculation, right? You know what is accounts receivable days. It's your receivables collection period. The formula was accounts receivable days in the numerator divided by credit sales into 365. So in this particular question, they've given us how much is the credit sales. 45. We know it is 365. We also know how much time they give their customers to make the payment. So how much would be the accounts receivables if it is 30 days, and how much would be the accounts receivables if it is 45 days? Because this will give me the overall accounts receivable balance. That is old one. That is before I introduce this discount. Okay. Now what happens after I introduce a discount is a different calculation. Now I'm calculating before introducing the discount, what was the scene? Right? Before discount. So that is calculation of old accounts receivable balance. So how do you start? If I want to know 30 days receivable and 40 days receivable, how will I do it? Can I just interchange the formula and I can arrive at the figure, right? Can I say it is 30 into this 45 will go into 45 divided by 365. That's going to be my accounts receivable balance, which is $3.69 million, right? 30 days, 30 into sales is 45 million. Divided by, they've told take 360 days, no? Not 365 days. So please be careful. But the problem is only 60% of the customers are going to pay in 30 days, right? So I will have to put it this way, everyone. 30 days, you know how to calculate accounts receivable days is equal to accounts receivable divided by credit sales into 365. So I'm giving 30 days time and I want to know how many of them are taking. So out of $45 million sales, only 60% of them are taking this. So accordingly, I will have to calculate how much is my accounts receivable days for 30 and similarly, how much is it for 40. So while solving this, how much do we get? Can I say 45 into 60% is 27. So 30 into 27 divided by 360, 2.25 million. Correct? How? 30 into 45 into 60% into 27 divided by 360 days. They have only told us, assume. So this is my accounts receivable balance. 30 days ka accounts receivable. Right? Same way, can you calculate for 40 days how much is the AR? How many people are going to take this? Can I say it is 40 into 40% of the customer. So 45 into 40% into 18 divided by 360. That is 2 million. So what was my old total accounts receivable balance? It was $4.25 million. This was my old accounts receivable balance. In my balance sheet, these many accounts receivables were there. But now what is happening? Check in the question. Now we are introducing the discount, right? We are introducing the discount. So what happens when we introduce a discount? After introducing the discount, let's write down the facts. This was before discount. One second. Yeah, this was before discount. Now, after discount, what's happening? after introducing discount, let's calculate the accounts receivable balance. They are saying 0.5% will take this, right? 0.5% if you're giving a 0.5% discount if paid within 10 days. Okay. And how many of them will take this? 50% of the customers. Then what about the balance? 20% will continue to pay in 30 days, 56, and another 30% will continue to pay in 40 days time. So can you calculate the new accounts receivable balance? This was the old accounts receivable balance. Now calculate the new accounts receivable balance. Same way how we did it. The ones who pay in 10 days. What would be the amount? Can I say 10 into how many of them are taking the discount? How many of them are taking the discount? 50% of the customers. So 10 into 45 into 50%, that is 22.5 divided by 360. So $0.625 million. What is this? This is your accounts receivable balance, the ones who are paying in 10 days. Similarly, how much would be the accounts receivable balance for 30 days and 40 days? Check. Do the math in the same way. 30 into how many of them are paying? 20%. So 45 into 20%. So that means 9 divided by 360. So 0.75. Similarly over here, 40 into 30% of the customers. So 45 into 30%, 13.5 divided by 360. So that is 1.5. So what is your total accounts receivable balance? It is 2.875, right? So this was your old accounts receivable balance and this is your new accounts receivable balance. So what do you observe? What have you observed from your old to your new? The accounts receivable balance has come down, right? From 4.25, it has come to 2.875. That means there has been 1.375 reduction, right? That is your savings actually. How much of it was what was the percentage? 7%. So how do you look at this? Everyone, your old accounts receivable balance was 4.25 and your new accounts receivable balance has come down. Why? Because so many of them have taken the discount and they've made the payment, right? So it has come down to 2.875. But to give this, what was your cost of discount? When you give a discount, I told you, right? It comes with a cost. So can I say cost of discount? How much discount you're giving? You're selling at 0.5%. 0.5% is the discount. So on the amount, correct? So can I say, how many of them are taking this? Only 50% of the customers are taking this, right? So out of 45 million sales, only 50% of the customers are taking. And how much is the cost of the discount? 0.5%. So $0.1125 million is the cost of giving this discount. Then now can I say that from 4.25 it has reduced to 2.875. So whatever is the difference, now you have to fund only for this much. Earlier, the financing cost would come up to 4.25 into 7%, but now it is just 2.875. So there is a savings. How much is that savings? Can you all do it? So from your old accounts receivable balance, earlier it was 4.25 into 7%. Now it is just 2.875 into 7%. So there has been a savings, correct? Now your financing cost, earlier you had to do so much. Now your financing cost is only for this much balance. So can I say my financing, understand the concept guys, because I gave discounts to my customers, my accounts receivable balance has come down, right? So it is just 2.875. Now if I urgently need money, I'll have to borrow and the borrowing comes at 7%. But now the amount would be only for 2.875. So my financing cost would be 2.875 into 7%. That is 0.20125. Correct? So what is my total cost now? How much is my total cost? Can I say this plus this? This is my total cost. I'll give you all 2 minutes to go through it. So my cost is actually increasing in this scenario. Because if I'm giving discount also, there is a cost. And I'll have to finance also, no? So that is also my cost. So my total cost is this much. Hence, what can I conclude? What's the conclusion? That it is not advisable to give discount because it is just increasing my cost. So we can conclude saying that offering discount by candy company is not advisable as it leads to an extra cost. So we can say that it's not worth giving discount to our customers, because if you observe, what are they asking us? Look at the question. They're asking us, you're considering to introduce an early discount, but if you introduce a discount, your cost is increasing only. You don't see a reduction in cost. Correct? So then for 2 marks, they're asking, using your results from 1 and 2 above, comment on the financial acceptability to candy company of each option. So we can conclude saying that, okay, over here, the third part of the question we can answer saying that, what is a comment? It's very important to give a comment. That is the conclusion. So my conclusion would be, bulk purchase discount should be accepted as it leads to a saving. But offering early payment discount to customers is not worthwhile. Okay, why it's not worthwhile? Because it leads to, this is the total cost. There is no benefit, and that's why early settlement discount is not financially acceptable. So this is the comment which you have to give for 2 marks, where you are saying that why you should not go with the second option and why you have to go with the first option, because it leads to a savings over here, but here there is extra cost only. Correct? Another way of looking at it is, earlier your cost would come up to how much? 4.25 into 7%. That is 0.2975. That would be your cost. But now your total cost would be, giving discount is also cost, and for the remaining financing of the receivables also it is a cost. It is coming up to 0.31375. So here the cost is greater than the benefit, right? And that's why we should not offer early discount. Okay, so after introducing the discount, your cost has increased. Here, your cost would be only to fund these receivables. Now, it is to fund these receivables, and because you're giving discount, that cost of discount also you have to factor. So that's why it is not advisable to give discount. Okay, let's finish this problem. What else they're asking? So 6 plus 4, 10, 12 marks we are done. Then 8 marks is theory. So for B part, they're asking, discuss the working capital objectives of liquidity and profitability and the conflict between these two objectives. You very well know what is the conflict between these two objectives, right? We've discussed that in detail when I talked about liquidity and profitability trade-off. Should I keep too much inventory or should I keep too less inventory? Should I give too much time for my customers to make the payment or less? So you have to talk about that. Besides that, what else are they asking? That was for 4 marks. So you can explain the liquidity and profitability for each scenario, that is for accounts receivables, accounts payable, and inventory management. Okay. Anything else that has been tested here? Let's see what is the next question. The next part of the question is explain the cash operating cycle and its relationship with the level of investment in working capital. So you know what is a cash operating cycle? We discussed it. Accounts receivable days plus all of those days together gives you cash operating cycle, and we have to always ensure that our cash operating cycle is as less as possible, because it means that we're able to collect quickly the cash from our customers. And then what are the factors that influence the cash operating cycle? You can include this: nature of the company, uncertainty, activity levels, the credit policy, the risk appetite of the company. Everything is going to matter. Explain the cash operating cycle. You have to explain how to arrive at cash operating cycle. Cash operating cycle basically means the time taken for a company to receive its cash back once it goes from it, right? And what is the level of investment in working capital? This one, working capital investment level. What are the factors? You should mention these points. Nature of the business. Certain companies will require a lot of working capital. Certain companies will not. Based on the activity levels, credit policy, length of the operating cycle, credit policy, risk appetite. So these things you will have to mention over here for 4 marks. Okay, so that brings us to an end of your 20-mark question on working capital management. We've had a detailed discussion on working capital management. So we are done with investment decisions, financing decisions, and working capital. So these are the core areas which you can definitely not skip. Of course, in professional exams, you can't skip anything. You can't afford to skip anything. But these are the heavily tested topics in the exam. So yeah, I'm going to stop over here. And in the next revision session, we will continue our discussion on the most tested concepts. All right. So till then, keep revising and keep solving more and more MCQs as well, because yes, 40 marks is your for your solving, but another 60 marks is your MCQs. So time management over there is also very, very important. All right, guys, I'll see you in the next class. Bye. Hi everyone, welcome back to ACCA FM Rapid Revision session. In the past classes, we have discussed about investment decisions, financing decisions, then your working capital decisions. We've also taken problems from past exam papers, right? And we have solved it in Excel sheets. Okay, so that was about it. I want to introduce in today's class another important resource which is provided by the ACCA professional body, which you should not be ignoring. All right. And what is that? That is your examiner's report. Right in the first class of the revision session, I told you guys that I will be taking up some examiner's report also. But first of all, let's understand what is the meaning of examiner's report. So this document, okay, this PDF is easily downloadable from your ACCA Global website. In this examiner's report, you will find, okay, let me first show you guys where you can find this examiner's report. So if you can see my screen, this is your ACCA global website. You will have to go to students, and in students study support resources, and in study support resources you will have to choose ACCA qualification because you are doing ACCA. You have the study support resources for all the subjects, but since we are discussing about FM, let's choose FM. And over here, you will find everything what you need to know about FM, right? From the syllabus, the technical articles, then how a computer-based exam looks like, your past exam papers, question practice, everything is available over here for free. Okay. And something called as examiner's report also you can find out. So what is this examiner's report? So in examiner's report, so you know who is the examiner, right? Examiner वो इंसान है जो आपके papers को correct करते हैं, correct? So in examiner's report, it is a very, very important study resource. And in your revision phase, this is something that you have to give a check, okay? So what you can do, what you can find in an examiner's report is, you will get insight into the marking process, including common students' mistakes and how to avoid them. So in an examiner's report, so you know it's a 100 marks paper, right? And in 100 marks paper, some questions will be easy, some questions will be challenging, right? So those challenging questions will be addressed here in the examiner's report. In the examiner's report, they'll also show where often a student is making mistake. What is a common mistake done by the student? And you know, how you can avoid them. All those discussions are done in an examiner's report. So today's class, I'm going to take up some examiner's report, and we're going to solve them in order to understand, you know, how better we can approach a particular MCQ. So in the past classes, we've been doing more of section C questions, right? That is your constructed response questions, where we you know, used to type the answer in the Word or solve it in the Excel. But we all know that 60 marks of your ACCA FM exam is for your MCQs, your multiple choice questions. So today I would like to also take up some MCQs from the examiner's report. So you have it almost for all the attempts, that is March, June 2022, September, December 2021. So I'm going to take up some latest examiner's report for our discussion. Okay, so as I said, you just have to click on this and you will, and you can download them. Okay, so I've already downloaded few of the examiner's report. Let's start solving them. Just give me a minute. Let me share my screen. Okay. So this is an examiner's report, okay, which came in March, June 2022 attempt. So what they do is they, in March also there is a window for you to write an ACCA exam. In June also there is a window for you to write the ACCA exam, right? So they'll combine both the attempts, that is March and June. Both are combined and an examiner's report is done. What were the challenging questions in the March attempt? What was the challenging questions in June attempt? So both these things are taken into consideration, and we then check, you know, where to focus on, and, you know, where to pay attention to. Certain concepts we might think that we've understood, but when they ask in the exam, it is very challenging. So things like this are addressed in our attempt, I mean, in the examiner's report. So if you can see over here, I'll show you guys how to even download the report if there is any confusion. So I told you guys how to go over there, right? So all you have to do is go to the ACCA global website. Like this. And then if I want March, June 2022 examiner's report, I just have to click. And I have the report downloaded in your respective PC. Okay, my screen is not shared. Yeah, I just click on it, and the March, June attempts report is now in my PC. You can see. So what I'll do is, let's start solving them. So let me go to the March-June attempt. Okay. So you can see over here, I've downloaded it, and this is the content. So as I told you, it is a combination of the two attempts together. So we know that actually what happens in section A, there are 15 questions carrying 2 marks each, right? But in the examiner's report, what have they done? They have taken only 4 questions, okay, which were quite challenging for most of the students in that particular attempt. So we're going to discuss those 4. Similarly, in section B, you will find 3 scenario-based questions, right? You'll have 3 scenarios, and based on that scenario, you will have sub-questions. So here they have taken up 1 scenario, and then even in section C, they have discussed on certain requirements where students found it a bit tricky. So today I'm going to focus on section A and B, that is your objective test questions. Okay, so only not the entire paper is discussed. Okay, because in the revision phase, that does not make sense. In the revision phase, we need to focus only on those areas, right, where students find it difficult, or that one particular adjustment which student might ignore. So all those things is beneficial if you do a examiner's report, right? So what are they saying? Here they will give us a constructive guidance on how to answer the questions while sharing their observations from the marking process. So examiner is the one who corrects your paper, right? So he has corrected so many papers. So while correcting so many papers, they realize, okay, this is a common mistake done by every student. So that's why that question was picked and put in the report. So here we also highlight the strength and weaknesses of the candidates who attempted these questions. Okay, so in section A, it's an objective test question. We focus on 4 specific questions that caused difficulty in March and June 2022 sitting, right? And in section B, since we have 3 case scenarios, we will be taking up only 1 scenario to explain. And even in section C, they give guidance on answering these questions and where you can improve yourself, correct? And also how you can use the CV functionality. That is, how can you use a formula to answer a particular question. So let's start with the very first question in the June and March attempt, where students sort of, got a wrong answer. So let's have a look at our first question. So they're saying in section A, in this section, we will look at 4 sections which prove to be particularly difficult for candidates. Let's see if you guys are able to answer this. So what are they saying here? Pride Company is a listed company with 800 million ordinary shares in issue. Okay, so they've given us the number of shares outstanding. Yesterday, the ordinary share price closed at $6. So they have already given that yesterday the ordinary share price closed at $6. 2 days earlier, the board of directors approved the launch of 2 new innovative products, but this has not been publicly announced. So this is an unpublished information because it's not publicly announced. But in the first line, they said yesterday the ordinary share price closed at $6. Okay. Product A has an NPV of $40 million. And the decision to launch product A will be announced publicly tomorrow. So this is going to be announced, right? Published. And product B has an NPV of $160 million. And the decision to launch product B will be announced publicly this morning. Okay, so both of them are yet to be published. Assume all other things are equal and the capital markets believe that the projected NPVs. Both products will be financed using internally generated funds, meaning your retained earnings or your reserves. This is the question. So what are they asking us? What will the ordinary share price be at the end of today if the capital market is semi-strong form efficient and strong form efficient. Okay, this is the question. I'll give you all 2 minutes to think about it. Okay, so what are they asking us? They're asking us what will the ordinary share price be at the end of the today if it is semi-strong efficient and strong form efficient. So this here they are testing your concept from chapter 20, that is business valuations and market efficiency. In market efficiency, we saw there are 3 types of efficiency, right? Weak form of efficiency, semi-strong form of efficiency and strong form of efficiency. So what happens in weak form of efficiency? Only past information is taken into consideration. In semi-strong form efficient market, your past and your published information is taken into consideration. And what happens in your strong form? Past, published and even unpublished information is taken into consideration in strong form of efficient market. So here they're asking we have to choose which is the share price which suits for 1 and 2. That is over here. So can I say how much is it? They're saying yesterday the ordinary share price closed at $6. 2 days earlier, the board of directors approved the launch of 2 new innovative products, but this has not been publicly announced. So even though it has not been publicly announced, right? The share price has already been closed, correct? So that means this $6 has incorporated this information also, which is not published, which is unpublished. So that has also been taken into consideration. So if unpublished information is also taken into consideration, then that means it is a strong form of efficiency, correct? $6 represents a strong form of efficiency. Then what about these 2 things where they've told the decision? If you see over here, the decision to launch product B will be announced publicly this morning. So it is going to be published, right? So can I say that? So they're asking today what will happen, right? What is at the end of today? So here, yesterday itself, they have closed it. So that means $6 is your strong form of efficiency. Now, this is about tomorrow. What are they asking us? Today, at the end of the day today, what is the result? So here, product B has an NPV of $160 million. And the decision to launch product B will be announced publicly this morning. So this was a published information. So can I say this is semi-strong form of efficiency because it takes published information into consideration? And I have 800 million shares, right? And the total value is how much? We're all aware of this formula, that number of shares into price is equal to total value. So total value is 160. I don't know how much is the price. Number of shares is 100. So how much is the price? It's going to be 160 divided by 800, which is 0.2, correct? So $0.2, I can expect an increase because this company has launched this product, and because it has launched this product, this is going to affect the share price, right? So how much will it be? $6 plus 0.2, which is $6.2. So the correct answer would be, if it is a semi-strong form efficient market, it would be $6.2. And if it is strong form of efficient market, it would be $6. That is, it has already been incorporated and the share price closed the other day, right? So these two would be the right answer. Okay, so what is a general mistake what students did? Let's have a look at that. We know that in a semi-strong firm efficient market, the markets value shares based on information relevant to past movements and also published. Two things we take into consideration. Now we know that the share price will react to NPV of product B today as the news is released. As soon as there is a product launch, now the share price is going to react to this public announcement. So by how much? $0.2 per share. So what will happen? The share price will come to $6.2. You know how we got it. $6 plus 0.2. $6.2 because of this breaking of news. But in a strong firm, if the market is very strong, what happens? It takes all the information into consideration, historic, published, and even unpublished information like insider information. So the share price of $6 will already reflect the NPVs of both new products as the decision to launch them was taken 2 days ago. That is yesterday itself, right? So that is why this question, students found it a bit tricky. Of course, under pressure, it can get confusing. But the only point that you have to understand over here is that what? The point that I'm trying to make over here is that this has already been taken into consideration because it's a strong form of efficiency. Whereas in product B, when they decided to launch this, because of this news which they're going to release this morning, the share price is going to get affected. So that information has to be taken into consideration. So this was quite a tricky problem for a lot of students in the last attempt. Okay, guys. So let's move to the next question. Here they're asking, which of the following statements about an over-the-counter interest rate options are correct? Okay, so they're asking about interest rate options. So the moment you hear this word option, what do we know? You have the right, but not the obligation. If you want, you can exercise it, but it was not compulsory, right? Your interest rate option, that is one thing. And look at the word they've used. It is over the counter. Okay. If it is over the counter, what does it mean? It is not listed in the stock exchange, right? Or futures exchange. It is not listed. Correct? Over the counter happens between two parties, right? So which answer is correct? Can it be traded if it is not listed? No. An immediate premium is payable. That is in futures exchange, right? It must be exercised. No, it's an option. If you want, you can exercise. Otherwise, it's okay. So which statement is correct over here? Can I say it is an agreement with a financial institution? Yes, this statement is correct. Why? Because over-the-counter trader, it's like if you go and apply for a bank loan, it is happening between you and the manager, right? Over the counter. That is the meaning of over the counter. Your bank loan is not traded in the secondary market. Correct? So first statement is correct. Can it be traded? No. An immediate premium is payable? Yes. Whenever you enter into an option contract, you have the right, whether to perform or not perform. To get that right, you have to pay a premium. So this statement is also correct. It must be exercised? No, it is not a forward exchange contract where you have to perform. It is up to you. Whether you want, you can exercise it. Otherwise, it's okay. So that's why the right answer is option B. That is 1 and 3. So the students got confused over here because they ignored the word over the counter. So if they use the word over the counter, it means that it is not traded in the secondary market. It is not listed in the secondary market, right? Okay, next question where they're asking us, okay, another question where students found it a bit challenging. Which 4 of the following descriptions relate to main macroeconomic policy objectives? So here they are talking about chapter 11, right? That is your economic environment of the business. In that we saw various policies, remember, fiscal policy, monetary policy, exchange rate policies. So here they're asking which 4 of the following descriptions relates to main macroeconomic policies. There were green policies, so many of them, but which of them are main? Ensuring minimum amounts of price increases. This is something that, see, always do when you come across a macroeconomic policy, think of it like if you were the Prime Minister of India, what were the changes that you would want to do in the country? It will include all major decisions, right? So similarly over here, ensuring minimum amounts of price increase. Yes, this is something that you would definitely want to focus. Increasing national income and living standards for your citizens, of course. Then ensuring a balanced ratio of imports to exports. We know that, right? We can't have too much imports. That means then we'll have a deficit. So this is also very important. Maintaining interest rates at minimum levels. This is more about your monetary policy, right? So that's one part of it. Then they are talking about balancing government spending with tax receipts. This is monetary policy, and this is more of fiscal policy. They are asking us macroeconomic conditions, which is external in nature. Then ensuring a stable and fully employed labor force. Now this again is something that comes under macroeconomic policy. Correct? Maintaining the interest rates, balancing the government, this one, what should be the tax rates? Those are all fiscal policies, right? So here they're asking what are the macroeconomic policies. So they've given here clearly that maintaining interest rates at a minimum level is instead a monetary policy objective, and balancing government spending is a fiscal policy objective. Whereas all the other points that we mentioned, no, these are your macroeconomic policy. So whenever you come across such a question in your revision phase, always make notes, okay? Because then you just have to read the notes. This is something that you've learned from an MCQ, right? So that has to be noted down. Okay, the last question from this particular examiner's report, where they're asking, so look at this. Beaver Company has 100 million equity shares in issue and has just reported a profit after tax of $55 million. Okay, PAT. A new issue of 50 million equity shares at an issue price of $1.5 is being considered. All proceeds would be used to redeem a bank loan with an annual cost of 8%. Corporation tax rate is 20%. Assume that the operating profit, that is profit before interest and tax, or your EBIT, remains constant. If the equity issue goes ahead, okay, if you are issuing 50 million equity shares, okay, at 1.5 each, how much money you will get, no? With that money, what you're going to do? You're going to redeem a bank loan. You have taken a bank loan. You want to pay off that bank loan, and with interest of 8%. So they're asking if equity issue goes ahead and the bank loan is redeemed, what will be the new EPS? What will be the new earnings per share? What's the formula for earnings per share? It is profit after tax minus preference dividends divided by number of shares outstanding. Correct? This is your earnings per share. So now, over here, we all know the format, right? So if you look at this, what is our format? Something sales minus variable cost is your contribution less fixed cost. You get your EBIT less interest. You get EBT less tax. You get EAT, or your profit after tax. This is how you arrive at it, right? So what have they told? They've already given us that the new earnings, that is the profit after tax, is going to be how much? Okay, they've told it has just reported an after-tax profit of $55 million. So what do we have to do? We have to do reverse calculation. Your profit after tax is 55 million, right? Then how much would be your before tax? 55 million is after tax, right? So 55 million is after 20%. Then how much is 100%? 5 into 80 divided by. So 55 is after tax, after you deduct 20%, right? So 55 is 80%. So can I say 68.75? Because 68 75 is your earnings before tax, because tax is how much? 68.75 into 20%. It's around 13.75. Correct? What about your interest? How much is your interest? Interest is going to be 50 million. So this part most of the students will forget. You're taking a new issue. You're issuing 50 million shares at how much? $1.5, right? 50 million shares at 1 point. So you're raising 75 million. And the interest rate is 8%. But interest is always tax deductible, right? So it will be 8 minus 20%, 6.4%. That would be 4.8. So interest would be 4.8. So x minus 4.8 is equal to 68.75, right? EBIT minus interest is equal to EBT. Correct? So if EBT is 68.75, if interest is 4.8, how much is your EBIT? Can I say 68.75 plus 4.8? Okay. So now we need to check how much is the new earnings per share, right? So we're doing the reverse calculation. So if you look over here, new profit after tax, we want to know how much is the new profit after tax. So that would be 55 million plus 1.5. This is the interest, correct? Which is 50 million into 1.5 into 0.8 is equal to 59.8. Okay, so what I'll do is I will properly show you guys how we've arrived at this. Just give me a second. It's just this particular question was confusing for students because of one fact that they forget to take the interest calculation, right? And many candidates did not adjust the earnings figure and instead used 55 million to get 0.367. Okay, that is what they did. They took this itself, 55 million, the profit after tax, and they calculated. But then we will also have to take into consideration the new equities, right? The new equity shares which we issued, which was 50 million into 1.5 into 6.4%, which is 4.8 plus 55. Yes. So I hope everybody has understood how we got this. This is my profit after tax, which was already there. Then I again issued, I issued 50 million into 1.5 at how much? 8% was the cost, but that was before tax. So after tax, it would be 6.4%. Correct? So 50 million shares of 1.5 each, which is 75 million. Correct? And out of this, 6.4%. So how much is this? 75 into 6.4%. That is $4.8 million. So this comes up to $4.8 million. So 55 million plus $4.8 million is your 59 points. So if you want to calculate your new profit after tax, how much is it? 59.8 divided by, now how many shares you have? You already had 100 million shares. Now again you issued 50, no? So it will be 59.8 divided by 150. So when you solve this, you will get 0.3999, which is your option A. So they are asking if the equity issue goes ahead and the bank loan is redeemed. So you have issued this equity shares only to pay off your bank loan, correct? So you issued, you raised 75 million, but out of that you had to pay your bank loan. You had to redeem your bank loan, right, at the rate of 8%. But a lot of students might forget to take that into consideration. So overall, how much did you all get? 59.8 divided by 150, which is 0.39. So many candidates did not adjust the earnings figure and instead used $55 million to get 0.367. That is, or they did not adjust the number of shares to get, yeah, so they just did 55 divided by 150. Okay, they did 55 divided by 150, that is 100 shares, 100 shareholders I already had, plus 50. That time you'll get 0.367, which is also there in the question. But we have to also adjust the earnings figures, which won't be 55, but it would be 59.8. Correct? So that's something that most of the students forgot to take into consideration because they did not adjust the number of shares to get 0.598. Okay, so this was quite a tricky question. So alternatively, if the equity proceeds were taken to be $15 million rather than 50 million into 1.5, students would have gotten. So they see how they are showing that, where students lost marks and all those alternative options are also there. Answers are also there in the options. So in the exam, you might think you've given the right answer, but not necessarily. So that is the situation over here. So candidates should read the question carefully and follow the instruction on how to answer the question. For example, if a question asks a candidate to select 2 correct statements, then marks can be awarded only if 2 statements have been selected. There'll be no, like if they ask 2 statements and if you choose only 1, okay, because you're sure only about 1 and if you do not choose the second correct, then you'll get 0. So always be careful that you have to choose both. There is no partial markings. So either you have to choose both or not. And also sometimes they'll give you like this, a box and million will already be there. So again, don't go to write millions, or again, don't express it in decimals. Okay, for example, if the number is requested in millions, there will be an M after the entry box like this. If the candidate puts, instead of putting 13 million, okay, you don't have to put 13 million over here. That's also wrong. You just have to write 13 because million is already there. And even this is wrong. Going on putting the zeros inside the box. Got it? So that is also wrong. So most of the students make mistakes like this, and even though they know the answer, they end up losing marks. Correct? So, and if there is no format specified, you can round it off to 1 or 2 decimal places. Okay, so that is something that needs to be taken into consideration. So these were the 4 challenging MCQs what students faced in the past attempt. Okay, so this question, if you closely observe, closely look at this particular problem, as I told you, if it's a bit confusing, this how they arrived it, you can do a reverse calculation. We did it, we did half the calculation that time, right? Sales minus variable cost is your contribution less fixed cost is your EBIT less interest is your profit after tax. So we all know that the profit after tax is how much? It is $55 million, right? So EBIT less interest is your EBT. Sorry, we'll finish the entire thing. So this is going to be EBT, right? Less tax is your EAT. So EAT is given to us. That is, EAT is nothing but profit after tax, which is 55. Less tax. So 55 is after tax. That is 80%, right? So if 55 is 80%, then how much is 100%? So in that way, we did reverse calculation, right? So 55 into 80 divided by 100. 100 divided by 80, we get 68.75, correct? And how much is the interest? How much would be the interest? 50 million, right, into 1.5. So that means 75 million, and the interest is 8%. So 75 million into 8%. How much is it? It's about $6 million, right? $6 million. So this would be 6. And before that, how much would it be then? Can I say 68.75 plus 6? This is after tax only, guys. That was a mistake that we did in the previous calculation. So this would be 74.75, right? So they've told EBIT remains constant. So this is how we arrive at it. So what is my, this was my earlier. correct? Earlier profit after tax, we arrived like this. So if 74.75 is my new, right, EBIT, now that I have raised this new equity shares and now no more, and I have redeemed this loan. So I don't have any, now I don't see this 74.75 is my EBIT. Now that I have issued equity shares and I have repaid my loan, I don't have interest expense. So there is no interest expense. So if EBIT minus interest. So my EBT is 74.75 itself, but I have to pay tax, no? How much is the tax? 20%. So of this, 20% will go as tax. So after tax, how much will it be? Since they have told EBIT is constant, I'm just doing it this way. Our EBIT less interest will give me EBT, less tax will give me my earnings after tax. I want to know how much is the new earnings after tax. So this would be 74.75. There is no interest because I have repaid that bank loan. So my EBT is 74.75, but I have to pay tax 74.75 into 20%. So 14.95 will go as tax, right? Minus 14.95, which is 59.8. Got it? The same figure that we got over here. Okay, so this was after tax calculation. So this is a shortcut, but the logical way of arriving at it is 59.8 divided by 100 shares holders you already had plus this new equity shares that you have. So 59.8 divided by 150, which is equal to 0.398, which we can round it off to 0.399. I hope everybody has now understood it. Okay, because they've told EBIT is constant, we can do it in this method as well. So this was a full-fledged examiner's report of March-June attempt. Okay, 2022. So now let us do a problem from, let us do some more MCQs from the examiner's report on the latest examiner's report, which is available in the ACCA Global website. So this is your September-December 22 attempt. Okay, the very recent one which is available. As usual, students who found certain questions very challenging in the December and September attempt, together they have combined and given us 4 questions for practice. So shall we start solving them? So the first question which most of the students found it difficult was this. They're saying over here, Abrar company has 6% convertible loan notes in issue with the floor value of $106.2 per $100. So $100 is the nominal value. Floor value is $106.2. Each loan note can be converted into 15 ordinary equity shares, right? Ordinary shares means your equity shares at any time or redeemed in 5 years time at a nominal value. What is the minimum? Okay, so the question is asking what is the minimum share price at which investors would convert their loan notes to 2 decimal places. So what are they testing over here? They're testing how convertible debt works, right? So you have 2 options, either to redeem, right, or to convert into equity shares. They are asking if you convert, what should be the minimum price? That is what they're asking. So if you redeem, how much are you going to get? 106.2. Correct? That is a floor value. That is the value that you're going to get it. Now, if I want to know, if I can convert it into 15 ordinary shares, how much should be the share price? As I told you, this equation is very, very important. Number of shares into price is equal to total value. So if I want to know minimum value, minimum should be 106.2. And I want to know how much is the price if I'm converting 15. So can I say price should be 106.2 divided by 15? So at least the price of the share should be 7.08. One share should cost at least 7.08. Because if I do 7.08 into 15, I'm getting 106.2. That time it is at par. Even if I don't convert or if I convert, it is the same, right? So at least 7.08 per share is a must, right? They're asking what is the minimum share price? 7.8 at which investors would convert their loan notes. If it is below 7.08, nobody would convert the loan notes into equity shares. Why? Because it is not worth it, right? Whenever you come across a convertible loan note question, you should check whether it is beneficial to convert it or not, right? So only if it is at 7.08 or above 7.08, I would consider converting it, but nothing below it. So the minimum share price would be 7.08. Now, why did they put this question is because most of the students, they did 100 divided by 15, okay, the nominal value, and they said 6.67 should be the minimum price. But here they've clearly told that the floor value is 106.2. Correct? So floor value is nothing but the present value of the redemption option. Today, if you are planning to redeem it, you're going to get 106.2. And that is the reason you should take the floor value and not the nominal value for dividing. So this was a common error seen by the students where they took nominal value. They did 100 divided by 15 and got 6.67, which is the wrong answer, right? We should do 106.2 divided by 15, which is 7.08. Clear, everyone? This would be the minimum share price. So this was quite a new type of question that was tested in the recent attempt. Next, they're asking a state-funded hospital. Okay, look at the way they're asking the question, how tricky it can get. We might know the concept, but it's important to understand the inner workings. So here they're saying a state-funded hospital has the objective of providing value for money. All of you remember the concept of value for money? The 3 E's. What are they? Economy, effectiveness, and efficiency. Look how they're testing whether you have understood the concept or not. So a state-funded hospital, more like a government hospital, has the objective of providing value for money. It measures the achievement of this objective using economy, effectiveness, and efficiency. Which of the following performance indicators measures the hospital's economy? So they want to talk about the hospital's economy. Okay. So most of the students got tricked in this question. How? They chose option C. Normally, suddenly if you see, you feel, oh, cost is given. No? So cost means economy and they go for it. But what is option C saying? Cost per successfully treated patient. So successfully treated patient is actually not talking about economy. It is talking about the efficiency of the hospital, how successful they were in treating the patients, right? And average waiting time for patient admission. This is also talking about efficiency, right? Now, here, most of the students went with option C and got the wrong answer. But the correct answer is they're testing the economy E, which is the total medical staff salary cost, because it's talking about how well you were able to get the best output, okay, get the best output without sacrificing the quality. That is what economy talks about, ensuring the best quality and quantity without sacrificing the quality. So economy is the acquisition of resources of appropriate quality and quantity at minimum cost. Correct? So the medical staff salary cost is the only option that does this. Many students went with option C by selecting which one? The measures of efficiency, that is the success, the cost of the cost per successfully treated patient, but that's not the right answer, because that is the measure of efficiency, and this looks at how well inputs are converted into outputs. What is efficiency? How well you are able to achieve the task with minimum resources. So that spoke about efficiency and not economy. So option B would be the right answer. See, everybody will think that yes, we've understood value for money concept, but look over here how they tested this particular concept. Got it? So economy talks about getting things done at a lesser price without sacrificing the quantity and quality of the product. Efficiency talks about with how less resources you can achieve the best. And effectiveness talks about have you achieved it or not. Okay. Moving ahead, let's check this question. The third question, they're asking a machine which is costing 4,50,000. right? Year 0, you purchase the machine, 4,50,000. Has a useful life of 6 years, after which time its estimated present value of resale will be 25,800 and the present value of total cost of running over the next. So year 1 to year 6, this was the cost of the machinery, right? Initial cost. And for you to run the machinery, running or maintenance cost is coming up to 25,800. So it is a cost, right? And then finally at year 6, when you sell the machinery, how much are you going to get? 25,800 you're going to get when you sell the machinery. And running cost is 82,280. So in such questions, you should be very, very careful about the signs. Year 0, you're purchasing the machinery, so it is a cash outflow, so negative. Then year 1 to year 6, it is a cost, running cost, right? So 82,280, again, brackets. Then year 6, what is happening? You are reselling it. So reselling means you are getting money. So it's a cash inflow. So these are all present value only, right? So they are asking what is the equivalent annual cost, something that we discussed in our classes, right? What is equivalent annual cost? Why do we use equivalent annual cost? To check when is the right time to replace a particular asset. हमारा formula कैसा था? EAC is equal to present value of cost divided by annuity factor at 10% for how many ever years? That is how many years in this example? 6 years. Correct? So how much is my present value of cost? Can I say 4,50,000 negative, again minus 82,280 negative, plus 25,800. So my total present value of cost is 5,06,000, right? 6,480. This is my present value of cost, which is a negative. Divided by how much is your annuity factor at 10% for 6 years? You can refer to your annuity table, that is 1 divided by 1.1. You can go to your annuity table and at 10% for 6 years, how much is it? You can check from there, or you can do it in your calci. 1 divided by 1.1, 2, 3, 4, 5, 6, and then grand total. So it is 4.355. So just apply the formula. I'll get 116298.5 something. So which I can round it off to so much. So what is this? This is our equivalent annual cost, right? When we do this, we get it. So wherever, whichever year it is a list, so they were asking for 6 years itself. So the correct answer would be 1,16,299. Right? Most of the students, what they did over here is they calculated for 1 year or different years. Some candidates incorrectly just evaluated the present value of one cycle, right? While some others appear to simply divide the present value of one cycle by the number of years in the cycle. We should not divide it by the number of years. We have to divide it by the annuity factor, correct? And this way, we get the answer. So this was also a different type of question. Actually, it was very simple. We had to just calculate the equivalent annual cost using the machine if it were be bought to be replaced after 6 years. So the only thing was we had to calculate the equivalent annual cost for 6 years and take the annuity factor. You had to remember this formula over here. That was the only catch. Let's do one more question from this particular examiner's report. Here they're saying a financial manager believes that if information regarding his organization is made public, it will not affect the share price as this information is already reflected in the current share price. If it is already reflected in the current share price, then it's not going to matter, right? So what kind of form of efficiency it is? You know, there are 3 forms of efficiency: weak form, strong form, semi-strong form. If it is already reflected in the current share price, what form of efficiency is it? We all know that it is strong form of efficiency where everything is taken into consideration already, right? So that is your answer, strong form of efficiency. We've seen Under strong form efficient markets, the share price will reflect all information regardless of whether it is in the public domain or not. So a significant number of candidates selected semi-strong. Why? Because here they told no that believes that organization is if they're going to publish. So things like that can confuse you. That's why in professional exams, concept clarity is important. And we've seen that even in March, June attempt and also in September, December attempt, a question on market efficiency has been tested. So please ensure that you you read this topic again. All right. So that was about your section A, where we discussed about a lot of concepts, right? And these were the questions where students tend to go wrong. And I hope everybody has understood it. Okay, let's do one more problem. Let's take up another problem from section B. Okay, and then wind up the examiner's report discussion. There are so many examiner reports available in your ACCA Global website, which you can download them and practice during your revision phase. Not just for FM subject, for other subjects also it is available. So when you're doing other papers also, you can check them out. Okay. So now talking about, let's do one question from section B. You know how section B questions are, right? You will be given a scenario and based on that scenario, you'll be asked 5 questions carrying 2 marks each. So from the September-December attempt, there were about each attempt, there were 3 scenarios, right? So out of the 6 scenarios, the most difficult scenario which students faced, that has been put in the examiner's report, where student went a bit, where the students faced a bit difficulties, that is there over here. So let's have a look at it. Okay, Wren Company. So Wren Company, that is the home currency of Wren Company is the dollars. And the company is a supplier in foreign country whose currency is dinar. So let's get our facts right. There is Wren Company whose, then there is a foreign company which is the supplier from whom Wren has purchased. Right? And what is the currency of that supplier? It is dinar. How much time is given? What have they told about the timing? They've told us that in 6 months' time. So the supplier has given Wren Company 6 months' time to make the payment of how much? 3 million dinars. 3 million, not dollars, dinars. Okay, so Wren Company has to pay the supplier 3 million dinars. And the company is concerned about the exchange rate. Not today, but it has to pay in 6 months' time. Right? But you never know in 6 months what can happen, right? So what are they saying? They've given us the spot exchange rate. What do you mean by spot exchange rate and how do you read it? They've told 2 dinars per dollar. So what does that mean? It means $1 is equal to 2 dinars. This is the spot rate. And what is the 6 months forward rate? They're saying $1 is equal to 1.94 dinars. So dollar has appreciated or depreciated? $1 was 2 dinars. Now that same $1 is 1.94 dinars. That is in 6 months' time. So here the dollar has appreciated. Correct. Now you being, you have to make your, or can I say, in other words, dollar has, if dollar has depreciated, what is happening to dinar? Dinar has appreciated. Correct. That's the way we interpret the currency. When one currency appreciates, the other currency depreciates. So $1 is equal to 2 dinar. Now that $1 is equal to 1.94 dinar. So what's happening? In this particular situation, we can see that dollar is depreciating and dinar is appreciating. And Wren Company would not be happy about dinar appreciating because he has to make the payment. No, he has to make the payment in dinars. Then they have given us the borrowing and the deposit rate. What are they asking? Wren Company wants to compare making a lead payment of the 3 million now. Now you are understanding why Wren Company wants to make the payment now itself, because 6 months time they're expecting it to be 1.94 dinar. That means what is happening? dinar is appreciating, and if dinar appreciates, Brand company has to pay more because it has made this purchase in dinars. So Brand company would want the dinars to depreciate. Always remember, let's keep patriotism aside over here, okay? So even though Brand company's home currency is dollars, it has to make the payment in dinars. So it would want the dinar to depreciate. So in the current situation, the dinar is depreciated, but then in 6 months' time, it's going to be 1 point. So it is planning to make a lead payment with taking out a forward exchange contract for D3 million that can be exercised in 6 months' time. So if he wants to compare that, the company wants to compare whether lead payment or forward exchange contract. Then as the company is short of cash, it wants to make the, what do you mean by leading or leading the payment? That means you're scared that tomorrow, what if the exchange rates are not in your favor? So that is why today itself, you will decide to make the payment. But to make the payment, you need money, no? So what are they going to do? They're going to borrow. And if you borrow, will anybody give it to you for free? No, you have to pay interest. So that borrowing interest rates and all is given to you in the question. Then they're saying, when company is considering raising $500,000, okay, in 3 months' time, in order to ease its cash flow problems. Now, this is a separate scenario where it wants $500,000, not today, but in 3 months' time, in order to ease its cash flow problems. Okay, so it wants in 3 months' time, and the company would borrow the money for a period of 6 months. This interpretation is very important. And it would hedge interest rate risk by using a forward rate agreement, that is an FRA. So Vren company has been offered 2 FRAs by its bank. One is 3 versus 9 FRA at 10 to 8% and 3 versus 6 FRA at 9.8 to 7.8. But the company is also considering interest rate derivative hedging. So this is the scenario. Okay, I hope everybody has understood the question. Let me repeat the problem for you guys. So there is this rent company. It has purchased something from a foreign supplier and it has to make the payment in 6 months' time. And it has to make 30 lakhs dinars. It has to make the payment. But the problem is they are confused whether to make the payment now or through a forward exchange contract. To make the payment now, it wants to make the payment now, but it does not have money. So it has to borrow, right? So that is the situation. And in the second scenario, it wants $500,000 because it has some cash flow problems, liquidity problems, but it does not want the $500,000 now. It wants, not now, it wants after 3 months. Okay. And it wants for a period of 6 months. So they're planning to approach a bank for a forward rate agreement. So you guys also just give it a read, and once you all give it a read, we'll try solving the question. Okay, so I hope everybody has gone through the question. So now let's answer the first part. So question number 1, they're asking uh, in relation to interest rate derivatives, which of the following statement is correct? So interest rate futures hedges can be closed out anytime. Yes, it can. Why? Because they are exchange traded. They are traded in the secondary market. So it can be closed out anytime. That statement is correct. But let's look at the other options. Forward rate agreements fix the interest rates on future long-term borrowing. Nothing like that, right? It can be done for anything, not just for long-term borrowing. So this statement is false. If interest rate options are allowed to lapse, then there is no overall cost to the holder. No, whenever there is an option, you have to pay premium, and that is a cost. So this statement is also false. Then buying both an interest rate cap and an interest rate floor is an where is it? Yeah, is an example of interest rate collar? No. How can both be the example of it? So that's again not the right answer. So option A is the correct answer. So a lot of students, what did they do? They chose option B. Yes, forward rate agreements they fix the interest rates in advance itself, but not only for future long-term borrowings, right? That is why that statement was wrong, right? Not just for long-term instruments. So that's why B was wrong. And also buying a cap and selling a floor would be an example of collar. That is incorrect. Okay, buying a cap and selling a floor. So here, see, they're saying buying both an interest cap and interest floor is an example of interest rate collar. No, buying a cap and selling a floor, that would be an example of collar. Not buying both would be the example of interest rate collar. Had the question be buying a cap and selling a floor, then the statement would be correct. But since they said buying both, that's why the statement is false. Okay, next question. Look at the question. They're saying, considering the future value on the D3, that is dinar 3 million payment date, and comparing the lead payment with the forward exchange contract, which of the following statement is true? So I told you guys that Wren company has got two options, right? Wren company has got two options. What are they? One, it can lead the payment. Now itself it can make the payment, right? Or it can go for a forward exchange contract. So the question is asking which is better, going for a lead payment or is it better to go for a forward exchange contract? So let's just quickly do this problem. Just taking the revision notes. Just give me a second. So I hope the question is clear. They're asking whether the company has to probably like do the lead payment or should it go for okay. Let me share the screen. So if you observe, so examiner's report, we are talking about section B and we are discussing December attempt paper 22, the latest one. So the question is, first question, what was the right answer? A was the right answer. Okay. Now we are doing question number 2. Okay, so the situation is, I hope it's clear, where they're asking, consider future value on the D3 million payment date and compare the lead payment with the forward exchange contract. So we are checking whether we have to go for lead payment or forward exchange contract. This is the situation. Okay, so now what are the exchange rates? We know that $1 is equal to 2 dinars. This is the spot rate, right? And if you're going for a 6-month forward exchange contract, $1 is equal to, how much have they told? It is 1.94, no? The question says $1 is equal to 1. Where is the question? Oh, this. It is 1.94 per dollar. This is the situation. How much should the company make? The payment is in 3 million dinars. Okay, 3 million dinars. So, if it is going for a forward exchange rate, how much would be the value? $1 is equal to 1.94 dinar. So, 3 million dinars would be how much? 3 million is nothing but 30 lakhs. So, can I say 30 lakhs divided by 1.94? So, it will have to make a payment of, total payment of 1,546,392. Correct? 15,46,392. This would be the payment which Wren company would do to the supplier if it goes for a forward exchange contract. Now, what if we make a lead payment? That is now itself, because you're scared that tomorrow if the exchange rates are not in your favor. So if you're making the payment today itself, then the problem is you will have to make the payment now, but you need to have money for it, right? You don't have cash, so you will have to borrow. So how much will you borrow? You have to make $3 million, and now itself means $1 is equal to 2 dinars. So if you have to make 3 million dinars, how much you will have to borrow? 30 lakhs. 3 million is 30 lakhs divided by 2, right? So 15 lakhs. So this is the amount of dollars. This is the amount of dinars. This is the amount of dollars that you will have to borrow to make this payment. Now you have to borrow. Will they give it to you for free? No. What is the borrowing rate? The borrowing rate in dollars is 10% per year. Okay, so this is 10% is for the whole year. Correct? That is for 12 months. You want only for 6 months. So how much is it? 10 into 6 by 12. So it is 5%. So if you're borrowing 15 lakhs, all of you know the basic formula, no? Which we've studied. Present value into 1 plus r whole to the power n is your future value. So if you're borrowing 15 lakhs at the rate of 5%, how much is it going to be? So 15 lakhs into 1.05. So it's going to be 15,75,000. So what is the payment? It would have been 15,75,000 if you're going for a lead payment. If you're going for a forward exchange contract, it is 15,46,390. So which is better? Paying 15,46,000 is better or 15,75,000 is better? Obviously, forward exchange contract is better by how much amount? What is the difference? How much is the difference? It is 15,46,392. 28,608, right? So this much is the difference, correct? This is the amount of what? This, by this much amount, it is better to go for a forward exchange contract rather than lead payment. So let's check if that amount is there. So how much did we get? 28,608. Yes. So FEC cost 26,008 more than the lead payment? No. FEC cost 46,000 more than the lead payment? No. The lead payment cost 46,392 more than the FEC? No. The lead payment cost 28,608 more than? Yes. Correct? Here 28,608 is the difference. So that's why forward exchange contract is better. So that's why option D is the right answer. Okay, so what did most of the students do? They went with option A, where they took 46,392. How? Because it does not address the requirement of making the comparison of future payment date and the fact that the money for the, they did not consider the fact that you would have to borrow. What they did, they directly did lead payment. You have to make the payment, no? So they didn't do this particular maths. They just did 15 lakhs and they compared this 15 lakhs and this one. But that does not make sense because we did not have this 15 lakhs. We had to borrow it, right? So that is why this would be the actual figure and not. So most of the students, they compared 15 lakhs and 15 lakh 46,392 and thought A is the right answer. But this 15 lakhs, we did not have ready cash. We had to borrow it. So that's why it became 15 lakh 75,000. Okay. So that was the second part of the question. Then third part, what are they asking? If Wren company takes out the relevant FRA, okay, and borrows at a base rate of 10.5% per year in 3 months' time, what is the net cost of borrowing? So first of all, we need to understand what is FRA, right? So we all know that FRA, what does it stand for? It's a forward rate agreement, right? FRA is a forward rate agreement. It is a derivative contract between the company and the bank, right? And what do we know about derivative contracts? That both the parties to the contract have opposite views. Now, if I am borrowing money from the bank, what will I be worried about? I will be worried about the interest rates going up. What will be the bank worried about? The bank will worry about the interest rates going down. So both of us have opposite views, right, about the interest rates. So that is why, to safeguard, to protect myself from this risk, it's a hedging instrument. I take a forward rate agreement. So if you observe in this particular question, there are two forward rate agreements. The first step, a student should first understand how to choose a forward rate agreement. They'll give multiple forward rate agreement, but how do we choose which is the right forward rate agreement for me? They have clearly told in the question that Wren company is considering raising $500,000 in 3 months' time in order to ease its cash flow problems. And for that only, it wants to borrow the money for a period of 6 months. Correct? So the cash flow problem is not today. It is going to be there in 3 months' time. And this problem is going to be there for a period of 6 months. Right? So 3 to 4, 4 to 5, 5 to 6, 6 to 7, 7 to 8, 8 to 9. Right? So that makes it 6. So this would be a suitable FRA, that is 3 to 9. Most of the students in this particular question, they took 3 to 6 and they took this as the FRA, but this is not the correct FRA because 3 to 6 means it is covering only 3 months' time. They have interpreted the question wrong. I need the money from 3 months, but the period is 6 months. I hope this part is very clear to all of you. I don't need the money today. I need the money in 3 months' time and I need it for a period of 6 months, not a period of 3 months. Now here, it is taking only for a period of 3 months. That's why this is not the correct FRA. This is the correct FRA. So what is this? So that is the first step, to choose the correct FRA. Choose correct FRA, which is how much? 3 to 9. This is the forward rate agreement, 3 months to 9 months, because this duration is 6 months. That's why. And the agreement is 10 to 8. Okay, 10% to 8%. This is the interest rate. So how much are you borrowing? You're borrowing $500,000 you will require in 3 months' time. So at what base rate? What was the rate decided? Let's look at the question. It was at 10.5%, right? %10.5%. So you are, so can I say you're borrowing at the rate of 500,000. Now this 10.5% is for the whole year. You want it only for 6 months, correct? So 10.5% is nothing but 0.105 into 6 divided by 12. So how much is the interest that you're paying? Solve this. 26,250. What is this? This is the interest paid on loan. How much? 26,250. But what is happening? This is the interest that you paid on loan. Now, 10% was the 10.5% was the rate that you decided. But 10%. So what? See, you are the company over here. What will be the company be worried about? The interest rates going up. What will the bank be worried about? The interest rates falling, because it will get less amount, right? Both of them have opposite views. So you thought that the interest rate goes up, and it did go up. It was at 10.5%. Bank thought it will go down, but it was not, right? So who won the bet over here? The company won the bet, right? So company thought that the interest rates would go up, and it is at 10.5%. So the base is how much? 10%. So since the company won the bet, now bank has to pay the company. How much? Only the difference amount. That is 10.5 minus 10. That is 0.5%. So 0.5% is 0.005. That is for the whole year. You want it only for 6 months. So how much is it? Always first do this part and then multiply into 500,000. So you have to pay 26,250, but you will get to 1250 because you won the bet, no? So what is the net cost? What is the net cost of borrowing? It is 26,250 negative plus 1250. That is 25,000. Which is actually nothing but this rate itself. What is the feature? This 25,000 is actually nothing but 500,000 into 10% is for the whole year. So for 6 months, it will be 5%, which is nothing but 25,000. So whatever would be the exchange rate, you have protected yourself with, you have locked this entire transaction at 10%. That is the feature of a derivative contract. You're protecting yourself from risk, correct? So net effect would be $25,000 itself. Tomorrow, if the interest rate goes to 10.5% or if it falls to 7% or 8%, you would still be paying $25,000 itself, because that is the locking of interest rate at that rate. So the net cost of borrowing would be $25,000, which is option B. Lot of students chose option C, which is incorrect, because this is based on selecting the wrong FRA. They did not recognize the correct FRA. And some of them added these two figures and took 27,500. That is also wrong. Okay, one more question. It's a theory question. They're saying which of the following statement is correct? If exchange rate is 2 dinars per dollar, okay, if $1 is equal to 2 dinars, and a relative increase in the dollar interest rate, okay, if the interest rate increases, will cause the dollars to appreciate? No, there is an inverse relationship, right? As interest rate increases, the dollar rate depreciates. So that's why this statement is false. The international Fisher effect states that the expected changes in the spot rate is equal to the expected difference in inflation rates, not just because of inflation rate, also because of interest rates. So this statement is also false. Statement C, forward exchange rates reflects interest rate parity. Yes, this statement is correct. Remember interest rate parity theorem, that is your IRPT. In IRPT, what were you calculating? You were calculating the current forward rate, right? In our purchasing power parity theorem, we used to calculate the future spot rate. In IRPT, we calculate the current forward rate. So forward exchange rates reflect interest rate parity. So this statement is true. Last statement, purchasing power parity relates exchange rates at long-term interest rates. No, it is your inflation rates, not the interest rate. So this statement is also false. So the correct answer would be option C. Okay. Then comes your last question. In relation to foreign currency risk, which of the following statement is or are correct? So when two statements also can be correct or only one statement could be correct. They're saying economic risk is an exchange rate risk that can be avoided by operating in domestic markets only. This statement is false. What is the meaning of economic risk? Economic risk is a risk that is there because of macroeconomic conditions like inflation, changes in the rules and regulations, so many other external factors, right? So it doesn't mean that if you're doing business only in your country or you don't have economic risk. No. So they're saying that you can avoid it if you're doing it only in your country. No, you cannot avoid it because it is going to affect everyone. You do it in your country or other country. Inflation is there in your country also, other countries also. So this statement is false. Exchange rate risk arises because of changes in exchange rates that have not been added. Yes, that's the thing that we're discussing in foreign exchange risk, right? The reason why there is changes in the cash flow is because of the continuous fluctuations in the exchange rates because of the uncertainty. So statement 2 is correct. So the correct answer would be B. That is 2 only. Okay, guys. So that was a full-fledged discussion about the examiner's report. A very, very important exercise that you have to do at least 1 week prior to the exam. Take up 2 or 3 examiner reports, especially for your section A and B questions, so that you know where are the things that you can probably go wrong. So in this way, it is a revision, not just about your past exam papers, but also the fact that you are, understanding where you could probably go wrong, right? So they say, no, prevention is better than cure. So that's why please make sure that you make use of examiner's report. So that was all about your examiner's report. I'll end the class over here. In the next class, we will look how a real FM exam looks like and how to go about it, what should be the approach and all of that. Okay. So I'll see you guys in the next class. Until then, I want everybody to, keep these resources ready. They're available for free, guys, in your ACCA. Your professional body is giving all these resources for free. So please make use of it. Download it and keep it. The past exam papers, the examiner's report, all of it. And make sure that in a day, at least 1 hour you spend on picking up these papers and reports. All right. So yeah, I'll see you guys in the next class. Till then, keep revising and keep practicing. And I wish you guys all the very best. Bye-bye. Hi everyone, welcome back to ACCA FM Rapid Revision. I think this is the last time I'm going to say because this is our last class on the revision session. So today we're not going to solve any problem as such, but then we are going to understand the entire computer-based exam, how it looks like, what are the important resources that you have to pay attention to, which you cannot afford to ignore. Okay, so we all know that these professional qualifications, they have a professional body, right? Like how we have in India for CA, we have ICAI. Similarly, for CMA, we have IMA. So every professional qualification will have a professional body. There will be a dedicated website for it, correct? So similarly, for ACCA, okay, we have a professional body. I hope everybody has visited that website, but the support that you get from the professional body when it comes to ACCA qualification is immense, okay? The type of resources that you have to prepare for your exam, there are too many resources and it is so useful, right? Because sometimes you'll have a lot of resources, but you would not know how to approach it and where is it available. So I'm going to discuss all those points today. All right. So today's agenda is going to be where I'm going to talk about these resources, how useful these resources are, and then we're going to look like how a computer-based exam is, a real-life ACCA FM exam, how it looks like. And then finally, I'm going to give you guys some tips and tricks to clear the FM exam. All right, guys. So let's visit the ACCA Global website. I'm sure you guys have been there because you all have registered. Right, at this point in time, I hope everybody has registered, because in order to write the exam, you need to be registered with the ACCA, correct? So let me share my screen. I'm sure the screen is not new to all of you. You all have visited this website earlier. And as I mentioned, that the support that the website gives you is immense, but most of the students are not aware as to how to access these resources. So it's very simple. All you have to do is go to students, right? This is a free website, and the best part is everything is available for free, right? So you just have to go to students, study support resources. So if you click over here and come down, you will get ACCA. You have to choose ACCA qualification because we're all doing ACCA, right? And the support you get for all the subjects. Okay, but since I am picking up FM, I will focus on FM. So you can choose FM. I think I've shown you guys how to get here earlier also. So these are the exam resources that you have. And trust me, guys, they've supported you so much, right from how to plan your studies, what is all FM all about, what is the syllabus, then how to learn, how to revise the concepts, then the examiner's report. You all are aware of what examiner's reports are. In the previous session itself, we had a detailed discussion about examiner's report, correct? Wherein we solved questions, the areas where students can probably go wrong. Correct? Only those cream questions, we took them and we solved. So we've already discussed about examiner's report, and we've already discussed about past exam and question practice, correct? We've done a lot of past exam papers. We took papers from 2020, 2021, and we did the section C problems, section A, B, and C. So we've done that as well in our revision session. So apart from that, I would like to draw your attention to one more important resource, that is your technical articles. Most of the students, they ignore technical articles, but please don't ignore technical articles, because these articles, let me show you guys what technical articles are. Okay, so if you come here, you know that these are the topics that are addressed in ACCA FM, right? We saw about working capital, investment appraisal, business finance, business valuation, risk management techniques. All these are the concepts that we have discussed in ACCA FM classes and in the revision session. So these technical articles are actually written by the examiner themselves. The one who corrects your paper, no? They write these technical articles. Now, why should we read technical articles? Because we all know that these professional qualifications, you take any professional qualification, CA, ACCA, CMA, CPA, concept clarity is very, very important. Not like our normal exams where previous day we study and then we go and write it and still we'll be able to clear. It doesn't work that way. Professional qualifications mein concept clarity is extremely important. And with the help of technical articles, you guys are in a position to understand the concept in a better way. Okay, let me show you guys an example. So if you see over here, discuss the purpose and role of financial management function. There is a technical article over here, correct? Then there is again, assess and discuss the impact of economic environment on financial management. Your chapter 11, where we have discussed about fiscal policy, monetary policy, exchange rate policy, so many policies, right? So there is a exclusive topic just on the macroeconomic environment. Okay, where they have, you can see over here, several areas of financial management where is the, Like, what is the implicit annual interest rate in this transaction to the nearest 0.01? So they've given the alternative methods as to how this particular problem can be solved. Correct? They've told a company has agreed to sell $10 million of treasury bills for 9.6 million and will buy back them in 50 days for 9.65. And this is the interest rate. So they have shown how it actually works, and it is explained in a very nice way. So that's one example of a technical article. Okay, apart from that, I will show you guys a theory topic technical article where you will get a lot of concept clarity. For example, your working capital management. We've already seen that in a 20-mark question, right? When you address a 20-mark question, it won't be completely practical. It'll be a combination of practical and theory, right? So if you see here, they have explained about what is the importance of working capital management. Now, you might say that we already know about it, but here they give you that extra pointers which you can use in your answers in section C. Okay, we all know it is the capital that is required for day-to-day operating activities. It's your current assets minus current liabilities. We are aware of it. But look at, as you go ahead with the paragraphs, you'll get extra information about the topic which can make your answer look attractive, right? Because ultimately, what is our objective? To impress the examiner. Because if we impress the examiner, our marks will increase and we will clear the exam, right? So here they have given you good pointers, so you can use technical articles to make good points. Okay. For example, extending the credit period offered to customers can lead to additional sales, but at the same time, company's cash position will fall due to longer wait for the customers to pay. See, this is all what we've already discussed. That is liquidity, profitability, trade-off, and all of that. So you can use these technical articles during your revision phase, right? When you're doing your revision, you can read them so that your concept becomes super clear, right? It has to get registered here. So while you are doing your classes, you will anyways learn once. Then during the revision phase, when you read more about the concepts, it's just going to get stronger, because ultimately the stronger your concepts are, you are in a better position to tackle the MCQs, tackle the constructed response questions, and also these are carry forward to your P-level papers, right? Of course, if not working capital, there are other topics like investment appraisal, risk management, business finance, business valuations, which will again be tested in your AFM, that is your advanced financial management paper. So that's why with the help of technical articles, you have to make your concepts even more strong, right? Then again, talking about the objectives of working capital. Right here also they have discussed about the liquidity versus profitability trade-off. This is a very, very common question asked in most of the ACCA past exam papers. That is the liquidity and profitability trade-off of your current assets. That it could be how much time I should give my customer. Should I give too much time? Should I give too less time? Should I keep too much inventory or should I keep too less inventory? So this liquidity versus profitability trade-off has been beautifully explained over here. Right? So that is one topic. And then this over trading and over capitalization. This is also a topic which has continuously been tested in the exams. And what they say is what the examiner writes in technical article, no, very likely that topic will be tested in the exam. Okay, so that's why a week prior to your exam, you should make sure that you have read all the technical articles. Instead of, junk scrolling on Instagram or whatever, why don't you open this website and start reading the technical articles, correct? Maybe you're lying on the sofa or you're just simply, you're with your phone in your break time. Just give it a read, okay? Because this is definitely going to help you guys. So similarly about the liquidity ratios, efficiency ratios, what is a cash operating cycle? Then, you'll get that extra. What are the factors? Now, this also is a question which has been continuously tested in past papers. That they'll ask you to calculate the cash operating cycle. Then again, they will ask you what are the factors that affect the cash operating cycle? Why does it take a longer time for me to get my cash back once it goes out from me? So It could be because of the nature of the business. It could be because of the industry norms, power of suppliers. So when you read them, no, they have explained it in a very simple way, not like, very heavy words. See, for example, a supermarket chain may have low inventory days because immediately they make the food, they sell it. They make the food, they sell it, right? But what about some other construction company? In a construction company, it takes a lot of time, correct? So there the operating cycle might be very, it might take a lot of time, correct? And investment in working capital also might be higher. So these are the reasons which will affect the cash operating cycle. So they've explained it really nice. And we all know that as accountants, our job is not just to calculate the ratios, but also to interpret those ratios, correct? So the interpretation part also has been done really nice through technical articles. They take a particular problem and based on the problem, they have interpreted or evaluated and passed the comments. And then they give a conclusion also. So if you see over here, they expect you to know. The financial management syllabus also demands detailed knowledge of specific models and techniques of each component of working capital, because right from your chapter 7 to 10, right? Chapter 7, 8, 9, 10 is all about working capital management. So it's a major chunk of your ACCA FM syllabus, which you cannot ignore for sure. So that's why please do give it a read. Okay, don't miss the technical articles. I'll show you guys some more technical articles. And if you see over here, not just that, real life reference also they give you. You know PwC, right? All of you want to join the Big Four once you become qualified. So they're also working capital. So they also give you the practical touch of the topic. How PwC is managing, what is driving its working capital, everything, financial performance. So if you guys have time, you all can definitely give it a read so that you understand how working capital management works in the real life scenario. So they've made it really interesting through pictures and everything so that you all don't get bored. But unfortunately, still people don't read it. But yeah, so this is the trends, through graphs and pictures and animations, they've made it really nice. So please do give it a read if possible. Okay, so that is about your technical article. So if you can see over here, Mike Ashworth, a subject matter expert in financial management itself, has written this article, correct? So probably that person only might correct your paper also. So if you use the same words, the same lines, they will know that you have gone through the technical article. They will know that you are strong with your concept, and there are chances that you get a higher, and the percentage of you clearing the exam increases. Similarly, certain topics like risk management and business finance or your capital asset pricing model, CAPM, it's a bit dicey concept, right? First time when we see, it will take time to digest these topics. So for such topics, at least, I would highly recommend you all to give it a read, correct? So if you see, for risk management, about your foreign currency risk or hedging technique, all these are explained really nicely. Like what are the causes of interest rate risk, then the traditional and basic approaches. So these are the problems that you can probably, they might be tested in the exam as a theory for 6 marks or for 5 marks in a 20-mark question. They might split. So that's why for more concept clarity, I would highly recommend you all to give it a read. Okay. So in your revision session, whenever you all are revising, for one day, you can exclusively keep it for reading of technical articles, or you can split this way that, every day I'm going to do 2 technical articles, and thereby you can cover all the technical articles. So any ACCA rank holder, if you ask, they will definitely not skip the technical article. 1 or 2 technical articles, they will definitely read it. So major of the concepts of, I think almost all the concepts of FM technical article is available. So if you see, there are about 6 areas, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24 topics. Okay, you have 24 topics to be discussed, right? Or to be read. Not a big thing, guys. 24 topics, you can at least do one topic a day if it's too much, right? Just take one topic a day, read it. Whenever, let's say today you decide to revise investment decisions. So you take the topic investment decisions, you do past exam papers, you do your exam kit problems, all of that, and then you read a technical article, or you first read the technical article and then start doing your exam kit problems or past exam papers. In this way, the concepts will become really very clear. So especially your technical articles are useful for theory topics because it gives you more insights as to how to approach. So that would be my advice. That is not to ignore the technical articles and include technical articles in the part of your studies. Okay, so you know how to access your technical articles, because these technical articles are those which are written by the examiner themselves, right? It is a library of articles to help you develop broader insight into the subject, split by syllabus section. Okay, all you have to do is go to study support resources and you will find them. Okay, and all of it is available for free, guys. So please do not ignore this. Okay, apart from this, now we know that technical articles are important. If you go down, as I told you, the support that ACCA provides you is immense. Apart from technical articles, there is this exam, FM exam technique resources. So if you click on this, and if you see over here, you will have some additional resources like read the mind of the FM marker, right? And there are 3 articles, 3 resources, which I would want to cover it in this session so that you guys are aware of, where to take care and where to, pay attention to all those things. So let me start with this. Okay, it's already open. So read the mind of FM marker. As the name says, the one who is correcting your paper, you have to read their mind, it seems. How will you read? They have only given you a PDF, correct? So normally students, they ask me, ma'am, how is the correction done? Is it strict? How, it's like, where should I focus? Where, how should I present my answers? So today we are going to address all those questions. That is, for a constructed response question, what should be your approach? And all those doubts relating to, will I get marks, if I write it this way? Let's answer that, okay? So if you can see here, specifically, I am the member of the team who will mark FM. That is the one who is going to correct your paper, no? They have only written this article. So this article is designed to give you, that is the candidate, the student, an insight into my mind so that you can better understand what a marker will be looking for when it comes to marking your FM paper. Okay, so here with the help of this article, they are going to tell you, they've chosen certain questions. The article uses 2 candidates' answers, 2 students' answers they have taken. Of course, they'll not mention who is that student. They've taken and they've told how to approach it. So let's have a look at it now. All right. So if you see over here, this was one of the question that was tested. One second. Yeah. So this was a question that was tested in the past exam paper, which was asked for 20 marks. Section C is for 20 marks, right? Wherein they have told, I think now it's clear. Yeah. Where they asked to calculate the NPV of the investment project. It's very important. Then the discounted payback and the financial acceptability. So these were the questions. Now, look at the words that they use. Critically discuss. Okay, here they've just used discuss the financial acceptability. Here they've used critically discuss. So all these things have to be kept in mind. That is what they are saying. So first thing to note that calculations are worth a maximum of 11 marks. How? Because they are asking calculate NPV and calculate the discounted payback. So 11 marks is just for practical, right? And here they are only saying it's very easy to make mistakes in calculations, right? Because it is very important to answer the discursive. Discursive means practical questions to be confident about earning a pass mark. And in B part of it, it is more like a theory because they're asking discuss the financial acceptability of the project. Now this discuss the financial acceptability of the project will depend on what answer you got, correct? So for 3 marks, it has to be wherein you have to say that you have to give a conclusion wherein NPV is positive, therefore accept, right? So which prompts for 3 marks there has to be. So they're saying when they're asking it for 3 marks, okay, just writing for 3 marks, there has to be more to say than NPV is positive, therefore as well. So normally what will happen? Student will calculate the NPV and then discuss the financial acceptability of the project. When it is asked for 3 marks, a student will just write, since NPV is positive, accept the project, right? But what is the examiner saying? He's saying for 3 marks, there has to be more to say about the NPV. What about the acceptability of the project according to the second criteria, that is discounted payback? According to NPV, yes, you have to accept the project. But what about if you're using a discounted payback? Then what would be your answer? All those things also you have to mention. So does it give the same answer? Maybe if you're using NPV method, it is saying accept the project. But if you're using payback method, not necessary that you have to accept the project because they'll give you a target. You have to check whether you're meeting the target. So that has to be very clearly mentioned. So that is what they're trying to say in the B part of the question. For 3 marks, not 1 line, at least 3 lines. Okay. Then if you look at so that was just discussed. Now they're saying critically discuss the views of the directors on the investment appraisal. So now they're using the word critical. So when they ask critical, it has to be detailed, correct? Because pay attention to these extra words. So it is not possible to start answering this without identifying these views which are clearly stated in the last paragraph scenario which says the views. So here also they're giving you an insight as to how you have to address this area, correct? So therefore 6 marks, then they're saying 6 marks, you should aim for 2 marks of relevant comments for each issue. So there could be various issues, right? So each issue 2 marks. Ignoring any of the views would immediately restrict the marks available. So for critical discussion, the answer need to focus on the negative aspects of the director use. So you can't just write positive because they've used the word critical, right? So when there is this word critical use, you can say some negative aspects also. Maybe the director, what he's thinking about this project might be wrong. So that can also be put forward in your answer. So this way you will know how to attempt. Okay. So moving ahead, that was one part of it, how to read and write the answer and how much to write. Because normally students ask me, ma'am, for 3 marks, how much I should write? For 6 marks, how much I should write? So for that, my answer would be check the situation, check the scenario, and based on that scenario, you give a calculated guess as to how much in each issue. Like for example, in the previous example that we took, there were 4 issues. So for 4 issues, each issue 2 marks. And you have to address it that way. Then if you see over here, they're saying, if you look at this is how an NPV problem is solved, right? Where, certain things is correct, but certain things are not correct. For example, a student, this is one sample answer which they are showing, okay, of a candidate. And they're telling how they're given marks. So whatever is in the red, that is probably wrong. But whatever is in the other color, it is correct. So how they're going to give the marks? So they've given 8 out of 9 over here. And then over here, okay, let's read the notes for better clarity. The views of the directors that all investment projects must be evaluated over years of operation is a very safe view. However, this approach may have its disadvantages by looking at, okay, I want to show you guys. Okay, 2 out of 6. So this student has received 11 out of 20 for the answers. So you know that, right? A part of the answer, they had asked to calculate the NPV, which the student has calculated and has provided the working note also. Second part of the question, they asked them to calculate the discounted payback, but I guess the discounted payback is calculated incorrectly. So that's why there was no marks given to the student. How much was the score for discounted payback? I guess it was about, 2 marks was given for discounted payback. But since the student has not answered the question properly, you have not got the, where is it? Yeah. So that's why 0 marks. And then they have given how much? See, it was asked for 3 marks, talking about the financial acceptability of the project. And the examiner has given just 1 mark out of 3. Why? Because they've just written since NPV is positive, it should be accepted. What about the discounted payback part? That has not been addressed. Hence, marks has not been given. So, they're saying on what basis they have given the marks. Why they've given 0 here. Why they've given 1 mark over there. So, these are the things that you can give it a check. See here, this is the last part of the question where the views. For this view, they've given 1. But for this view, they've given 0. They're not happy with the answer, right? It was asked for how much marks? The views. The views, the C part of the question, if you notice, was asked for 6 marks, correct? And out of 6 marks, how much did the candidate get? Out of 6 marks, the candidate has got only 2 marks. For each view, 2 marks was awarded, right? But then for this particular view, the examiner was not satisfied with the answer and thus 0. Then here they've given 1 mark for certain things. And here they have again given 0 because it does not justify. So that's why 2 marks over here, and then again here they've scored some, and that's how the student has scored out of 20, 11 marks. So this is one of the examples where I showed you guys how they are correcting the paper. That was of 1 candidate. Now, if you look at this candidate, how much this candidate has got? 6 out of 9 when it comes to calculation of NPV. Then also payback period also has been calculated properly. So they've given 1 mark out of 2. Why have they deducted the marks? Maybe because there has been a slight mistake. So, so they've given just 1 mark. And then what about the profitability? The project is acceptable according to the 2 preferred appraisal methods. So they haven't given, they've given 1 mark over here. They've given 2 out of 3, right? If you see, they've given 2 out of 3 because the student has mentioned about the NPV part also and the discounted payback also. So that's the reason they have awarded 2 out of 3. Then when it comes to the views, the student has not got any marks because this is not sufficient for 6 marks, correct? And even the student has not addressed the views about the directors. It is very general, the answer. And that is why no marks has been awarded. So total out of 20, the student has scored just 9 in section C. So I hope everybody has got an idea as to how to read the mind of the marker, right? So they've given you 2 sample answers and they've told how, each answer, you can see how much marks they have given and how much, where things were ignored. Like, for example, 1 mark was available for inflated sales amount. Only half a mark has been given because year 1 amount is incorrect, right? The ones which were shown in red. It's just that in the read the mind of the marker, they've also told why they have deducted the marks, correct? So you as a student, before writing the ACCA FM exam, if you go through this, you will know where to pay attention to, how much to write, correct? They've said 2 marks were available and have been awarded for variable cost. Then regarding the payback part, if you see, what have they told? This was all about, okay. Yeah. So if you see over here, the candidate has rewarded with nearly full marks. The illustrates to show important points in the exam technique. A clear layout is important so that the marker can follow your steps. If you're written in a very haphazard manner, how can the marker give you marks? So that should be very clear. And if you spot an earlier error, when you later review your answer, it is probably not worth trying to remedy. So both the marks available for this part were essentially, if there is any absence of working, if you have calculated just in your calculator and written, but you have not shown the working, if there are no working notes, then how can they give you marks? So no marks can be awarded for anything other than the correct answer. For example, 2.7 years or 2 years was the correct answer. Even for a 2-mark part question, it is still good exam technique to show all working, so a marker can give appropriate credit. Because look at the line over here. It is not the task of the marker to rework a candidate's answer, right? Marker is just there to correct your paper. So that's the reason some places you've not got the candidate has not got the marks. So with learning from someone's mistake, we can know now where we can be safe. Like for example, we would end up writing just 1 line, but 1 line for 3 marks question is also not enough. You have to give more information to it, right? And when they use the word critically discussed, that time you have to mention little extra points regarding the views of the director. See, 1 mark is given for the final point made here, although it is not just the possible rejection of a project that is an issue. So this is a detailed analysis of a particular student's answer, and they have picked these 2 candidates because most of the students' answers must have been like this itself. Tomorrow if you write your exam, your answer might also be like this. So you will know exactly how much marks you're going to get, because normally students are very curious after the exam. They come home and they check, okay, for this question I might get so much, for this question I might get so much, and then they sort of make a list, tentative, itna milega karke. So that's why if you go through this, read the mind of the FM marker, you'll get a detailed analysis of how to write your answer and where the examiner is planning to give you the marks. So this also, please do give it a read, because it helps you understand the, how to present your answer and things like that. Correct? So they had taken 2 candidates' answer, and you saw that one student got 11 out of 20 and another student got 9 out of 20. You can compare those 2 answers and see where things can go wrong. So that was one section C question. Again, so examiner itself is providing you this PDF and he's saying, fulfill your potential and gain the necessary marks to pass. They are clearly saying what they expect. So please meet their expectations so that you can clear the exam. So this was one of the important resource that I wanted to show you guys. Please make use of it. Next up, we have how to attempt discursive requirements in financial management. So when I say discursive, it's your section C questions, where I'm talking about your practical questions, wherein you have to solve, right? You will have 2 questions carrying 20 marks each. So a lot of students, they are a bit, confused as to how to start the answer. Because all these exam techniques, they really help. How you present your answer. If they use the word evaluate, what is expected? If they use the word calculate, what is expected? If they use the word discuss, what is the expectation of the answer? If they use the word critically discuss, then how should you write the answer? So here you can only see it has been noted in number of examiner reports. I showed you guys, where, requirements are answered better than discursive requirements. Therefore, this article will look at how to answer a discursive requirements in a question. For example, the same question, that NPV question only we'll see. What are they asking? Critically discuss the views of directors on Pelta company's investment appraisal. So, the points to be noted over here, they've used the word critically discuss about the views of the directors about the investment appraisal. So, break down the requirement of the question so that you clearly know what to answer, right? So, if you see one of the candidate, when we analyze the answer, did not talk about the views at all, just spoke about the project. And that's why that candidate got 0 marks. Because question is something else, answer is something else. There is so much gap. So that's why to consider how to answer any question, what should the candidate do? Should first consider the verb used, right? What is the verb that they are using? Are they using calculate? Are they using evaluate? Are they using discuss? Or are they using critically discuss? So all these things have to be taken care. So this means that they should consider, when they say critically discuss, it's a debate or an argue or advantages, pros and cons on the issue, referring where appropriate to relevant financial management theory, right? They need to review the question scenario, and the views of the directors of Pelta company are that all investment projects must be evaluated over 4 years of operation with an assumed terminal value of the end. Okay, all those things they've given. Then there were views of the directors, where they said that the evaluation period, the assumed terminal value that is at the end of the project, and the use of the discounted payback alongside. They're using two methods. One is NPV and one is discounted payback. So here an answer will need to discuss all these 3 points. Okay, in your answer you have to include these 3 things in order to get full marks for this requirement. And to answer this question, each of these views should be taken in turn with a discussion of what it means for the investment appraisal. Why is it good or bad? Not just telling the good things. Why is it bad? Because they are talking about critically discuss. And now they're going to show you how you could have answered this question. Okay, it's not just they're just saying that you should write it like this. They'll also show you how it is. So you can see over here. Let me zoom this. So they're showing you the answer makes 2 distinct points and would attract both of the available marks, showing that a short focused answer can gain relevant marks in full. A less developed answer, such as the following, would receive 1 or 2 marks. See, by only considering 4 years of the project. Okay, where is it? Yeah. See, one student has written by only considering 4 years of the project, some of the cash flows are excluded and the NPV is inaccurate. Now, this is a very less developed answer. Okay. Now, more weaker than this is a 4-year appraisal period is shorter than the length of the project. It is very weak. They are only saying such answers are not entertained. So please don't write answers like this. Then this does not say what the implication of 4-year time horizon is. See, it's very blank. It is not crisp. It is not allowing a user. See, why do we prepare financial statements? So that we can, so that the decision making is done, right? So such answers is not clearly giving us any information. And that's why they say this is a weak answer or it is a less developed answer. Correct? So a different type of answer which some students might provide is a bullet point, which does not contain full sentences. 4-year doesn't consider all cash flows. Terminal cash flow is an estimate. Now, this also does not address the question requirement, right? And that's why you would not get marks for this also. where they're asking you to discuss. If you write a bullet point, how can you get it? How can you get marks? So that's how they're saying that such answers are not entertained and you wouldn't get full marks for it. Similarly, they're showing you, how a developed answer would look like, and they've taken so many examples to make you guys understand what they expect. See, an example of good attempt would be like this. This is how they expect. They're not just showing weak response, they're also showing what is a good response, right? So please do have a look at it so that you can again match to their expectations, correct? So this is written by a member of financial management examination team. The one who corrects your paper itself is telling you how you should structure your answer so that you get full marks. See, marks though they will give you, but do you want 50% of the marks or do you want 100% of the marks? If it's a 20 marks question, you at least need 15 above. If you write weak answers or less developed answers, you will end up getting 9, 10. And you can't afford to, get so low because these exams are quite expensive. So you have to make sure that you are getting majority of it. Okay, so that was about the question which is answering how to attempt discursive requirements in financial management. If they ask calculate, calculation should be there, working note should be there. If they ask discuss, 3 or 4 lines. If they ask critically discuss, talk about the pros and cons. So these things you have to keep in mind. So that was another thing in our discussion. Okay. Apart from that, let's now talk about the next part, that is objective questions. So we all know what is the format of ACCA paper, right? The first class of our revision session also, I told you guys, how does the format look like? It is a 100-mark paper where you have 15 questions carrying 2 marks each. That is your section A. Section B, where you will be given 3 scenarios and each scenario carries 5 marks, 5 questions carrying 2 marks each. So again, 30 marks. So 30, 30, 60 marks. And then section C, where you have 2 questions carrying 20 marks each, 40. So 30, 30 and 40. So 100 marks. So do you observe that 60 marks is your objective test question? Out of 100 marks, you have section A, B and C. This is 30, this is 30 and this is 40. So A and B are basically your objective test questions. And they carry 60 marks. You can either get full marks or you can lose entire thing. So that's why we have to be very careful when it comes to your MCQs. Now, when they say objective test questions, I'm sure you all know what are objective test questions, right? The ones who are not aware of, it could be a multiple choice questions, or it could be a fill in the blank or multiple response. So you need to be aware that it can be in any form. Just give me a second, guys. Just go through the types of objective test questions. I'll be right back. Okay. So we know that an objective test question might not be just an MCQ, okay, where they ask you a question and ABCD. It could be multiple response where they answer any 2 of, like, the option might be choose any 2 statements which are correct. So that is multiple response. Or it could be a fill in the blanks where they're giving you the scenario and then you just have to fill in the blank, or you have to type the answer. You have seen, no? We have done in the classes also, where they give you this box and there'll be the dollar symbol and million. You just have to write 13 million or 14 million. So that's like fill in the blank. Then there'll be situations where you have to drag and drop. Like, it's like a match the following. This is this is this. So that is drag and drop. Then there could be drop down list wherein, they will show you, there'll be a question and then you have to choose. A drop down list will come. In that, you will have to choose. So similarly, these are the types of question you can expect. And what are they asking? Where do I record my answers to objective? So a lot of students have asked me this question. You can see that it must be recorded on screen following the instruction. I will show you guys how these questions look like. As I told you guys, I'll be showing you guys how a computer-based exam looks like. So in that, you will come across all these things that we discussed: drag and drop, fill in the blanks, MCQ. So to answer, so it will be easily available in the exam itself on the screen. You just have to follow the instruction. And when it's a constructed response question, that is, they'll give you a Excel sheet or they'll give you the Word file so that you can write the answer. Correct? The question will be on the left hand side and the solving you can do it on the right hand side. So this also I will show you guys. It's a split screen. I'll show you how it looks like. Okay. Then the next question is for objective test questions. Do we need to show our workings? Of course not, guys. It's an MCQ or it's a these are frequently asked questions from the students. You don't have to show the working because it's just choosing or it is just fill in the blanks or it's just drag and drop. So you don't have to show the workings as you need to perform some calculations to arrive at your answer, but you will do those calculations in your rough sheet, or there will be something called a scratch pad in your main ACCA exam. It is like a working note for you. Nobody is going to see that scratch pad. So that is just for your reference in case you don't have a rough sheet. So therefore, for constructed response question, remember that whatever you write in your scratch pad, nobody can see it. Examiner cannot see it. So your working note must be there in the main sheet itself. Anything you want the marker to see must be recorded using the spreadsheet or word processing and not in the scratch pad. Okay, scratch pad is a rough sheet. Will we be given scrap paper for workings? Yes, if you're writing center exams, that is if you're going, a scrap paper will be provided in the exam center for workings or notes. However, this will not be marked because that is not what you're submitting. I hope you guys know it. It is a rough paper. If it's a remote exam, then for security purpose, no scrap paper. And remote means if you're writing it from your house itself. To make notes during the exam, you can use the digital scratch pad. So that time, if you use writing your exam reportly, you can't use an extra sheet of paper like this and do it. You have to use the main, what is that, on-screen scratch pad itself. Will we be given marks for workings for OTs, or is it simply just right or wrong? So it is simply just right or wrong. The correct answer will score 2 marks and an incorrect answer will score 0. Partial marks are not awarded. For example, they'll say, choose any 2 answers which are correct. You know that option A is like they'll give you A, B, C, D, E, F, and you have to say which 2 statements are correct. You know for sure that A is correct, but you're not sure of the next one. So you can't just choose A and expect to get 1 mark because it's of 2 marks, no? So either you have to choose both or you will get 0. I hope this is clear. So for partial, you won't get marks. You will get, because all these objective type questions are of 2 marks. So either you'll get full 2 marks or 0. There is no in between. There is no half marks and all of that. Do we lose marks for incorrect answers to OTs? Yes, if your answer is incorrect, why will they give you marks? They won't score the 2 marks for that question. But you will not be penalized further. This means there is nothing to be gained by leaving an OT unanswered. If you're stuck on a question, then you have to give an educated guess or a best guess, right? Or you can use the flag for review button. I'll tell you all how to use that flag for review button when we look at a computer-based exam. Then they're asking, can an answer to an individual question in an OT case be dependent on another answer? No, each group of 5 questions will be based on a common scenario and each question is carefully devised to ensure that there are no dependency between individual questions. So it's not connected. Like if your So you all know, right, how a section B question looks like. There is a scenario, and based on that scenario, 5 questions. So all these questions carries 2 marks each. So they are not, it's like if your question number 1 is wrong, it is not interconnected. These are separate. So you don't have to worry about it. So if you've answered your question number 1, then that's not going to affect your question number 2. Next question, how will an OT question be presented? You know that you have a splitter bar. For each OT question, the common scenario will be shown on the left-hand side because that's a scenario. And based on that scenario, you will have the questions on the right-hand side. What is a splitter bar? How it looks like? I will be showing you guys in a few minutes. Can answers to OTs be changed? Yes, you can change it because it's an exam. So you felt like option C is the right answer. But then after doing calculation, you realize it is option D. You can change it. It's not that once you click, it's done. No, you can change it. Simply clicking on alternative, you will automatically change your selection. Then should I start with OT? So some students, ask me, ma'am, should we start from section C because it's 20 marks, or should I start with objective test questions? Now this again depends on personal preference. You must ensure that you practice your exam technique in advance. It's not that on the exam day you start experimenting. No, you have to take up your mocks. Mock exams are very, very important. Only if you're confident about taking your objective test questions, you might want to work through all of these before starting your constructed response. But if you're confident about tackling the constructed response, you may prefer to start with these. So it is up to you. Okay, it's not like it goes in an order wise. I'll again show you guys. It's totally up to the student whether they want to start from section C or section A or section B, because there is something called as navigator in your main exam. Can the OTs be on any area of the syllabus? Yes, any areas. It can come from chapter 1 to chapter 20, right? I told you guys that, of course, working capital management, investment appraisal, they're supposed to be important chapters, but you can expect questions from other areas of the syllabus in your section B. Are there examples of OTs available? Yes, there are so many in the ACCA website. There are past exam papers, there are examiners report, and so many support as I showed you guys. You can please access them. So yeah, these are the general questions that were asked in with respect to objective test questions. So I hope everybody now is in a position to understand the entire how to answer your questions, how to, to know what goes into your, what goes into the mind of the marker, what are they expecting, then how to present your answer, and the frequently asked questions when it comes to objective test questions. All of that is, I believe, it's clear. Okay, so going ahead with the concept, as I told you, technical articles, examiner's report, then read the mind of the marker. All these are additional support that you get from your professional body. So please don't ignore them. All right. So next up, I want to show you guys how the real ACCA FM exam is going to look like. So once you have registered with your ACCA, you'll have your My ACCA account, right? You can log in, and through that, if you go to your profile, you will be able to take up the mock exams, which is there. So I'll show you guys how an actual ACCA exam looks like. So this is a specimen exam. What is it? It's like a mock exam. This is exactly how your ACCA FM exam is going to be. The interface I'm saying. So most of the time students fail to take up mock exams, or students will not, open this, which is again available once you register. You will get this page, right? You can go because see, imagine on the exam day only you see the interface. It's going to scare you, right? Because you've been practicing at home and it is very different, and suddenly you see a new interface, you are not very comfortable. So that is why, to make it so comfortable for you guys, ACCA has given the specimen. So, there is section A, which carries 15 marks, 2 marks each, and how much is it? It carries a total of 20. So there is flag for review, navigator, and next. So if I click next, the exam is going to start. So you can see this is your first question. Now let's say the first question only was of risk management and you are all panicky. You don't know the answer because you're under exam pressure. So what do? You want to do this question, but not now, maybe a bit later. So if that is the case, you have the option to, whenever you feel like coming to this question a bit later, don't blindly, go to the next question. You choose any answer like this, okay, and make use of this feature called flag for review, okay. So I'm going to flag this question. What do you mean by flagging the question? Right now, you don't want to take up this question. You want to come to this question a little later and do it. So that's the reason you're flagging this question, all right. And then you go to next. And then you get another question, which is, what is sensitivity of the NPV to change in the sales volume? Whenever they are sales volume, you should take contribution. So NPV divided by contribution, that would be your answer. So you're very confident. You'll give one random answer and then you'll go next. Now see, this is the question on drag and drop. It's an objective test question. Can you see where you have to drag it? Drag and you have to drop it like this. One example of drag and drop. I am randomly doing the answers, guys, just to show you guys how it looks like. Now, this is a normal question where they're asking on capital structure theory, Modigliani and Miller. It's a very important concept. Please don't skip that. This is also very simple. You just have to choose, right? So every time, please choose an answer only, go to next, even if you're not sure about it. The reason I say this is because there are no negative marks. So if there are no negative marks, what is the harm in choosing? What if your, guesswork is right? So that's why please don't leave any question. That's one thing. Now this is multiple response question. We saw what is drag and drop. We saw a normal objective MCQ. Now this is which two of the following statements are features of money market instrument. So they're asking which two. So you have to choose two things. Now you know for a sure that you're confident about one thing. Okay, but you're not sure about this one, and if you go next, you'll get 0. When they say which two statements are features, you have to choose 2. Clear? So you have to choose any 2 and go ahead with the answer. If you choose one, you don't think that you'll get 1 mark. No, you have to choose 2 to get full 2 marks. Otherwise, you'll get 0. Then, okay, this is a normal question where they're asking operational gearing. You just have to apply the formula. Choose an answer only and then go next. Don't leave. Now see, this is a question like fill in the blanks, where they're asking you to calculate the annual finance cost savings if management reduces the collection period to 60 days. So here you will have to type your answer. Got it? So if you choose a letter, it will say the input does not match. You have to put a number itself. So some random number I will put it. Then again, I'll go next. So we saw a drag and drop question. We saw fill in the blank question. Then we saw multiple response question. Now here, see, you just have to choose like this, true or false. Correct? That's one more type of objective test question. Then this is again a normal question, normal MCQ. A normal MCQ. So in this way, see, this is a question where you have to write your length of working capital cycle, where you have to type your answer. So this is the way you are going to attempt the question, right? Then you have to choose multiple choice. Now let's say 15 questions are done. Okay, you've randomly chosen questions. Now which 2? So randomly I'll choose 2 and then I'll go next. This is my last question in section A, right? Where you have to choose which 2 of the following targets predominate to monetary policy. So here also you will just choose an answer, then go next. So your section A is done. Okay, so now let's say you want probably, so your section A is done, right? So let's say you want to now do section C and then come to section B. If that is your strategy, how will you go to section C? Will you go on clicking next till, 15 questions? That is so much, it's so much of waste of time, right? So what you have to do in such a scenario, there is an option called as navigator. With the help of navigator, you will directly go to section C. Let me show you guys. Okay, so as I said, now you're done with section A. You don't want to do section B. Instead, you want to do section C. So what will you do? You will go choose navigator. And in this navigator, you directly want to go to section C. So you will choose like this and you will come to section C. Don't be a fool and just, go on clicking next. And that's going to take up a lot of time. Use the feature of navigator. And as I said, this is called as a split screen, where on the left hand side you've been given the scenario, and on the right hand side, if it's a calculation, then you've been given an Excel sheet to solve it. If it is a question, then you will have to type in your answer, and they'll not let you go to the next page until you scroll down and see all the information. Only then you can go to the next screen. Okay, see, now this is briefly discuss. Now this is a question on discussion where they're asking you your advice. So here you will have to type your answer like that. And the scenario will be over here. You have the option to highlight. So while reading the question only, if you see any important points, you can highlight it. So that's one advantage. Correct? Calculator, there is an on-screen calculator for your reference, but I would highly recommend you all to take your calculator and go, because it's better, because it's not very comfortable to calculate on screen. As I told you about the scratch pad, this is for your workings. Whatever you do over here, your examiner cannot see it. So if you want to show any working note, please show it in your main exam itself. Okay, in the main screen itself, not on the scratch pad. So this again is a discussion. So it's a theory question. So they've given you a word format. If it's a problem, then you will get to solve it. See, until I see the next screen, it does not allow me. See, I've not seen the screen completely. So that's why it's not allowing me to go to the next question. Okay. So similarly, this is another question. This is a scenario, and based on that scenario, you've been given the constructed response question. See, only limited. So I would recommend you all to solve it in this FM specimen, because in the normal Excel sheet, you will have all the features, no? But in the exam Excel sheet, these are the only features that is available to you. Okay. So please ensure that you practice in your section C, in the ACCA proper website. You have this mock paper which you have to take once you're ready. All right. So in this way, you will attempt your section C question. Okay. Now let's say that you're done with your section C. Correct? And you've attempted all the questions. Now you want to do section B. All right. And what will you do? Again, you will use the feature of navigator, and you will go to a particular question. For example, let's say you have, remember you had, let's say your first question was not very favorable, right? Under pressure, you didn't want to tick up that question. So you thought you will come to it later. So you can use the flag for review option. See, now this question has been flagged, but you want to come to this a little later because you're not finished your section B. So how will you go to your section B? Through your navigator, you will go to section B like this. Okay, and then you see in section B on the left hand side, there is a scenario, and on the right hand side, you have the main exam. I mean the answer. You'll have to choose. Correct? Arrange the following. It's a objective test question. Similarly, if you go next, again, here it's a fill in the blank question where you have to write your answer. Then it could be a normal MCQ. So in this way, you have to solve the answer. Now, the next part is, see, this is a multiple response where you have to choose which two of the following. In this way, you will answer all of this. Let's say you're done with section B also. And now you got reminded of your question which you had flagged. Now, certain questions you should flag it. Why? Because you want to come back to it later. Now, will you go on clicking back till you reach the first question? No, that is foolishness. So here, whatever questions you flagged will be highlighted like this. So I can see the go like this. Okay. See the page and then click on this so that you reach the question. Otherwise, it won't make sense for you again to come to your first question by clicking 100 times the back button. Correct? So this is how your ACCA FM exam looks like. And you will be given this formula table also. Okay. I think in the specimen, yeah, here you can see this. If you look at this, exam instructions will be there and also the formula sheet. You all are very well aware of the formula sheet, your EOQ, your Miller-Orr, which is very important because it's so difficult to remember Miller-Orr formula, right? You can just refer to the formula sheet and apply. Then your CAPM, all these things which we have already discussed. Your weighted average cost of capital, Fisher's formula, Gordon's formula, your present value table, very important. And your annuity table, that is also given to you in the exam. So not to worry. All you have to do is click here and look at the formula sheet. And you will be, you can access it. Okay, so these are some extra information for you to how to, talk about your constructed response, the things that we discussed itself. You can see they are just basically telling what are the features of every key. So you can go through them as well. Now, apart from this, as I told you guys, how your main ACCA FM exam, everything should be complete. Okay. So once you're done with the exam, open, let's say you have some 5 minutes remaining. Open the navigator and check whether everything is complete. Okay, there shouldn't be anything like unseen or incomplete, right? You have to ensure that all the 30 questions, all the 36 questions have been answered. Okay, now this was just a specimen for you guys where I showed, how to attempt and how the main exam looks like. But you ensure that everything is complete over here and review your flagged questions, even if you give a guess. As I told you, this question was a bit tricky, so you want to come back to it later. But what if you don't get time to come back to it later? That's why always choose one answer only, go next. Okay, don't just flag it. Choose an answer, choose an educated guess and flag it. Because I've seen so many students who just flag it and then they'll think they'll come to this question a little later. But the problem is they run out of time and they don't have time to come back to it. And they've not attempted only this question. Because if you don't attempt, you end up getting 0. But what if my guess was right? I'll get 2 marks, no? So please be smart in answering your exam because that is also a skill. Because now we've seen how to, see a full-fledged ACCA FM exam. Correct? So this is how your exam looks like. Once you're done, correct? Once you're done with everything, like if you go to question number 36, that's your last one, right? So after that, if you go next, you will get this reviews answered and all of that. Now that we've not attempted all the questions, it is looking like this. Once you're done, you have to click on end exam. And it will again ask you whether you want to end the exam or not. So no means click no. If you have time, click no. And again, if you want to review, you can go back. But if you're sure you want to end the exam, then click on yes. Okay. And then once you click yes, you can't go back and change the MCQ and all of that. It is the end of the exam. I hope you guys understand that. All right. So this is how see 2 times it will ask confirmation. Then again, you'll click yes. And then you're done with the exam. It will say your exam is now complete. And then you can also review your answers later. How you have performed and all those things is available in your website. All right. So that was about how a computer-based exam looks like. I hope everybody has got an idea how to attempt the questions. This is available, guys. The moment you register, this specimen exam is available to you. So I would highly recommend you all to take up the mock paper without fail. All right. So now we have seen what are technical articles. We have seen read the mind of the marker. We have also seen how to attempt discursive questions, how to attempt objective test questions. We have seen a full-fledged CBE exam. Now, I want to show you guys one more important resource from your ACCA Global website, which you shouldn't be ignoring. Just give me a second. Let me share it. So let me share my screen. The next resource that's important for you guys is to have a look at it is this. So all of you might wonder, why is ma'am showing a FM retake guide? Okay, so generally retake guide is a guide which is again provided by your ACCA professional body, where the students who could not make it, who did not clear the FM exam, they would want to go through this so that they don't repeat the mistakes. But all of you have heard of this term, prevention is better than cure, right? So that is why we are going to look at this FM retake guide well in advance so that we know what are the mistakes that we should avoid. Correct? So there is completely no harm in looking at the retake guide even if you're taking the ACCA FM exam for the first time. Because this retake guide gives a detailed explanation as to why students got 49, 48, 47, you know that, right? 50 is the passing mark. Students end up getting 47, 48, just because of, certain tiny things where they had to pay attention to, correct? So with the help of retake guide, we can overcome that. We can make sure that we get 50 above. We can make sure that we don't do those mistakes which we could possibly make. So it's a really nice document, very attractively done by ACCA. So let's look at it. So what are they saying? 3 P's: plan, prepare, and pass. So welcome to your guide that is helping you to retake your FM exam. So don't look at it as retake. Think of it that even if you're writing the exam for the first time, what are the things that you need to focus on? So what are they saying? Why you have to use this guide? Because a structured approach to help you succeed in your retakes. Then you have signposted resources and how to use them. Tips for success to help you pass this time, not any time for anyone. Interactive clickable checklist so that it keeps you on track. So let's have a look at the retake guide. So first and foremost thing, what are they expecting? Understand where you went wrong. So most of the students, they fail an exam because they do not have the necessary knowledge or they have poor exam technique. As I told you, in such exams, even the skills, as I told you, right, that how to attempt a discursive requirement, how to present your answer, what is expected from the examiner, that if you understand, no, then your 50% of the work is done. So you need to have a good exam technique. The how you study also matters, correct? So in this, we're going to see how. So look at these. This is one student only told that during my break at work, I make sure I read a chapter or solve exercises in my book. All in all, you know yourself, you know your limits and capabilities, but you need to conquer the fear of failure and note something down somewhere that will give you that motivation and determination that will keep you going. For me, it was my family's sacrifice in helping me to fund my studies. So you can write a note over there because that can motivate you to study in case you feel demotivated or in case you're not finding motivation to study or you're feeling lazy. Then this is one way to ensure that you can avoid. So this was a student from UAE who wrote this. So what are the tips for success? Of course, don't give up. Use this guide to help you achieve your success in your retake. Start by thinking positively and believing that you will pass. Okay. See, planning to fail is like failing to plan, right? So you got to be positive. You got to, think that you're going to clear it no matter what. Okay. So having that positive attitude is very important. You have to study the whole syllabus, not just the important areas, because in professional exams, the questions can come from any areas. You should show your workings. Tell the examiner how you got the answers. Label them. Set them out clearly. Correct? Especially in questions like working capital, cost of capital, NPV calculation. Otherwise, you will lose mark. Remember, we saw, read the mind of a marker, how they deducted marks even because you just wrote very little, or it was a very weak answer or a less developed answer. So, see, this is an extract from the examiner's report where they're saying what are the possible questions or areas where students go wrong. So, if you notice, errors in calculating the cost of equity. So, you can make a note of the things which is very important. One is calculation of equity using DVM. Students use cum dividend instead of ex dividend share price. We all know that whenever we're using Gordon's model, we have to use ex dividend market price of the share and not cum dividend. So that was one general mistake. Then they took the formula incorrectly, or the growth rate was not calculated. Then in CAPM, that you know CAPM, no, RF plus beta into RM minus RF. So this itself is your risk premium. So normally students take it as RM and they get the wrong answer. So, or they forget to take the tax calculation, that is after tax, 1 minus tax. So these are some common mistakes done in the question, correct? Which they have pointed out, and they're telling, you know, these are the places where students have gone wrong, and that's the reason they got 45, 46, 47. So you guys don't make this mistake, correct? So that's one thing. Then why did you fail? Did you get somewhere around 45 to 49? Then it's because of the poor exam technique. Okay, you knew the concept, but you did not know how to present it, because presentation execution is very, very important. If you scored below 25, then that's because your concepts are not clear. Did you struggle to come up with answers? Then there is lack of knowledge, or you were just guessing the answers. Did you run out of time? Again, poor exam time. You did not do mock exams. You did not practice, you know, sitting for 3 hours. So all those things could be the reasons of your failure. How? Okay, now failure is done. How can you pass? What are the tips for success? They are only saying read the technical article. Didn't we look at it? They also showed, they're also showing the fact that if you haven't done so, please do it. And then there is student account to ensure you avoid specific to your exam. So much support they are giving, right? And as I told you, the reason students fail is because of lack of knowledge, poor examining technique, or a combination of both. If you're getting 25 and below, it's because your concepts are not clear. If it is just 48, 49, it's because the technique you will have not got the knack to write the exam. And for that, you have a lot of resources. Correct? So CBE technique, there is a separate page for CBE technique also, which you can see. Right? So that also, please don't miss it. You can go just by clicking CBE support resources. In that, I showed you guys, no? If you go to study support resources, choose ACCA qualification, choose FM, you will have those CBE techniques also. Then what else they're saying? Consider retaking through approved learning partner itself. Have a study plan, obtain an approved content provider. So all that basic things. Then they also have a study planner. Okay. ACCA global website, if you go there, there is something called as plan your studies. So you can actually utilize that, because students want to make a plan. Of course, planning is one part, execution is another part. So don't just plan, you have to execute it also. But for you to plan your study, there is this template which is easily available for you, wherein you can plan. Okay, in week 1, I'm going to cover chapter 1, 2, 3, like that. So sticking to the plan is even more important. Then you have, they're also saying the reasons why one student could fail because of poor exam technique, right? And what is that? Because schedule in time to watch the study support videos and review the exam technical articles, which can be found. See, so many times they're saying read the technical articles, because it will give you pointers on how you can improve your technique. So all this study syllabus guide, response. See, this is one more important thing that I want to tell you guys. You all know it's a computer-based exam, right? So you have something called as CB specimens and past sample papers, which we have already done in our revision session. But I would make sure that you guys practice in this constructed response workspace. Okay, so you can download this constructed response workspace, which is exactly like how your ACCA FM exam will look like. Okay, so if you come here, you will be able to, you have to log in for that. And once you do that, you can download it. Okay, this constructed response workspace is a sheet which has limited Excel features like how you have in your ACCA FM exam. So please download that, and all your section C questions you practice in that sheet itself, so that you are aware of which functions are available in the main exam. See, there is one more student who is saying, after failing with 40% for the first time for my retake, I made sure I read the technical articles carefully. I can't stress more about the importance of these technical papers. Examples illustrated in these articles are so clear that it's very hard to not understand them. So technical articles, third time they're mentioning. So please don't ignore it. Then before you start, what else? Question practice, all these things, you know it. Remember to think positively, don't give up, practice properly. All these are anyways there. Apart from that, what else? So practicing questions, keeping a check on the time, keeping a check on the clock is very important so that you don't run out of time. Then you have this duration. I'm sure everybody knows this. We've had a discussion how much time you should spend. So look what they say. You should spend approximately 2 hours on section A and B and 1 hour 20 minutes on section C. So 3 hours exam, no? 2 hours. Sorry. Total exam time is 3 hours and 20 minutes. Okay, it's not 3 hours, it's 3 hours 20 minutes. So prior to the start of the exam, you will also be given up to 10 minutes to read the exam instruction. So they're giving you how much, how you have to plan your time. Then they're also saying use the time wisely, look at the constructed response questions, then think that, that you will be given that first little time, no? In that you have to plan properly. That's one thing. And then reading the requirement. I told you guys again, right, that especially in your section C questions, read the requirement of the question properly, identify how many parts are to the requirement and allocate your time. Remember in that example that we took, the directors had 4 views and each view carried 2 marks. So you have to plan your answer accordingly and identify the verb and understand what is required of you. Carefully analyzing the answers provided in the question and answer banks once you've attempted a question will help you understand what does different verbs mean, right? What is the examiner asking? Now this is like your read the mind of the marker itself. If you look for it, you can arrive at it. So see, another student is saying, I had the knowledge, but I did not attempt enough questions to learn the examiner's style. So I could understand what he was asking in each question. So the key to retaking this exam was to find a new approach. Do as many questions as possible. So I understood what I was being asked. See, again, a student where they're stressing on the exam technique. Then time management, please make a note of it. Remember, you should always allocate 1.8 minutes per mark. Once you decide how long you're going to spend on a question, you need to stick to it as long as you come back to it. Don't rush on your objective test questions as it is easy to misread the question. Okay, so don't be, I know you will be under pressure, but don't let the pressure defeat you. Okay, make sure that you're calm and you're answering the requirement at least twice so that you choose the right answer. Apart from that, make sure you're answering the question set and not the questions you wish you had been set. So basically they're asking answer to the question, don't give your own answers. Then application of the knowledge, what are the other tips? You have it all, right? This document is easily available in your ACCA website. Just have a quick glance at it. So I just wanted to show you guys that there are so many things. Identify where sometimes students don't know where their exam is. So all those things, plan it accordingly. take the necessary documents and eat properly before the exam, sleep properly. Don't spend the last night before your exam doing last minute revision, because you're already under pressure and you're going to panic. So such things and all, please avoid. Don't go to discuss, because that's again going to increase your stress. Once the exam is over, you relax. Don't overanalyze, because you can't change anything now, right? So this is a very cute document which you have to have a look at it. Don't think this is only for retakers. You look at it as a opportunity, so that you don't make the mistakes what students who did not clear the exam made it. So plan, prepare, and pass. So that's about your retake guide. One more document where I would want to give my tips and tricks for you guys to clear the ACCA exam in your first attempt. So what I would recommend is, there are some 8 must-know things in FM. If you're writing an FM exam, these are the things which you can definitely not avoid. First one is NPV calculation. You have to know how to convert your future cash flows to present value terms. You need to know how to read the discount factors, annuity factors. All that is very, very necessary and important. Only include incremental cash flows. You know that working capital in year 0 is negative. Then at the end of the project, there is a recovery. All these basics. Then the tax on profits. If there is arrear in the question, then make sure that you have included that. Any cost as related tax income. Then your tax allowable depreciation. All those concepts have to be understood carefully, because they will definitely be tested either in section A, B, or C. So one of the 8 must-know things in FM is NPV. Then comes your weighted average cost of capital, which is again very important. The formula is given to you in the formula sheet, but you need to know what is the meaning of it. Are they asking on book values, or are they asking on market values? Generally, they ask you on market values itself. So if the question is silent, always use market values. You know what is weighted average cost of capital. A company might raise finance from various sources. So you need to know how to calculate cost of equity, how to calculate cost of preference shares, how to calculate cost of debt, how to calculate cost of irredeemable debt, bank loan, and together you should be in a position to calculate your weighted average cost of capital. In the revision session also, I've told you guys to stick to the format so that you take everything into consideration. So here there are certain places where you have to pay attention to. When they say retention ratio, it is a percentage that they want, right? For example, if your earnings is 100 and you gave dividends of 40, that means 60 you have retained. You should not take 60. You have to take 60%, because it's a ratio. So all these tiny things you have to keep in mind. The third important thing is your working capital. I've already stressed so much on this that you need to know the liquidity, profitability trade-off. Then the concepts, that is the conservative, aggressive, not permanent, fluctuating, all those things, cash operating cycle. What are the factors? Very heavily tested in ACCA FM exam. Then the fourth important thing is business valuation. We know business valuation is an art and not science. What are the different methods? Which is the best method? The advantages of methods? All of that. Most likely to be tested in section B as one objective test question. That is a scenario and then 5 questions carrying 2 marks each. You need to know how to calculate the market value. It is the number of shares into the market price of the share. Correct. Then the risk management, which you cannot, ignore. That is how to calculate your forward exchange contract, futures contract, risk management, your purchasing power parity theorem, interest rate parity theorem. All these things also have to be kept in mind. Ratios, as I told you, your ratios, every chapter you have studied different ratios, right? So financial ratios, here you will understand all the ratios in one place. So this is also very important, your dividend, activity ratios, profitability ratios, liquidity ratios. So you need to be aware of the formulas. Then the 7th most important thing is theory. You cannot afford to ignore theory. You have to, especially those topics like market efficiency, then your Modigliani and Miller, that is your capital structure theories. All these are very, very important. So don't ignore them. correct? So that's one more thing. And then also your risk and uncertainty and specific decisions, not just NPV in your investment appraisal, whether it is better to lease or buy a particular asset, or when is the right time to replace a particular asset, sensitivity analysis. All these are also important concepts. So these are the 8 must know things in FM. If you are not aware of these concepts, please don't write the exam. So make sure that you have done the thorough revision of all these concepts, and only then you are ready to take up the ACCA FM exam. So all of that, now we have come to an end of the ACCA rapid revision session. So I would want to share a very motivational quote for you guys, okay, which is really very inspiring. Okay, not like quote, but it's more like this formula. It has maths in it. You all know that 1 to the power anything is 1, right? So 1 to the power 365 is going to be 1 itself. But if you could just do, 1% extra effort. So 1 plus 1% is how much? 1.01, right? So 1.01 the whole to the power 365. Look at the answer. It is 37.7. Correct? If you're not doing anything, you will be there itself. But if you at least put 1% hard work, look at the results. It is 37.7. You do 1 minus 1%, you'll get 0.99, and do to the power 365. It will become less than 1. So the point that I'm trying to make is doing nothing at all. Okay, just staying there, you'll be like that only. If you become even more lazy, that is 1 minus 1% if you do, you will get an answer which is less than 1, which is worst case scenario. But if you can just put 1% extra effort in your studies, look at the result. It is 37.7. So imagine this is just 1%. If you put more than 1%, it's just going to increase. So doing nothing at all versus small consistent efforts is going to take you to places. Okay, so start with solving one chapter or solving one exam kit problem, then move to next. So in this way you have to motivate yourself, right? Because you all want to clear the FM exam, right? So yeah, that's about your rapid revision session, where we had a detailed discussion as to which are the important resources. Right from day one, we touched upon the important concepts of FM. We did past exam papers on the important areas of the syllabus of FM. We did technical articles. We also covered important resources provided by our professional body, that is your read the mind of the marker, FM marker, and then how to answer the discursive questions. Then we also saw how a CBE exam looks like, what is the format, what is it, how to manage time, and we saw prevention is better than cure. And finally, I gave you guys some tips and tricks to clear your ACCA FM exam in your very first attempt. So another thing that I normally tell my students is, for any professional exam, for you to clear any professional exam, you need these 3 C's. What are those 3 C's to clear a professional exam? One is concept clarity. I've been telling in my classes also that understanding the concept is very important, because once you understand the concept, you can apply it. They twist and ask, you'll be in a position to answer. Second, consistency is very important. You have to have, consistently, you have to study, just like how you eat, brush, sleep every day. Similarly, study should become a part of your routine. And finally, the third most important thing is confidence. Okay, this is very, very important, because I've seen so many students who are, their concepts are clear, they've consistently studied, but exam fear. Because of exam fear, they, lose out on by 1 or 2 marks. So please don't do that. You all have written your exams. You all have written so many exams since childhood, right? Just treat it as just another exam. But yeah, work hard. And if you are able to follow all these 3 C's, then I assure you guys that you will definitely clear your exam. Okay, because for any professional exam, concept clarity, consistency, and confidence is the key to clear the exam. So, on that note, our journey comes to an end, right? It was a very, we've come a long way now. We started with the understanding FM and all of it, and we've done with the revision session as well. I wish you guys all the very best. All right, do well, clear the exam in your first attempt, and carry this knowledge of FM in your AFM paper also, right? And yeah, work hard and party harder. So I'm gonna stop over here, and I wish you guys all the very best. Do well. Bye bye.